I guess we are live. Just confirm me with the audio video. Just confirm me with the audio video. Can you all hear me? Perfect. 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 Just give me a second. Okay. Okay, Ji. So, hello everybody. Vanakkam, good morning, and welcome to this day 3 of our CA Final Direct Taxes and International Taxation Marathon series. Sir, what is day 3? How you all are doing? Everything we shall answer. First of all, you mark your presence in the comment box so that I am aware that you are awake, you are listening, and you are there. Sir, we started off with day 1 where we covered the international taxation, transfer pricing. We covered advanced ruling, DTAA. We covered as well base erosion, profit shifting, and tax treaties as well. And even latest development in international taxation we covered. This is the entire day 1 which covers your entire international taxation. We are done with it. Apart from that, yesterday in the day 2, we did all these small topics from the direct tax, namely 10 topics: appeals, GAR, DRC, clubbing, set off, tax audit, black money law, ICDS, deductions. These 10 topics yesterday we did. Now, whatever the remaining portion is, whatever the direct tax portion remaining is, the big, mighty direct tax portion, whatever remaining is now, our target is to complete today. If I broadly tell you what all chapters we are targeting, we are just targeting the tax rates, capital gain, IFOS, PGBP, assessment of various entities, trust taxation, TDS, assessment procedure, and at last, if time warrants, we might do penalties as well. So this is the an honorable target for us. Again, where are you going to find this material? So this material is actually not mine, but this is ICI study material only, but condensed in just 350 pages. I would request you that if you have your material as of now, whatever material you follow now, that's absolutely fine. At this juncture, you might not be willing to change, but if you have sufficient time before exam, you might refer this material as well. Sir, if whether I will be solving question answers or not, wherever I will be solving from Super 150 question answer PDF. That PDF is circulated in my Telegram channel. You can refer to that as well. You can go to Telegram channel. Link is in the description. At last, sir, always we have to be energetic. We have to be always responsive to the comment, and we have to be very. We have to be very clear. Okay, we have to be very enthusiastic because this is the big day. Here we have to cover a lot of things. And the first thing that you have to do is like the video, subscribe to the channel, and also comments are clear during the entire session. Let's start without wasting even a minute. Starting with the tax rates chapter. First of all, Ji, basic tax rates, normal tax rates, alternate tax rates, special tax rates. What is there in this chapter? There is nothing in this chapter. Basic tax rates, you are aware, yaar. I don't think that this is the thing that I should be telling you. What I should be telling you is 115 BAA. Good morning to all of you. Super energetic, and we will ace our chapters with you today. Perfect, sir, perfect. 115 BAA. Hi, sir, just waiting for penalties to upload. I will upload it as soon as possible. I will upload it. After class, the throat becomes not usable. Therefore, I could not do from last 2 to 3 days, but I will get that done either today or tomorrow afternoon. I will get that done now. 115 BAA. What does this section says? See, if you are a company and you don't want to pay general tax rates of 25 and 30%, so you have an option to pay 22% tax rate, flat 22% tax rate. But when you exercise this option, you have to pay flat. You have to pay a flat 10% surcharge. You have to pay flat 4% education cess. All in all, your effective rate turns out to be 25.168%. In this entire tax rate now, whatever your special rates are, whatever your incomes which are taxed at special rate, they shall be continued to be taxed at special rates only. Done, sir. Similarly, we have 115 babe. What this section is, I'm just briefing you out the tax rates, not the depth of this, because this depth is not tested. Only the tax rates are important in this. See, if you have a manufacturing income, then you are taxed at 15%. If you have IFOS income like dividend, if you have house property income, if you have any kind of interest income, this is taxed at 22%. If you have any income which is taxed at special rates, this shall be taxed at special rates only. If you have any chori ki income, you understand chori ki income? You try to divert your high tax paying income to this unit, then such income would be taxed at 30%. And if you have short-term capital gain, if short-term capital gain is on depreciable asset, then 15%, and non-depreciable asset, then 22%. All these tax rates plus 10% surcharge plus 4% education cess will give us 115 BAB. Done, sir. BAD is same for cooperative society. BA is same for cooperative society. We are not getting to depth of that. But important here is what are the conditions, what are the forgivens, and what are the things that we have to let go to get to get these benefits. First of all, you will not be required to comply with AMT and MAT. The best thing of all, you will not comply with AMT MAT, and whatever AMT MAT credit you have, that shall lapse. Wow, sir. Wow, wow, wow. Once you go for these regimes, now you cannot claim additional depreciation. You cannot claim deduction under 10 AA. You cannot claim deduction of 33 AB ABA. You remember 33 AB ABA? I know you forgot. I know you forgot, sir. It is 33 AB ABA. Tea, coffee, rubber business, 40% deposited to NABARD. Petroleum and natural gas business, 20% deposited to site restoration account. You used to get the deduction. Now you will not get here. You will not get if you go for new tax regime. Section 35. Section 35 was donation. Donation for scientific research. Somebody is into scientific research. Somebody is an IIT, approved college, approved research institution. You used to donate them and you used to get deduction. Lawmaker says that donation will not be allowed. Sir, what about there was also a first part. If we do scientific research and started business, we used to do revenue and capital expenditure. If we have not started business, scientific research, but revenue capital, that shall continue to be allowed. This shall be continued. No worry. Whenever these things happen, we shall this type of business can be allowed as deduction under new regime as well. Donation shall not be allowed. Okay, donation will be disallowed under 115 BAA, BAB, BAC, BAD, BAE. Done, sir. If you are opting for 35 AD, remember no 100% deduction. Wow, sir. 35 triple C and CCD, what these two sections are. See, CCC was about agriculture extension project. You used to get capital deduction of capital expenditure there. CCD was about skill development project. Here also you used to get capital expenditure deduction. Now this will not be given to you. Any chapter 6 deduction would not be given to you. But there are 3 sections that you are going to get. What are those 3 sections? Sir, 80 JJAA jao jao or admilao JJAA JJAA JJAA. ठीक है sir. Then we have 80 LA and then we have 80 M. These 3 sections we are going to get under 115 BAA, BAB, BAD, BA. In these 4 sections we are going to get. Any unabsorbed expenditure is there now. If there is any outstanding unused additional depreciation or 35 ED expenditure unused, it shall lapse when you exercise for this regime. Next point, sir. Done. Whenever you want to opt for this scheme, now you shall file the form. You shall file the form before the due date of ROI. Okay? Whatever the form is, that 10 I8 and IB, whatever the form is, you have to forward. You have to furnish before the due date of ROI. Done, sir. Third thing, 115 BAC. This is important. This is important, sir, because this has undergone changes. If you are an individual HUF, AOP, BOI, artificial juridical person, you will pay taxes by default with this rate. For your attempt, this rate is applicable. Sir, what are the rates? Up to 4 lakh, now you don't have to pay any taxes. To 4 lakh, no taxes. 4 lakh to 8 lakh, we have 5%, 8 lakh to 12 lakh, we have 10%, 12 lakh to 16 lakh, 15%, 16 lakh to 20 lakh, or 20%, 20 lakh to 24 lakh, 25%, more than 24 lakh, 30%. This is the slab rate applicable. Sir, how do we solve? In exam, do we have to write this long slab rate? Right answer is no. For example, we have with us Akash. Akash has been given with income of 40 lakh rupees. We can simply do one shortcut. Reduce 24 lakh rupees, multiply 30% plus 3 lakh rupees into 1.04. This is the shortcut we can do. ICI also does in the questions of DTAA, so we can also use this shortcut. Perfect, sir. Perfect, sir. Perfect. Whenever assessee go for 115 BAC, in that case, now how much surcharge is applicable? If total income is up to 50 lakh rupees, then no surcharge. 50 lakh to 1 crore, 10%. 1 crore to 2 crore, then 15%. And more than 2 crore, then we have 25% surcharge in this entire surcharge process. Now, remember, 25% surcharge will not be applicable to any short-term capital gain under 111A, 112A long-term capital gain under 112, and dividend income. We know these things. Another benefit under 115 BAC is, sir, remember, there is a concept of rebate under section 87A. What this says, if you're an individual, okay, if you are an individual who is a resident, remember, rebate under 87A is given to only individual and those who are resident. Individual, those who are resident. Individual, those who are resident. Mind it, okay? Who do and rebate is not allowed on any income which is taxed at special rate. Rebate will be only allowed on the income which is taxed and with the slab rate only. Okay? How much rebate would be given? Rebate would be given to you if your total income is up to 12 lakh rupees. Taxes payable or 60,000, whichever is lower, shall be the rebate amount. Taxes paid or 60,000 rupees, whichever is lower, shall be the rebate amount. What did I say? Resident individual, total income to 12 lakh rupees. Then rebate will be given to you at the rate of taxes or 60,000, whichever is lower. You have to make sure that no rebate is allowed on the income which is taxed at special rates. No rebate shall be allowed. But under 115 BAC, we have a concept of marginal relief. Sometimes what happens is your income is just above 12 lakh limit. So lawmaker says that instead of taking away all of your rebate, what we ask you, so just to surrender the above taxes. Just telling you, for example, if somebody has income of 12 lakh, 1 rupee. In that case, rebate will not be available. So he will be required to pay taxes of 60,000 rupees. Lawmaker says, no, don't pay that. Just surrender this over and above 1 rupee and we shall not ask you any taxes. So there is a concept of marginal relief as well under 87A rebate if you opt for 115 BAC. Done, sir, done, sir, done, 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 sir. When you are opting for 115 BAC, now what are the things that you have to let go? It is important. Okay? What are the things that you have to let go? These are important. First of all, you are not required to comply with any kind of MAT. You are not required to comply with AMT. You are not required to have any credit as well. Whatever credit you have, that shall go. Remember, what are the things that you have to let go? Listen up. If you have house property income, and if you have a house property which is self-occupied, no interest on self-occupied house property allowed. That means you cannot have loss in self-occupied house property. Sir, if you have a let out house property, if you have given this property to somebody out on rent, in that case, you will be allowed interest deduction, but that interest said loss cannot be set off against the other heads. And that loss cannot be even carried forward. Wow. Wow. That means now we cannot have any loss from house property as well. Because in self-occupied house property, no loss possible. Under let out house property, loss is possible, but we cannot set it off. If you are having salary income, what will happen in case of salary income? Sir, every allowances that was earlier exempt is now taxable. Only few allowances are remaining. That is travel allowance, duty allowance, conveyance allowance, daily allowance. Except for these 4 allowances, every allowances that we have are now taxable. HRA fully taxable under 115 BAC. Sir, what else do we have? See, earlier we used to have a leave travel concession. If your employee used to give you a leave travel, trip, he used to give you, then it was taxed at your salary and this was exempt. Up to certain limit, it was exempt. Lawmaker says we are going to take away that exemption. Third thing, if you go for 115 BAC, any deduction for professional tax would not be given to you. Any deduction for entertainment allowance, this was allowed to government employees, will not be given to you. Standard deduction, which is given 50,000 rupees, will now be given 75,000 rupees. Under PGBP, no additional deduct depreciation, no 33 AB, ABA. Take off your scientific business, NABARD, you remember? Na? Just try right now, we referred. Scientific research, if you donate to somebody who is into scientific research, that shall also not be allowed. Specified business also, that shall not be allowed. Other sources are, what are the things that you have to let go in other sources? First of all, is if you are an MP MLA, if you remember, for a MP MLA MLC, constituency allowance was exempt. Constituency allowance and daily allowance was exempt. Now this will not be exempt. Apart from that, if you had a minor child now, and any income of minor child was exempt, sorry, 15 up to 1500 rupees, you used to get exemption for minor per child you used to get, but this is not allowed in new tax regime. Only in old it was allowed. At last, sir, how many deductions you have to let go? 10 double A, let go. Chapter 6 say almost let go, but there are 4 deductions allowed. First of all is 80 double J double A. Second is 80 CCD to employer's contribution to pension fund. It is first tax in your hands and then you get 14% of the salary deduction. 80 LA if there is an offshore banking unit in IFSC or IFSC unit. Or at last 80 CCH2, government's contribution to Agniveer Corpus. It is first tax in your hands and then you get deduction of it later on. If you opt for 115 BAC for the first time, whatever the expenses you had, whatever the deductions you had that you had till last year, you have to let go. 30, any 35 AD, any 35, any additional depreciation, and you shall be let go. Wow, sir, wow. Come on to virtual digital asset. Another important thing. See, whenever there is a virtual digital asset and you transfer it, then how capital gain is calculated? Sales amount minus cost. That's it. No transfer expenses allowed. No additional deductions allowed. Nothing. No chapter 6 allowed. No rebate under section 87A. Rebate under section 87A. Sir, rebate under section 87 is allowed. Under old regime, it is allowed. Under new regime, BAC, it is not allowed. Sir, any expenses not allowed. Any loss set off not allowed. Sir, if I have a loss in one crypto and if I have a loss in a profit in other crypto, can I set it off? Right answer is no, I cannot set it off. If I have loss in one Bitcoin and on the same day I have profit in one Bitcoin, can I set it off? Right answer is no. If I have any other loss, can I set off against this income? Sir, I cannot. This is, I mean, a dead loss. You cannot set off, you cannot carry forward. Similarly, if you have any profits, now these profits are fully taxable. You cannot tax, you cannot set off any losses, any unabsorbed depreciation from this profit. This is as good as payable. Any amount of profit is fully taxable at the rate of 30%. 30% is the tax rate. Gotcha. Come on to income from capital gain. Wow, sir, just in 15 minutes, major portion of tax rates done. Major portions of tax rates done. Income from capital gain. Sir, bigger chapter, relevant portion only. Okay? First of all, meaning of capital asset. Sir, capital asset meaning is also relevant. Arey Baba, why not relevant? Because this has undergone amendment. Listen carefully. What is a capital asset? First of all, three things are capital asset. First of all, any asset is a capital asset. Any asset, everything is capital asset, but exclude four things. Any stock in trade for business has to be excluded. Any movable personal asset is to be excluded. It is not capital asset. Any rural agricultural land or any gold deposit bonds are not capital asset, but any jewelry, drawing, painting, sculptures, archaeological collection, these are capital asset. Second thing, any securities held by FIIs are also capital asset. Apart from that, any ULIP is also a capital asset. But here there is a catch. Here there is a catch. Sir, just with Finance Act 2025, any securities held by investment fund category 1 and category 2 are also considered as capital assets only. That means if FII, sorry, if in alternate investment fund sell any shares now, it shall be capital asset, not the PGBP. Done, sir. This rural agriculture land, I don't think it is relevant for exam. Transfer, I don't think personally it is relevant. Period of holding, it is not relevant as of now. Things that is relevant are in exempt transfer. I don't know what is the love with the examiner with by this exempt transfer. I mean, how this has been asked from many attempts. I mean, indirectly they are asking this. Some of the exempt transfer we need to understand. First one, if you are a company, you are transferring any asset to wholly owned subsidiary, or your wholly owned subsidiary is transferring to your parent, then this transfer shall be exempt transfer provided recipient is Indian company. If we are transferring to subsidiary, subsidiary shall be Indian company, subsidiary transferring to us, we should be Indian company. Kishore, good morning, sir. Joined late. No issue, Kishore. Recipient should be Indian company. Second thing, sir, 100% parent subsidiary relationship shall exist for at least 8 years. Wow. And third thing, sir, the recipient should not convert this capital asset into stock in trade. That's it. Recipient should not convert this capital asset for at least 8 years. They should not convert this. And yes, that's it. If you fulfill these conditions now, then whatever transfer you are doing to the other person is absolutely exempt. What did I say? Recipient should be Indian company. 100% parent subsidiary relationship should exist for at least 8 years from the date of the transfer, and the recipient should not convert this capital asset into stock in trade. What if it is violated? Sir, what if it is violated? Then exemption shall be withdrawn and tax is charged in the hands of the transferor. Transferor is being taxed, okay? In the previous year in this transfer took place. So whatever the exemption was there, it shall be withdrawn. Depreciation in case of amalgamation. Sir, amalgamation depreciation. Listen. For example, Zomato merged with Blinkit. Zomato amalgamated with Blinkit. So there was transfer of assets happening now to Zomato. Provision says this is exempt. Similarly, shareholders of Blinkit got free of cost shares of Zomato. Ultimately, their shares were taken away, Blinkit shares were taken away, and forcefully they were given shares of Zomato. This is also an exempt transfer. Same goes with demerger, same transfers would be exempt. So the definition of amalgamation and demerger, just focus a bit. If two companies merge, for example, X and Y merge and become XY, this is also amalgamation. X and Y merge and they become Z, this is also amalgamation. X and Y become X, then to it is amalgamation. X and Y becomes Y, then to it is amalgamation. Under income tax, every two companies merging together, it is amalgamation only. It is an exempt transfer when all the assets and liabilities of amalgamating company transfer to amalgamated company, and at least 75% of the shareholders shall become shareholder in the new company. Similarly, in case of demerger, there are two companies: demerged company, resulting company. All the assets of the demerged company should go to resulting company. They shall be transferred at book value. Business should be transferred on going concern basis. In return, only shares should be allotted, and at last, at least 75% of the shares holders holding the shares in the demerged company should continue to hold the shares in the demerged company. Basic condition, if you understand this well, otherwise you can skip this point as well. That's okay to us. Then we have an exempt transfer, which is conversion. Conversion is also exempt. Lawmaker says if you are a sole proprietor and you want to convert yourself in a company, what things you shall take into consideration? All assets, liabilities of the proprietor should go to company. All assets, liabilities of proprietor should go to company. In return, what proprietor should get? Proprietor should get just the share capital and not the money. No money shareholder should get, only the shares he should be getting. And if he is becoming the shareholder of the company, he shall have 100% share capital. Now he shall continue to hold this 100% share capital up to 5 years. At least 50% he shall hold. At least 50% he shall hold. Otherwise, whatever exemption is shall be withdrawn and it will be taxable in the hands of the successor. Similarly, if there is a partnership firm who converts itself into company, then all the assets and liabilities of the partnership firm shall go to company. Company shall allot the share capital. Whom shall be allotted? Sir, the partners shall be allotted the share capital. In what ratio they shall be allotted? In the ratio of their capital contribution. And these partners shall become shareholders in the ratio of their capital contribution. At last, sir, whatever the partners were there, say ABC, they shall become shareholders. These partners shall continue to hold at least 50% of the PSR, 50% of the profit sharing ratio up to 5 years from the date of transfer. At least 5 years, the 50% ratio shall maintain. Otherwise, exemption will be withdrawn and it will be taxed in the hands of the company. At last, sir, we have another exempt transfer, that is if unlisted company converts itself into LLP. If company can every company convert itself into LLP? Right answer is no, not every company can convert itself into LLP. Sir, if company has turnover up to 60 lakh rupees in three previous year, the year of conversion, you don't have to take that three previous year. If out of the three previous year, all the years your turnover is up to 60 lakh rupees, plus your assets in last 3 years are up to 5 crore rupees, then only this unlisted company can convert into LLP. What are the conditions attached? Whatever the assets and liabilities are now shall go to LLP. LLP shall allot the profit sharing ratio and capital in the ratio of the shareholding. Shareholders should not get anything in return except for the shareholding, sorry, except for the profit sharing ratio. At last, whatever the reserves are there now, whatever the reserves are there of the company, these reserves cannot be used, cannot be touched by this LLP members for at least 3 years. These are the conditions which have to be fulfilled for making this an exempt transfer. If any of the condition, acha, one more condition. Whoever are the shareholders shall become the partners. These partners shall continue to hold at least 50% of profit sharing ratio at least up to 5 years. Then only this transfer will be exempt. Any of the condition violated, in that case, what would happen? LLP has to pay the taxes on the amount which was exempt earlier. Successor company has to pay the taxes on the amount of capital gain which was exempt earlier. Wow, sir, wow. Computation of capital gain now. Computation of capital gain, what this computation of capital gain actually mean? See, whenever you compute the capital gain, now why I have given this an important topic, listen. Computation is always to be solved with a format. If you do not follow the format, there are greater chances that you will do wrong or examiner won't give you marks. Always try to follow this stringent format. Computation of capital gain, first of all, take full value of consideration, reduce the expenses. This will give you the net consideration. So full value of consideration minus transfer expenses, this will give you the net consideration. Is there any shortcut to remember the shareholding maintained in the various new entities? 50% is the standard. Some cases it is 51%, but otherwise in all cases it is 50%. See, net consideration minus cost of acquisition minus cost of improvement. This will give us the capital gain. This capital gain will be long term or short term depending upon the period of holding. That's enough. After this, now you have to reduce the exemption here, exemption under 54 to 54F. And after exemption, you have taxable capital gain. On in this taxable capital gain, now we shall be charging 112A, 111A, 112. This is how you are going to charge taxes. Fair enough. Fair enough, sir. Fair enough. While calculating the capital gain, you have to take certain things in mind. We shall discuss that later on. First of all, now I would request you to come on to special cases, that is some special cases. And first of all is ULIP taxation. We have certain other things. We have some transfers as well. We shall discuss that later on. Come on to next topic, that is ULIP taxation. Very important topic. Keep everything aside. Keep everything aside. If you buy unit linked insurance policy or LIP, if you buy unit linked insurance policy and LIP, it will be only and only and only exempt if you have liked the video. If you have not liked the video now, government is forcefully going to tax your ULIP. Government is forcefully going to tax your LIP. I'm telling you. I'm not just warning it, but I'm just telling. It will be taxed in your hands. Sir, consider first of all, okay, if there is any ULIP or if there is any LIP. Okay. If annual premium is more than 10%, if annual premium is more than 10% of sum assured, for example, sum assured is 10 lakh rupees and annual premium is say 2 lakh rupees. If annual premium is more than 10% of sum assured, now then any ULIP would be taxed under the capital gain. Any LIC would be taxed under IFOS. LIP would be taxed under IFOS. So ULIP, if annual premium is more than 10%, LIP is 10% more than premium, then ULIP would be taxed under capital gain and LIP would be taxed under IFOS. Basic thing it is. Basic thing. What about, sir, if ULIP, if a premium is up to 10% in both the cases, even in ULIP, even in LIP, premium is up to 10%. Then in that case, when was ULIP issued? If ULIP was issued before 1st Feb 2021, then it was absolutely exempt. Any amount it was exempt. But after 1st April 2021, if ULIP is issued now, then aggregate premium up to 2,50,000 rupees would be exempt. Aggregate premium beyond 2,50,000 rupees would be taxable, and taxable under that capital gain. Similarly, for LIP, if it is issued before 1st April 2023 and it fulfills the 10% criteria, then in that case, you don't have to check any other thing. You don't have to check any other thing. It will be exempt on maturity. Similarly, if it is issued on or after 1st April 2023, then you have to check the aggregate premium of 5 lakh rupees. Up to 5 lakh, it is exempt. After 5 lakh, any of the premium that you pay now, it will be taxable, and taxable under that IFOS. So ULIP will be taxed under capital gain hit and LIP would be taxed under IFOS, and that is the bottom line. In this entire juncture, always understand, if this is taxable, say for example 10%, more than 10%, more than 10%, more than 2.5 lakh, more than 5 lakh, this all shall become taxable now. Lawmaker says if any of the policy that is taxable, but if it is received at the time of death, in that case it is not taxable, it is exempt. Any policy received on account of death is not taxable, it is absolutely exempt. Okay. Let me take an example that will illustrate you what do I actually mean. On 1st Jan 2021, I bought a ULIP of 5, which is sum assured is 5 lakh rupees, and annual premium is, sum assured is 50 lakh rupees, annual premium is 5 lakh rupees. See, before 1st Feb 2021, we only have to check whether we are fulfilling 10% criteria or not. Are we fulfilling? Right answer is yes, sir, we are fulfilling 10% criteria, so this is exempt. After 1st April 2021, we have to fulfill 10% criteria and a 2.5 lakh premium as well. 12 lakh is the sum assured and 1.2 lakh rupees is the annual premium. Are we fulfilling 10% criteria? Whether annual premium is up to 10% of sum assured, right answer is yes, the 10% criteria is fulfilled because premium is just 10%. Take a breath. What we are studying, ULIP taxation. Annual premium, if it is up to 10%, na, it is normally exempt. Okay? But after 1st April, annual premium 10% plus 2.5 lakh of annual premium is only exempt. On 1st March 2021, we bought another ULIP and sum assured was 13 lakh rupees. Annual premium was 1,30,000 rupees. Again, 10% criteria is fulfilled. Clubbing both of them, if we can see, 2.5 lakh criteria is also fulfilled because both the premiums combined together are not more than 2.5 lakh. Fair enough. ULIP 4 on 1st April 2021. Annual premium is 2.4 lakh rupees. Sum assured is 224 lakh rupees. That means, can I say we are fulfilling 10% criteria? Yes, sir, we are fulfilling 10% criteria. Are we fulfilling 22.5 lakh criteria? Sir, we are fulfilling 2.5 lakh criteria on this. But next year, we will be required to pay this as well now. These two ULIPs will also be required to be paid in next year now. So our annual premium will exceed more than 2.5 lakh. Your annual premium will exceed more than 2.5 lakh. In that case, what happens? If your annual premium exceeds more than 2.5 lakh, now you have to select which ULIPs you want to claim for exemption. If you select these two, then the third one will become taxable. If you select the third one, this fourth one is exempt, then these two you have to tax. You have to choose accordingly. You have to decide. So if you have multiple ULIPs, now you have to select the best 2 or 3 which you want to claim exemption and which you will be having the most benefit on capital gain. Whenever ULIP is being taxed, how it is being taxed, amount received minus premium paid till that date. No indexation allowed, or indexation is not allowed anywhere. And then long-term capital gain under 112A. This is how ULIP is being taxed. Point number 12, that is slump sale. I hope ULIP taxation was simple. ULIP taxation was not difficult. It was simple. Now, if you transfer any of your unit, if you have multiple units and you are transferring one of the unit, then we call it slump sale. Whenever you transfer any of the one unit now, then three things are calculated. Full value of consideration minus transfer expenses will give you net consideration. Full value of consideration is taken as FMV1 or FMV2, whichever is higher, or net consideration is taken as net worth. Okay, this will give you the capital gain. This will give you the final capital gain. Fair enough, sir. Fair enough. If a unit is held for more than 3 years, na, then only it shall become long term. Otherwise, it shall not become long term. See, for every asset, we have 1 year or 2 year of period of holding. But for slum sale, na, we have 3 years of period of holding. As of now, as well, it is 3 years of period of holding. If unit is held for more than 3 years, then only it shall become long term. If held for 3 years or less, in that case, it will become short term. How do we calculate the FMV1 and FMV2? How do we calculate FMV1 and FMV2? I'm giving you a thumb rule. FMV1 implies whatever the assets are gone, take the FMV of that. FMV2, whatever the assets are received, take the FMV of that. For example, if the unit which is transferred had a property, immovable property, take the stamp duty value of that. If the unit that we have transferred had shares, take the fair market value of those shares. If the unit that we transferred had any painting, drawing, jewelry, in that case, take the open market value of that as per merchant, banker, chartered accountant. If unit had any other asset, now they take at book value. So immovable property at stamp duty value, shares at FMV, jewelry, painting, other things at open market value, and any other thing at book value. Reduce liability, and this will give you the book value. This will give you the FMV1. FMV1. Ignore TDS. Yes, this is what we are going to ignore. We got it. FMV2 talks about assets that are received. If you receive money, take money. If you receive FMV of any other, if you receive any other assets, for example, you receive shares, then take the FMV. If you receive any jewelry, then take open market value of that jewelry. If you receive any immovable property, take the stamp duty value of the immovable property. This will give you FMV2. Higher of two you have to take. Last thing you have net worth. How are we going to calculate the net worth? See, net worth is nothing but whatever the assets you have now. If these are depreciable assets, take WDV. If these are self-generated assets, 3580 assets, take nil. If there are other assets, now take at book value. Take at book value. What did I say? Depreciable asset at WDV, other assets at book value. Okay, this will give you the total assets, reduced liabilities, and this will give you the final book value. Remember, while considering the just write it somewhere, or somebody mention this in comment box. Whenever any net worth is calculated, impact of revaluation is taken off. If any revaluation is done, na, impact of that has to be taken off. Important point. Huh? Any revaluation has to be ignored or adjusted. This will give you the net worth. Whenever a slump sale happens, valuation is done on valuation date. That means date of slump sale. In fact, you have to get a chartered accountant's report for certification of your net worth before the due date of audit. So there are two ways to save the slump sale taxes. Very poor, very petty ways, but yes, we have. We have. I mean, I cannot deny that we don't have. We have ways to save the slump sale taxes. What are these two ways? See, first way is if you are transferring any entity now, instead of transferring to the demerger, this will save the taxes. I mean, this doesn't make any sense. I am feeling humiliated to say that thing, but that is what is being given by institute. If you want to sell any unit, instead of selling, just do the demerger. Second thing, what exempt transfer? If you are transferring your unit to somebody else, instead of transferring that unit, acquire the 100% shares of the transferee, and it will make it 100% wholly on subsidiary. Then you can give your assets to that entity. My God, sorry, yeah, sorry, really sorry for talking about these bad points, but that is how it is. Transfer of capital asset from partnership firm to partner. Sir, you will be teaching this topic in marathon. People don't teach this in their fast track batches. So, are you studying my fast track batch? Are you studying my power batch? You are in my marathon. I will teach. Okay, I will teach. No, of course it is going to be fast, but listen, focus. You will. This is the brushing up of the concept. I am not teaching. I am brushing up the concept. Now, if partnership firm transfers any asset to partner, if it is being transferred at the time of reconstitution, or if it is transferred at the time of dissolution. If it is transferred at the time of dissolution, only section 9B is applicable. If it is transferred at the time of reconstitution, 9B plus 45(4) both are applicable. Both are applicable. Fair enough. What does this mean? Just understand the tone, huh? Just understand the tone. If a partner is retired, or if a partner is, a partner leaves the entity, then what happens is now we give him certain assets. 9B says that instead of giving the assets to the partner, just assume that this is sold to an outsider. Whatever the capital gain that turns out to be, if it is sold to an outsider, then such capital gain shall be taxed under 9B. Sometimes stock in trade is given to the partner. Assume this stock in trade is sold to an outsider. Whatever the PGBP comes to the partnership firm, that shall be paid by the partnership firm only. Did you understand the basic point? Did you understand the basic point? First, 9B says if this asset is sold to an outsider, now then whatever the capital gain turns out to be, that you shall pay. This is the first step. This is 9B, consistent across all the cases, with be it reconstitution, be it a dissolution. Second thing is 45(4). Now, what 45(4) speaks of? 45(4) clearly states that whatever you are paying beyond this capital account, if you are giving any asset to a partner, whatever beyond this capital account you are paying now, that is to be taxed. I will take an example to illustrate what do I actually mean. Mr. Prem is a partner in Exempt company, Mumbai. Exempt company, Mumbai has four partners. Four partners, including Mr. Prem, and their profit and losses are equal. That means 25% is the profit sharing ratio of the Mr. Prem. Prem resigned from Exempt company on 1st April 2025. So he resigned on 1st April 2025. On the said date, capital balance of each of the partners was 32 lakh rupees. Fair enough. In order to settle the dues of Mr. Prem, firm revalues its land for the first time since purchases. The valuer also valued the self-generated goodwill on 70 lakh rupees. Oh ho ho ho. Valuer valued the self-generated goodwill at 70 lakh rupees. Okay. So firm had a land at Pune 25 lakh rupees, revalued at 50 lakh rupees, 25.4 lakh Nagpur land valued at 45. Mumbai land valued at bought at 88 lakh rupees, valued at 250. Self-generated goodwill acquired at 20 and valued at 70 lakh rupees. Fair enough. In April 2025, Exempt company gave Nagpur land and 15 lakh rupees to Prem. So Nagpur land is worth 45. 45 worth lakh has been given, land has been given, plus 15 lakh cash has been given. Is it reconstitution happening? Right answer is yes, reconstitution happening. At the time of reconstitution, I had told you 9B and 45(4) both are applicable. Yes, sir, both are applicable. What 9B says? 9B says if asset is sold to an outsider, whatever the capital gain turns out to be, firm shall pay. So if this land has been given, if this Nagpur land has been given to Mr. Prem, first thing that you shall do is find out if this land was sold to an outsider, then whatever the capital gain was, you shall pay that. 45 lakh is the full value of consideration if you would have sold FMV. Minus cost of acquisition 25.4, that means 19.6 lakh would have been the capital gain. 19.6 lakh would have been the capital gain in the hands of the firm if this was sold to an outsider. On this, 12.5% tax plus 4% education cess would be charged. Then 2,54,800, this is to be paid by the firm if this asset was sold to an outsider. Do the same thing. Do the same thing. 254 under 9B. Yeah. Matching. 9B done. Done with 9B. Done. 9B. This is only 9. Now we have the other things. 45(4). 45(4) goes a step ahead. What does that say? 45(4) says what would have been the capital account of the partner if this land was sold to an outsider. Let this try processing. See, partner's capital was 32 lakh rupees. If this land were sold to an outsider, then 19.6 was the profit, and this was distributed to 4 partners. So how much each share would be 19 lakh 60,000 divided by 4? That means 4.9 lakh would be 4.9 lakh would be the profit. Reducing how much it will be, how much taxes will be reduced? So 254,800 divided by 4. 254,800 divided by 4. That means 63,700 will be the taxes for each partner. That means if this land was sold to an outsider, how much capital gain would be arrived? How much value of the asset would be? How much value of the capital would be? 3626300. This is the how much capital would be of each partner. This is the would be capital of each partner. So if this is the would be capital, how much you have paid to that partner in return? So 45 lakh land plus 15 lakh of cash. Then 60 lakh rupees has been given. How much extra has been given? 23 lakh 73,700. This is extra we are given. 23 lakh 73,700. This is extra we are given, and this will be taxed under 45(4). And this will be taxed in the hands of the firm. You might argue, sir, two times taxation happening, sir, this happening, sir, that happening. Yes, it is happening. Two times taxation happens. Whatever the capital gain is arrived at, this capital gain is attributed to different revalued assets, and this is a benefit given later on. But right now, two times taxation happen. First taxation happens as if this was sold to an outsider. Second time taxation happen assuming that whatever the capital is outstanding now, beyond which whatever you have paid, this is what is being taxed under 45(4). Detailed, if you want more detailed description now, I had taken power batch. In that power batch, first 5 lectures were free on YouTube. On fifth lecture, I guess, or on fourth lecture, in first half only, you will see a 45-minute explanation for this entire topic with example, with exam related question, with detailed understanding as to how things proceed. You can refer that as well. Then we have next topic, that is distribution in case of capital gain. Listen, whenever any whenever any liquidation happens, company does nothing, no taxes payable in the hands of the company, whereas shareholders pay the final taxes. Now, how things happen? Listen. For example, I'm taking an example. This is Rahul Limited, Rahul Private Limited, and share capital is 1 crore, reserves and surplus are 9 crore, and this company has a land of 10 crore. Okay? Company liquidated. Company liquidated. We know this thing that whenever there happens a liquidation, na, whatever the assets are distributed to the extent of accumulated profits are deemed dividend. Accumulated profits are 9 crore rupees. So whatever the assets are distributed up to 9 crore, it would be deemed dividend. Deemed dividend under section 222C. This is the deemed dividend, we are aware. But sir, in case of liquidation, there happens a capital gain, and capital gain, how much? Full value of consideration is the FMV of the asset. FMV of the land is say 100 crore. 100 crore land. Minus cost of acquisition. What will be the cost of acquisition? The amount invested to buy that shares. The amount invested to buy the shares, for example, is 1 crore rupees. So capital gain turns out to be 99 crore. If you carefully see, there is a twice taxation happening. Because 100 crore is taxed under capital gain as well, and out of that 9 crore is taxed under redeemed dividend as well. So lawmaker says reduce the 222C portion from capital gain. Only 90 crore would be taxed. 90 crore would be taxed. What did I say? Sales consideration shall be FMV plus amount received. That will be the capital gain. That will be the full value of consideration for liquidation. Minus any shareholders' interest. That means whatever the 222C is there. And minus cost of acquisition. This will give you the final capital gain. This is liquidation for you all. 50AA. See, 50AA lays down a series of securities, which according to you might be long term, short term, but will always be considered as short term, which will always yield short term capital gain. Always short term securities, always short term capital gain. What are those securities? Let me tell you. First of all is market linked debentures. Now, what is market linked debentures? For example, we have with us Akshay. Akshay says, Akshay gave me money and he wants interest. I said, how much interest you want, Akshay? How much interest you want? Akshay says, sir, any interest would work, but there should be adventure in that interest. Akshay wants adventure in interest. Adventure in interest. I said, okay, Akshay, I will pay you rate of interest 1.2 times the change in Nifty in a year. If Nifty grows by 10%, I will pay you 12%. If Nifty grows by 100%, I will pay you 120%. Whatever changes in Nifty happens now, whatever changes in Nifty happens, I will pay you. This is nothing but a market linked debenture. Market linked debenture, that means rate of interest is dependent upon any underlying asset or underlying securities or underlying index. Then it is called market linked debentures. Done, sir. Then we have another security called specified mutual fund. So specified mutual fund is a mutual fund now, where out of the total proceeds, mutual fund invest only up to 35% in domestic company. Otherwise, it shares of domestic company. Otherwise, it invests in bonds, RDBs, GDRs, whatever it is. Specified mutual fund is a mutual fund in which not more than 35% of the total proceeds are invested in equity shares of domestic company. Remember, specified fund is only specified fund if it is issued after 1st April 2023. If it was acquired or if it was issued before 1st April 2023, then it will not be considered as a specified. At last, unlisted bonds and debentures. Capital gain arising on transfer or redemption of bonds and debentures not listed on recognized stock exchange now are always considered under this section. Not listed on recognized stock exchange are always considered under this section. That means always short-term capital gain. Now, sir, many a times it is asked, if nothing is mentioned, then what do we assume? What do we assume? See, if just bond word is given, do we assume it a listed bond? Do we assume it an unlisted bond? See, we have to take an assumption. If it specifically mentions it is unlisted bond, go for 50 AA. In our taxation, it is mostly asked. If specifically it is mentioned it is unlisted bond, now you shall take 50 AA. If nothing has been mentioned, then you have to take a call. But if date is mentioned now, if date is mentioned, period of holding is mentioned, and no word like listed, unlisted is mentioned now, you have to take a call. Examiner's intention is to find out the period of holding, and if period of holding has been given and it is more than 2 years now, then it is long term only. You don't have to apply 50 AA. So if it is given that it is unlisted, don't take. If it is given that it is listed, don't take. But remember, if it is given the period of holding only. Period of holding will be given to you in every case. It will be given when you bought, when you sold, it is always given. If it is given and if it is long term, always make sure that you apply long term only. Understand and go with the flow of the intention of the question makers. Okay? Intention of the question makers matter the most. Gayatri, good morning, sir. Joined late. Oh, no issue, no issue, no issue. Securities held in demat. See, whenever you have any physical securities now, you know what the cost of liquidation of those shares are. But if you hold in demat, then shares are mixed up. You don't know which asset you are selling, which share you are selling. So in that case, you apply FIFO method for cost of acquisition. Exemptions, I personally don't think exemptions are important, but yes, conditions with respect to exemptions are important. Listen, under 54, if you want to claim any exemption, remember, you can buy even two houses. If you sell house property and buy house property, now, if you buy two houses, two adjacent flats, break the wall in between and make it one. Can you do that? Yes, sir, we can do that. If we have two houses, break the wall in between and get the house one. Make it a one house. Can we get exemption on that? Right answer is yes, you are allowed exemption on that as well. It is considered as one house only. Even if you bought from different buyers, if you bought at different price, if you bought at different dates, if there is different registry, yes, everything would be allowed. Everything would be allowed. What all? So there was an exemption. This was asked in IBS once. See, if you have urban agriculture land and that is sold, so you have an option to buy rural agriculture land, and if you buy, you can buy urban agriculture land. Somebody bought rural agriculture land. Now, this asset is to be held for 3 years. Legally, it is to be held for 3 years. Then only exemption would be given to you. Otherwise, exemption is withdrawn. But sir, what if we sell this rural agriculture land? Will exemption be really withdrawn? Right answer is no. Exemption shall continue because rural agriculture land is not a capital asset. Yeah, I guess that's enough for exemptions. Now we have tax rates. Important, important, important. We have basically three kinds of tax rates here. If you are falling under 112A, what does 112A says? If you have equity shares, if you have equity oriented mutual funds, or if you have units of business trust where STD has been paid In that case, now, whatever long-term capital gain you arrive, it will be taxed at 12.5% over and above 1.425 lakh of gain. What did I say? Equity shares, equity oriented mutual funds, units of business trust, where STT is paid now, then on that, if long term capital gain is arised, in that case, 12.5% will be taxed over 1.25 lakh. So, is this a benefit even? It is not a benefit. To be precise, this is not a benefit. 1.25 lakh you get free of cost. It is nothing for anybody. But the actual benefit is the cost of acquisition. Whenever you have any securities which are falling under 112A, you get a special benefit of cost of acquisition. What is that benefit? Sir, you shall take cost or lower of FMV as on 31st Jan or sales price, whichever is lower. So what did I say? FMV you shall take, sales you shall take, whichever is lower, shall be compared with cost, whichever is higher, and this shall become your cost of acquisition. So this inflated cost of acquisition you get, or some people call it grandfathering, this extra you get, this extra benefit you get. What did I say? FMV or sales, whichever is lower, compared with actual cost, whichever is higher, this will become your cost of acquisition. Now, in this entire process, sales price would be given to you, cost price would be given to you. How do you compute the FMV? That is important. Sir, FMV is of two types. If shares, business trust units, or mutual funds are listed as on 31st Jan 2018, then in that case, you shall take the highest trading price, not the average, not the lowest, just highest trading price. But if some no trading done, then take the highest trading price of the last trading session. Sir, what about if securities are not listed, mutual fund shares, business trust units are not listed, then what do we do? Sir, if units of mutual funds are not listed, in that case, you shall take NAV as on 31st Jan. Every mutual fund has given NAV as on 31st Jan. But sir, if shares or business trust units are not listed, you shall take cost of acquisition, divide by CII of year of acquisition, multiply by CII of 1718, that is 272, and this will give you index cost of acquisition, and this shall become your FMV as on 31st Jan 2018. Perfect, sir. Perfect, sir. Perfect, sir. There is a concept of equity oriented mutual fund. See, if any mutual fund, whatever proceeds it has now, out of that 65% are invested in listed equity shares of domestic company, then it is equity oriented mutual fund. Similarly, there is another mutual fund. For example, mutual fund has 100 rupees. It invested 90 rupees in another mutual fund which invested out of its total proceeds 90% in listed equity shares of domestic company. Then this first mutual fund is also equity oriented mutual fund. Then we have section 111A. What does this say? Again, those three securities, equity shares, equity oriented mutual funds, business trust units, on which STT has been paid. If there is short term capital gain, it shall be taxed at 20%. So if securities are sold, then if these three securities are sold, long term capital gain 12.5% over 1.25 lakh, short term capital gain 20%. Acha. If these securities are sold on recognized stock exchange and IFSC now, even if you don't pay STT, that is allowed. Okay? Now we have other assets. If you sell any other asset, if you sell property, if you sell gold, if you sell debt oriented mutual fund, if you sell any other units, preference shares, bonds, whatever you sell, in that case, if you have short term capital gain, it is taxed at slab rate only. But if you have long term capital gain, then it is taxed at 12.5%. 12.5%. Done, sir, done, sir, done, 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 sir. Coming on to very, 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 very important segment, that is if you are an individual, if you are a resident, individual, or HUF who transfers immovable property and earns capital gain, transfers immovable property, or I should say, on or after 23rd July 2024, plus acquired before 23rd July 2024, and has long-term capital gain. What am I saying? Very carefully listen. Individual HUF transfers immovable property on or after 1st April 2024, sorry, 23rd July 2024, acquired before 23rd July 2024, and has long-term capital gain. Then how his capital gain would be computed? Full value of consideration minus transfer expenses minus cost of acquisition. This will give the capital gain. How his tax would be computed? So tax computation would take place differently. See, capital gain will be computed the way we have already studied. But sir, tax would be computed differently. How tax would be computed? So tax would be computed as 12.5% on capital gain, whatever we have computed above, without indexation, or we have an option of 20% with indexation. Here we have to solve the entire question with indexation for the purpose of capital taxation, and on this taxation we shall calculate 20%. That means 20% with indexation or 12.5% without indexation, whichever is beneficial to us, we shall opt for that. Remember, indexation is still alive only for the tax purposes, not for capital gain computation purposes, not for capital gain computation purposes, not for capital gain computation purposes. Only for tax purposes, indexation is still alive. Fair enough? Fair enough, fair enough, fair enough. Sir, one or two important things I want to discuss with you all. Important things. There was a concept of indexation. I'm briefing this concept out. Did I say till now that indexation will be done for capital gain computation purpose? Right answer is no. For computation purpose, no indexation will be done, but for tax calculation purpose, indexation will be done. 12.5% without indexation and 20% with indexation, whatever is beneficial to you. But sir, there was a concept in old times, in the Adams, it was a concept that if asset was transferred before 23rd July 2024, then asset was indexed. How you used to index? Cost of acquisition was indexed, dividing the CII of year of acquisition, multiplying the CII of year of transfer. Similarly, improvements also we used to index. Sir, what was the index number? So in 2001, 200, 105. For your attempt, is this 376. So we used to index, divide by CII of year of acquisition, multiply by CII of year of transfer. This is how we used to index. But issue here is if asset was acquired before 1st April 2001, then you shall take cost or FMV, whichever is higher. Sir, but people will manipulate the FMV in that case. For immovable properties, the lawmaker says that if SDV is available, then FMV cannot exceed SDV. Fair enough. We got this. If transfer took place before 23rd July, then indexation is to be done. But for our attempt, in our case, for previous at 25-26, transfer would take place only in 25-26. So indexation is not to be done in almost all cases. Almost all cases, no indexation is to be done in your attempt. Again, if this were so easy, then this were not CA finding. What did I say? I'm just summing you up. Just summing you up. Indexation is only done if transfer took place before 23rd July 2024. Except for these four cases, now there is no chance that transfer would be done before. Transfer would always be done after 23rd July only. In your case, every question, no indexation is to be done. Tax computation can be done with whatever the option you have, 12.5%, 20% for that individual HF, you can do that. But normally indexation is to be never done except for these four cases. What are these four cases? Sir, for example, destruction of capital asset. Remember, this is a gray area. Destruction of capital asset. For example, your asset got destroyed in 2020 and you're receiving compensation as of now. If asset was destroyed in 2020, then it transfer took place in 2020 only, then we have to do indexation cost. We have to do indexation. You have to take index cost of acquisition till 2020. That is how indexation is still alive if transfer took place before 23rd July 2024. So how destruction would be treated as? See, full value of consideration shall be taken as whatever the asset you receive or whatever the money you receive. Cost of acquisition or index cost of acquisition up to the date of destruction of the capital asset. Improvement shall be taken. Capital gain will be as per period of holding that we shall take. Second concept, we have conversion of capital asset to stock in trade. See, if we have a capital asset which we have been just keeping for ourselves, suddenly we decide to convert it into capital asset. Suddenly we decided to convert such capital asset into stock in trade. The capital asset was a land. You converted such capital asset into stock in trade. Lawmaker says conversion amounts to transfer, but conversion is not as of now taxable. It is taxable in the year in which such stock in trade is sold. How capital gain would be calculated? See, capital gain, full value of consideration shall be FMV, whatever the FMV is arrived. Cost of acquisition, We shall take cost of acquisition, whatever cost we have. Sir, if transfer took place before 23rd July 2024, we shall index the cost as well. Indexation also we shall do. Indexation on improvement also we shall do. Long-term, short-term period of holding we shall also get. Fair enough. And later on this PGBP we shall calculate the way we have. Full value of consideration minus the FMV, we shall get the PGBP as well. Whenever the proportionate stock is sold, now proportionate capital gain would be taxable. Whatever amount is recorded that is not relevant. Sir, 54 EC, there is an exemption under 54 EC where you buy bonds. In this case, now it is mentioned clearly that from just a transfer, 6 months are not counted. You have to count 6 months from the date of actual sale of stock where you have to buy the bonds. This is the third important case. Second important case actually, where transfer might happen before 23rd July 2024. So you might have to index for capital gain computation as well. Third thing, whenever there is a compulsory acquisition of our property, then two type of compensation we receive. First of all is initial compensation. Initial compensation means as soon as the property is taken off, now whatever the announcement is being done, that is initial compensation. Second thing is enhanced compensation. What is enhanced compensation? If we are not satisfied with initial compensation, we go to court and court awards us some additional compensation, that is enhanced compensation. Initial compensation is taxable in the year in which first installment is received. Full value of consideration shall be entire initial compensation. Cost of acquisition, index cost of acquisition. See, if transfer took place before 23rd July 2024, we might have to index the cost as well. Cost of improvement, indexation shall be done in the year up to the year of acquisition. This will give us the long-term capital gain, short-term capital gain. So this will be taxable in the year in which first installment is received. What about enhanced compensation? It is taxable when received. When received, it will be taxed. Full value of consideration shall be amount received minus litigation expenses, and this will give us the long-term, short-term capital gain. It will have the same nature as if initial compensation has. If initial is long-term, this will be long-term. If initial is short-term, this will be short-term. If enhanced compensation is received due to interim order of the court, enhanced compensation received due to interim order of the court, it is not taxable. It is only taxed in the year in which final order is passed. Whenever you receive any interest on compensation, it is taxable under IFOS and you get 50% deduction of that. Fair enough. Anything extra in this chapter? There is a section called 1037, which says if you have urban agricultural land, you are an individual HF, you use that property for 2 years and you sell it. If it is compulsorily acquired, then whatever the compensation RBI pays, that is exempt. This is an exemption. This might be tested. I don't know why exemptions are being tested a lot in exam. This might be tested. Individual HF having urban agricultural land compulsorily acquired, RBI paying compensation used for 2 years, it is exempt. If it is not mentioned that RBI has paid the compensation, you have to assume that RBI has only paid the compensation. That's it. That is it. That is it, my lords. Done with capital gain. Oh my God, just 1 hour, 8 minutes. And we are done with tax rates. We are done with capital gain. Wow. Come on to next topic, that is income from other sources. Income from other sources. Section 56(1), not relevant. What are incomes taxed under IFOS? Not relevant. Come on to dividend taxation first. How dividend is taxed? See, company has profits. Company pays tax on profits. And after paying taxes, whatever the profits are distributed now, it is dividend. It is again taxed in the hands of the recipients. Okay? So dividend is only post-tax profits. It is distributed to the unit holders and is taxed again. This is dividend. Basic fundamental. This is dividend. Important concept. Dividend are of 3 types. First of all is final dividend, annual dividend that is distributed at the time of AGM. Second is interim dividend, any dividend that is being distributed during the year. Third one is deemed dividend. Sir, instead of dividend, sir, this appears to be dividend. See, as per Companies Act, now to be very precise, Companies Act clearly states that dividend can be in the form of money only. Dividend can be in the form of money only. But what people started doing is people started giving away assets free of cost to the shareholders, calling it not a dividend. Are you understanding? See, dividend as per Companies Act means money distributed is dividend. But what if people start giving up the assets? Then will it be considered as dividend? Right answer is 222A clearly states distribution of the asset by the company to the shareholders to the extent of accumulated profits. If there is accumulated profits, if company distributes any kind of shares to the shareholders now, sorry, if company distributes any type of assets to the shareholders now, it is as good as giving the money. It is as good as giving the money, just that you are giving the shares. So whatever the accumulated profits are there, that shall be considered as deemed a dividend. Second thing, if shareholders are there, okay, you give them free of cost debentures. See, matter is to take out the money outside of the business. So, in order to take out the money, what you did now, whoever were the shareholders, you gave them free of cost debentures. Free of cost debentures to every shareholders. Are Baba, if you are giving free of cost debentures to every shareholders, it is as good as you are increasing your liability for the business. You have to pay them later. You have to pay them, and when you will pay that, it shall be considered as deemed a dividend. Any distribution of debentures, deposits, certificates, debenture stocks, if you give any kind of these things to the shareholders, now it is considered as deemed a dividend only. Third thing, if you distribute any assets to the shareholders at the time of liquidation, it is also deemed a dividend. At the time of liquidation, if you do any distribution, it is also called deemed a dividend. If you do any reduction of share capital, then whatever distribution is being done, that is also deemed a dividend to the extent of accumulated profits. In all the four things now, one thing was common, that is accumulated profits. If you see, one thing was common, that is accumulate profits. So to the extent of accumulate profits, whatever the distribution you do now, that is deemed a dividend. What people started doing, you know what? People started capitalizing these accumulated profits. What does that mean? See, for example, if you have accumulated profits in general reserves, you distributed bonus. So there is no general reserve, but your share capital would increase. So people started capitalizing this accumulated profits. Lawmaker says that if you capitalize now, whether it is capitalized or not, we don't care. Capitalize or not, we don't care. Capitalize or not, we don't care. If you have accumulated profits in the form of general reserves, in the form of bonus, if you have distributed, we don't care. Any distribution shall be deemed a dividend. Any distribution shall be deemed a dividend. Any payment by the company in which public is not substantially interested. See, listen up. If there is a company and which is unlisted company, if this company gives any loan or advance to any of the shareholder who has more than equal to 10% voting power, or there is a another firm, there is another company where such shareholder has substantial interest, 20% or more, or if there is third person which is controlled by this shareholder. If company gives loan advance to any of the three, directly to the shareholder, where shareholder has substantial interest, or to some third person who will in turn forward this money to the shareholder. In all the three cases, whatever the loan is given by the company, whatever the advance is given by the company, to the extent of accumulated profits, it is called a deemed dividend. To the extent of accumulated profits, it is called a deemed dividend. To the extent of accumulated profits, it is called a deemed dividend. Okay. See, for example, if this company has given money to the shareholders, he has more than 10% voting power. So shareholders return the money with higher than market rate of interest. For example, 10 lakh have been given at the rate of 10%. Market rate is just 6%, and we have charged 10%. Shareholders has repaid this money. Lawmaker says we don't care. Even if they have repaid the money, we don't care. It shall be considered as deemed dividend only. Repayment does not saves you from calling it deemed dividend. Wow, sir. Wow, wow, wow. Remember, if loan is given, that is always deemed dividend. But if advance is given to the shareholders now, in the ordinary course of business, that means against that, and shareholders has to provide some services. In commercial advance is given, for example, shareholders is about to buy something, so commercial advance is given. Or, for example, shareholder has given some property to us. Against that, we have given a year rent. He has to give us the services, rental services. That in that case, now we can pay the advances. Loan will always be deemed dividend, but advance might not be deemed dividend in these three cases. Listen up. If there is a company, if there is a finance company in India, and its parent is outside India, but its parent is listed in stock exchange, which is a reputed stock exchange, then any loan advance between the two now shall not be deemed a dividend. This shall not be deemed a dividend. Lawmakers clearly say it is not deemed dividend. Whenever you distribute any asset now, then FMV of the asset shall be considered as deemed dividend. FMV of the asset is deemed dividend. 222F clearly states that if you distribute any money at the time of buyback, then whatever the money received by the at the time of buyback is by the shareholders, it is deemed dividend. We shall discuss this later on as well. Sir, interest taxation as such, it is not relevant, to be honest. Just focus on this thing. If there is interest on FD, if question specifically states that interest is on account of surplus funds, then it shall go to IFOS. If question specifically states that this FD, this security deposit was necessary for the business, then it shall go to PGBP. But if nothing is mentioned, ICI assumes it IFOS, you can take it to IFOS. Also for dividend as well, so dividend is always IFOS for every assessee, every assessee it is IFOS. Every assessee is IFOS only. Come on to taxation of gift. Taxation of gift. Wow, sir. There are some gifts which are exempt, some gifts which are taxable, some gifts which are tax exempt, and some gifts which are taxable. What are those some gifts? First of all, if you receive any gift from a relative, it is exempt. Who is a relative? I shall discuss that. Wait for a minute. Sir, if you receive any gift on account of marriage, your marriage, and not your father's marriage or not your children's marriage, no. If you receive any gift on account of your marriage, okay? If your father receives any gift on your marriage, it is not exempt for him. Any will or inheritance received, any gift on account of will or inheritance, somebody died and we received the property. Any gift received on the death of the donor or the payee, okay? Any gift received from local authority, you receive food, water, anything like that from local authority. Any gift received by any hospital, trust, or any institution. So if hospital, trust, institution receive anything at a lower cost, it is not considered as gift. Similarly, we receive anything from the hospital, trust, or institution, it is also not considered as gift. Last point you can skip out. See, these are exempt gifts. These are exempt gifts. Whatever the gift others are taxable. Now, who is in relative, we need to tell. See, I have drawn a diagram that will help you out. Okay? For an individual, his spouse is relative. For an individual, his spouse is relative. Try drawing it with me. Okay? Try drawing it with me. For an individual, spouse is relative. Their lineal descendant. Lineal descendant bole to son, son's wife, daughter, daughter's husband. Yes. For an individual, his brother, sister are relative, and spouse's brother and sister are also related, plus their respective spouses. For an individual, his mother, father are also relative, and spouse's mother and father are also relative. But mother's brother and sister, father's brothers and sisters are also relative, and their respective spouses are also relative. Plus lineal ascendant of yourself and lineal ascendant of spouse. That means dada, dadi, nana, nani, whatever we have. Mother's mother, father's father, father's mother, mother's father, whatever it is. Can you see a diagram? Can you see a diagram? Sir, can you see a cute mouse here? Can you see a cute mouse here? Always understand that whenever we refer 56 to 10 relative now, always understand this is a mouse I am referring. This is the mouse I am referring. Individual, spouse, lineal descendant, brother, sister, their spouse, spouse's brother, sister, their spouse, mother, father, spouse's mother, father, brother, sister, and their spouses of mother and father, and lineal ascendants of yourself and spouse. These are the relatives. Can you see a cute mouse? Small and cute some mouse. See, this is what I have drawn. I had asked a team to draw a mouse and they drew this. I had asked team to draw the mouse. Said they drew this. This is way more cuter, but this is not what is going to take you in exam. Okay, you have to take this diagram in exam. This is a mouse. Take it. Mouse or some rich people who call hamster, whatever it is. Now, taxability of gifts. See, there are some gifts, if they're exempt, consider it as exempt. If they're exempt, consider it as exempt. What a cute mouse, sir. Oh, thank you. But that is not what is going to remember. I mean, that is not what you are remembering in exam. You have to remember this mouse. Now, taxability of the gift. Understand. I think understand. Taxability of the gift. Listen. You will not believe this, but last time what happened was in Jan 26 attempt now, when there was a bumper result, there were many students, many students who secured exemption, and they were very happy. They just wanted to feed my mouth with sweets because they were very happy with my performance. Like you are happy in the marathon. When there were many students who were happy with my performance and with their performance as well. So they, well, you know what they did? They just Google paid me 500 rupees. Likewise, 200 people Google paid me 500 rupees. 200 people, 200 students, Google paid me 500 rupees so that I can eat sweets. 200 people. Just think of it. I'm not giving you an advice. It is not an advice. I never solicit such thing. Whatever you give, I will take, but I never ask for it. I never ask for it. But people have been doing this. I'm just telling you. They Google paid me 500 rupees. All of a sudden, I received 1 lakh rupees in my account. Lawmaker says that if you receive any money which exceeds 50,000 rupees, that is taxable. If you receive any money exceeding 50,000 rupees, that is fully taxable. Okay? If you receive money more than 50,000 rupees, it is taxable. If you receive any movable property, now what is a movable property? See, movable property implies only 10 things: shares, securities, jewelry. Sir, GPay number link is in the description. Link is in the description. But I never solicit that. Huh? It is up to your wish. See, like we never see when a guy is getting married, okay, he never asks for anything. Okay, he just accepts the gifts that he has. Whatever the girl brings up the gifts with her, na, we accept that. We never ask for anything. That is the thing. See, this is just for fun, huh? Okay, just for joke. I am saying I never solicit any such thing. I never solicit. Okay. Now, point here: movable property. What is a movable property? There are only 10 things that are called movable property. Any kind of shares, securities, jewelry, drawing, painting, sculpture, archaeological collection, any other form of art, bullion, virtual digital asset. These are only considered as movable properties. If you receive these movable property, then only gift taxation would apply. If you receive any other movable property like mobile phone, like car, like wristwatch, like bike, these are not taxable. These are absolutely exempt. If you receive any movable property without any consideration for more than 50,000 rupees in a year, then in that case, entire FMV of those assets would be taxed in your hands. If you receive any movable property at a lower consideration, you received shares at a lower price, you received gold at a lower price. In that case, if difference is more than 50,000 rupees, then difference would be taxable in your hands. If you receive any immovable property, then without consideration, if SDV is more than 50,000 rupees, then entire SDV is taxable. But whereas if you receive immovable property at inadequate consideration, you have to check two things. Whether difference is more than 50,000 rupees plus SDV exceeds 110% of consideration, both the cases, then entire difference is taxable. Entire difference is taxable in your hands. See, for money 50,000 limit, for movable property 50,000 limit, for immovable property 50,000 limit. But there is a small catch. Lawmaker says that money, if you receive money of 15,000, jewelry of 25,000, shares of 20,000 rupees, individually all is within the limit. But if these two things, money plus movable property, aggregate, also you have to check 50,000. Money 50,000, movable property 50,000, money plus movable property also 50,000 rupees you have to check. But for immovable property, you have to check on per property basis. Per property basis, you have to check 50,000 rupees. See, for example, if I receive a gift, for example, if I am doing a business and I received a gift of Thailand trip. Thailand trip is not taxed under IFOS for sure because it is not a movable property. Any Thailand trip is not taxed. But sir, if any of the trip I received on account of business profession, it shall be taxed under PGBP, so it will be taxed. If any gift has been received on account of employee-employee relationship, it is taxed under the head salary. It is taxed under salary. Even at the time of marriage, if you receive na, it is taxed under the head salary. Sir, fair enough, fair enough, fair enough. Immovable property, then what the taxation happens? See, if you are the recipient of immovable property, and you receive immovable property as free of cost or at inadequate consideration. See, if this immovable property is held as capital asset to you now, then difference would be taxed under your hands under IFOS. But if this immovable property is a stock in trade for you now, in that case, there is no treatment that will happen. No treatment that will happen because for if you receive stock and trade free of cost, that's fine now. That's fine because stock and trade free of cost is okay. We our if your business is of gold, you will try to accumulate more and more gold at lower price at free of cost. You will try to accumulate. So if you get any stock and trade at lower price, there is no treatment whatsoever done. One more thing, huh? This gift provisions are only applicable if you hold the asset as capital asset. If I have a if I have a business of gold and I receive gold at lower price, see my business is gold now. My business is to buy things at a lower price, then gift provisions are not applicable. If my business is of immovable property, I received immovable property at a lower price, then gift provisions are not applicable. This gift provisions would only apply if this is a capital asset for me. If it is a capital asset for me. Fair enough, fair enough, fair enough. Now, for the transferor, how things work. If you have a immovable property and you transfer it, if you transfer it free of cost, then section 47, exempt transfer. If you transfer it at inadequate consideration, section 50C, stamp duty value shall become the full value of consideration. That's it. If you have a capital asset, sorry, if you have an immovable property held as stock in trade, then in that case, now 43 CA applies and you will be taken as SDV as full value of consideration. Whether you sell it at free of cost or whether you sell it at inadequate consideration, SDV shall be considered as full value of consideration. Family pension. Family pension. See, whenever there is a government employee, whenever there is a government employee receives a salary during the tenure period. After retirement, after retirement, he receives pension. That is also taxed under salary only. But once the government employee dies, his family receives some pension for at least some time. For some time, family receives the pension. For sometimes they receive it. If they receive any family pension, now this will be taxed in the hands and in the other hands of IFOS. In the hands of legal hire, it will be taxed under IFOS. But this family members now did get a deduction. How much deduction? One third of family pension received or 25,000 rupees per annum, whichever is lower. And if assessee is opting out of default tax regime, going under old regime, then in that case, instead of 25,000, 15,000 would be just given. In this entire process, if somebody is recipient of Paramveer Chakra or Veer Chakra, then it is absolutely exempt. If somebody is in the recipient of, if somebody is into armed forces, paramilitary forces, and family pension is received by the widow of that person or children of any such person, then in that case, it is absolutely exempt. Allowable expenses. Whenever you have IFOS income, remember some expenditures are allowed to you. First of all, any expenditure that is directly attributable to such income that is allowed. For example, for earning rent, you have to pay some commission. For earning rent, you have to do some repair expenditure. For earning rent, you have to do some expenditure that is allowed. That's fair enough. That is allowed. For example, earning interest, you paid interest, that is allowed. For earning any income, you spend some income, that is also allowed. So If directly attributable expenditure is there, that is absolutely out. But remember, no personal expenditure is allowed. Personal expenditure is not allowed. If TDS is to be deducted on such payment and TDS not deducted, then it will not be allowed 30% and 100%. If cash payment done, not allowed. If any casual income is there, for example, lottery and all, then no expenditure is allowed. Okay? So ideally, if directly wholly attributable to such expense, then it is allowed. Otherwise, it is not allowed. Now, point is, sometimes you have income on compensation of compulsory acquisition, interest on compulsory acquisition. Then whatever the interest is there, now 50% of such interest is allowed. At last, sir, to earn any dividend income, if you have paid interest, then you get a deduction. How much deduction you get? Let us understand. Let us assume that you have a dividend income of 6 lakh rupees, and you paid interest of say 1.5 lakh rupees. How much would be allowed to you? See, dividend would go 6 lakh as IFOS minus 20% of dividend, that is 1.2 lakh, or interest paid 1.5 lakh, whichever is lower. 1.2 lakh would be allowed, and 4.8 lakh would be taxed. So 20% of the dividend or interest paid to earn that dividend is allowed on dividend. Otherwise, no expenditure is allowed on dividend income. No expenditure is allowed against dividend income. Only 20% of the dividend or interest amount, whichever is lower, is allowed. Anshul, if payment is made by prospective employers, then it is which employer, which payment is made by Anshul, which payment is made by prospective employers? Huh. It's just 1.5 hours and we have done 3 chapters: PGBP, cap gain, and IFOS. These were the major things that you had to do in the chapter. If you just go through the chapter once now, it will be enough for you. It will be enough because we have covered entire chapter. Of course, some things we have to leave, some things we have to leave things on you. Now, which payment I didn't understand, Anshul? Which payment is made by prospective employers? Clear with PGBP? Clear with these topics? Chalo, chalo. Come on to PGBP. See, payment is made by prospective employers in case of termination of employment. Termination of employment, if your employer pays that, now it will be salary. But if somebody else pays that, it will be IFOS. Profit and gain from business and profession. What does this section says? See, this is a big chapter. Section 28 lays down certain guidelines as to what all incomes would be taxed under PGBP. What all incomes would be taxed under PGBP, that is not much relevant. I don't think that is much relevant from examination point of view. Speculative business is nothing. Speculative business is nothing but a business where you don't take delivery of an asset and you buy and sell. You buy and sell of the securities, you buy and sell commodities without even taking the delivery of that securities or asset. Okay? For example, hedging contract is not speculative. Forward contract, derivative trading is not speculative. These are not speculative. By default, without taking delivery, you are buying and selling, that is speculative. But hedging, forward, derivative trading, or commodity derivative trading, these are not considered as speculative. So rents, rates, repairs, and taxes of building and rents, rates, repairs of taxes of land and machinery is always allowed to you, but capital repairs are not allowed. That's added to cost. That's it. Come on to section number 32. Important topic of the chapter, that is depreciation. Important topic of the chapter. What this topic imply? Whatever depreciation you have computed as per Companies Act, you shall ignore that. You shall ignore that. As per just Income Tax Act, whatever depreciation turns out to be, we will allow that. What is the depreciation allowed as per income tax? How it proceeds? Understand. Income tax says you should own the asset, you should have the asset in the business. You should use that business, you shall have the asset and you should have that asset for business purpose. You shall use it for your business purpose, actively or passively. Second thing, you have to be either owner or you have to be beneficial owner of the asset. If you are the owner, you will get the depreciation. If you are the beneficial owner, if you are the beneficial owner, then you will get the you will get the depreciation as well. Sir, what is meant by beneficial? Sir, for example, I bought the asset and gave it on lease to Anshul. In that case, what will happen? I will be the beneficial owner. I have given this asset to Anshul. Therefore, I am the owner only. I will be claiming the depreciation. What Anshul will be getting? Anshul will be getting lease rentals. He will be getting deduction of rental payment to me. So he will get deduction of rentals. I will get the depreciation. Same happens in case of lease. Lessor has the asset and he gives the asset to lessee. Lessor takes depreciation and lessee takes the lease rental. Perfect. So depreciation is allowed when asset is put to use. When asset is put to use, then depreciation is allowed. But in case of standby equipment, fire extinguisher, machine server, it is not allowed. It is allowed only when ready to use. It is allowed from ready to use. For example, I have pencil, which is a standby equipment. Or if I have fire extinguisher at my home, lawmaker says that on these now depreciation will be allowed from ready to use date. Sir, is it choice to get depreciation or not? Lawmaker says no, it's a mandatory charge. Depreciation is not allowed on land or goodwill. Okay, fair enough. At last, if asset is partly owned, for example, I own an asset in part and my brother owns the part. Provision says whatever the percentage I own, only that percentage of depreciation shall be allowed to me. Fair enough. How depreciation is allowed? See, under income tax, now all the assets are categorized into four classes. Class 1 is building, class 2 is furniture, class 3 is plant and machinery, and class 4 is intangible asset. All the assets are categorized into four classes. All the assets are categorized into four classes. In this categorization, in this entire categorization, every class has subsequent blocks. For example, plant and machinery has 3 blocks, building has 3 blocks, and each block has a rate. Based on these rates, you get the depreciation. So class, then block. On that block, you get depreciation on WDV method. Fair enough. What is the depreciation rate? If you have any building, which is a residential building, you will get 5% depreciation rate. If there is normal building, commercial building, office building, whatever building it is, if nothing is mentioned, building is mentioned, 10% depreciation rate. If you have a temporary structure or wooden structure, then in that case, 40% depreciation is given. Furniture, flat 10% depreciation rate. But sir, sometimes we have electrical fittings like inside furniture only, or inside the walls we have wires, we have switches. These are also considered as furniture only. These are also depreciable at 10% only. If you have lights, these are also part of furniture only. Sir, if you have any plant and machinery are categorized into 3 blocks. First block is 40% plant and machinery. What does this 40% plant and machinery comprise? First of all is aeroplanes and aero engines. If you have aeroplane or aero engine, it is considered as 40% depreciable. If you have computer software including UPS, scanner, printer. Computer software, UPS, scanner and printer. These are depreciable at 40%. Books and annual publication. Then we have pollution control device, renewable device, and medical devices. These 6 things are covered under 40% depreciation. Try reading it after me. Try recalling after me. So aeroplanes, aero engines, computer related softwares, books, pollution control, medical, and renewable device. These are 6 things that are considered as 40% depreciated. Sometimes we have ships, vessels, speedboats, electric boats, then in that case we have 20% depreciation. At last, we have normal motor vehicle. Ideally, the motor vehicle are depreciable at 15%. Oil well, office appliances, mobile phones, EPA, BX, and other plant and machinery are depreciable at 15%. So ideally, what happens? Ideally happens is 40%, 20%, and if nothing is mentioned, then 15% plant and machinery is the ideal case. How depreciation happens in case of motor vehicle? Understand, depreciation happens in case of motor vehicle. Ideally, motor vehicle is depreciated at 15%. But if this motor vehicle was acquired just before COVID, 2020, 31st March, just before COVID, if it was acquired between August to March, it was acquired. In that case, now 30% depreciation applied to this motor vehicle. If you are into renting business of motor vehicle, you buy motor vehicle and rent it out to somebody, or you lease it out, or you run a driving school. In that case, whatever the motor vehicle you have now is depreciable at 30%. But if you had acquired this motor vehicle in this golden period of COVID, just before COVID, you had acquired from August to March 2020, in that case, 45% depreciation is allowed to you. 45% depreciation is allowed to you. Windmill and equipment. If you have any windmill which was acquired before Modi government coming into power, 1st April 2014, if you had any windmill which was acquired before Modi government coming into power, in that case, it is depreciable at 15%. Once Modi government came into power, it became depreciable at 40%. If we have any intangible asset, all the intangible assets are depreciable at 25%, but goodwill is not depreciated. Remember, goodwill is not depreciated. Just can we recall all the rates? Just fast recall of all the rates. See, depreciation is technical and it is always tested. And when it is asked difficult, now you will always doubt yourself that you have not studied anything. You will think that you have not studied anything if depreciation is not strong. Remember, if there is residential building, then 5%. If there is normal building, 10%, wooden structure, 40%. Old depreciation rates. Wait a second, I'll come. Furniture 10%, including electrical appliances, switches, that's enough. Apart from that, apart from that 40% plant and machinery, we have aeroplanes, aero engines, we have books, we have a computer and related applications and computer related devices. We have pollution control device, renewable devices, and we have medical devices. Then we have speed boats 20%, then we have other plant and machinery 15%. Motor vehicle 15, 30 to 30, 45. We are okay. Windmill 15 and 40. Apart from that, intangible assets we have is 25%. Do we need to learn the old depreciation rates, sir? Yes, you need to learn, because depreciation, only one or two old rates we have, and they have been asked in exam. In, I guess, September 25 attempt RTP or exam paper, they asked one same thing, and this was only asked. This motor vehicle was bought and 30% depreciation was applicable on it. It was bought in Jan 2020. It was 1st Feb 2020. It was bought. So you need to remember this rate as well. How do you compute the depreciation? See, whenever you have any asset now, how do you compute depreciation? You shall first take the opening value of the block. If there is no opening value, take 0. You shall add up the actual cost added to the block, actual assets bought during the year. If asset has been put to use for more than or equal to 180 days or more, that means they have been put to use on 3rd October or before, 3rd October or before. That is added separately. If asset has been put to use for less than 180 days, that means they have been put to use on or after 1st October. They have to be added separately. At last, they have not been put to use. Three things: put to use for 180 days or more, put to use for less than 180 days, and not put to use. All the three things separately. Reduce the sales price. Whatever the sales price you are doing now, just reduce that. Insurance cost, reduce that. Reduce the WTV transfer at the time of slump sale. If you are doing slump sale now, whatever the WTV arrives, you shall reduce that. This will give you the WTV available for depreciation. In this WTV now, if asset has not been put to use, no depreciation. If asset has been put to use for less than 180 days, in that case, half rate depreciation of the block shall be given. And if it has been balance asset now, then no depreciation would be given to you. Fair enough. Three important pointers. See, during this entire process, if there is an asset which has been acquired by you, and you have paid some incidental expenses like freight, like telecommunication charges, Will that be added to cost? Right answer is yes, it will be added to cost. Sir, what if we have paid installation charges and not deducted TDS? Not relevant. For adding to cost, TDS deduction is not mandatory. Whenever you sell any assets, the selling of asset will always reduce the sales price from the block. Remember, sometimes they might give you FMV to confuse, they might give stamp duty value to confuse. You have to always reduce the sales price and nothing else from the block. At last, sometimes what happens is you buy asset during previous year and you not put to use. In the current year, if you don't put to use, no depreciation is allowed. But if you put to use that asset in next year, and that too for less than 180 days, then in that case, the full rate depreciation is allowed to you. Now listen, capital gain in case of depreciable asset, how capital gain is computed. Always understand, either number of assets become negative or zero, or if block becomes zero, either of the things shall become zero. Let me tell you how things go. For example, I have number of assets 2 as opening. I have 2 assets. I bought 3 more assets of 2 lakh rupees. So I have 5 assets of 3 lakh each. 5 assets of 3 lakh each. I have this much. Okay. Sir, if the asset has been donated for free of cost, whether WDV of the asset will be deducted from the block? No, zero will be deducted. So the zero will be deducted. If asset has been donated, then zero WDV will be deducted. Now, 5 assets of 3 lakh rupees. All of the 5 sold. That means we have no assets with us, and all of the assets are sold at 4 lakh rupees. Wow. 3 lakh worth has been sold for 4 lakh. Wow. 3 lakh worth has been sold for 4 lakh rupees. Wow. Yay. 1 lakh rupees of profit, and this will be short term capital gain. Now, similarly, you have 2 assets. Bought 3 assets, now 5 assets. 5 assets are now worth, how much is the cost? 2 lakh plus 1 lakh, that is 3 lakh. Done. All the 5 assets sold at 1 lakh rupees. You know what in Sindhi we call it thukkatai. We call it thukkatai. I mean, at two, how, what kind of businessman that is? 5 assets of 3 lakh rupees have been sold for 1 lakh rupees. This is a loss to us. So this is a short-term capital loss. For example, we have 2 assets. We bought 3 assets of 3 lakh. Total, we have 5 assets of 3 lakh each. Out of that, only 2 assets we are selling. That means 3 assets we still have. 3 assets we still have, and we don't have any WDV. We sold, we have 3 lakh of WDV and we sold them for 5 lakh rupees. So our WDV is exhausted. If WDV is exhausted, now lawmaker says whatever the extra value you have sold for, it is short-term capital gain, and remaining 3 assets are useless now. But sir, if you have 2 assets and you bought 3, that means you have 5 assets and WDV is 3 lakh rupees. If you sold 2 of them for 2 lakh rupees, then you have 3 assets. You have 1 lakh rupees of WDV remaining. They shall continue to be depreciated. They shall be continue to be depreciated. Depreciation shall continue. So if block becomes 0, or if assets become 0, then there will be capital gain. Sir, why capital gain? See, logic is very simple. Very simple logic. What logic, sir? See, first of all, it is a capital asset which is being transferred, so capital gain should apply. And since depreciation gives you a benefit of 30% reduction in tax rate, therefore taxes should be taxable. Sorry, I mean this profit should be taxed at slab rate only now, 25%, 30%. So which capital gain is taxed at 30%? It is short-term capital gain only. That is why we take short-term capital gain. Very important, sir. If you don't have this skull in your book, do draw a skull in your book. This skull is very dangerous, very frightening, very angry skull it is. What the purpose of this skull is? See, whenever you have additional depreciation now, it is greater possibility that you will forget that you have additional depreciation. There is a greater possibility that you might forget that you have additional depreciation in your question. So in that case, now this skull will remember. This skull will make you. This skull will remind you. If you are into manufacturing, production of any article, or if you are into printing, if you are into power generation, distribution, and transmission, in that case, you are entitled for additional depreciation. Sir, additional depreciation will be given on plant and machinery. only plant and machinery, and that to 20% of the plant and machinery that you acquire new. No second hand plant and machinery is allowed, only new plant and machinery is allowed, only new plant and machinery is allowed, no second hand plant and machinery is allowed. Apart from that, no new plant and no second hand plant and machinery is allowed. Apart from that, additional depreciation is given only on cost of the asset, nothing else. Only cost of the asset is there, and how much you will get if put to use for more than 180 days or 180 days. In that case, 20% additional depreciation is given. If less than 180 days, then 10% in current year and 10% in next year. Plant and machinery should be installed in factory premises, not in residential accommodation. Assessee should not claim 100% deduction on those assets if these are not assets that have been acquired in scientific research business. Similarly, it is not available on ships, aircrafts, transportations. But yes, if you have trucks, lorries in your factory, then such additional depreciation would be given on trucks, lorries in factories. This was additional depreciation important. Actual cost of asset. At what price you are going to get the depreciation? What is the value on which you are going to get the depreciation? It is important. What is the value on which you will be getting the depreciation? That is the cost of asset. What will be added to block? Example, whatever purchase price you pay to the vendor, that is added to cost. If you pay any installation charges, added to cost. If you pay any taxes on which ITC is not available, added to cost. If you do trial run, whatever the trial run expenses are there, you shall add to cost. If there is any product sale in trial run, just reduce that. Reduce any subsidy grant given from the central government or state government or any of the government. If any subsidy is being given, then it will be reduced from cost. This will be giving you the cost of asset. On this, you will be getting the depreciation. This is the amount on which you will be getting the depreciation. During this entire process, remember, any payment that is made to a single person in a single day should be done via account, paycheck, demand draft, electronic clearing system. Any payment done in cash, cross check, bearer check, uncrossed check will not be allowed as cost of asset. But whether TDS not deducted, will it be added? For example, we pay installation charges, but TDS not deducted. It will be added. Even to non-resident also, if we did not deduct TDS, it will be added to cost. Some special cases, see, some normally in a price paid to vendor is added to cost, but there are some special cases as well. What are those special cases? Let me brief them out to you. If asset was used for scientific research bought into regular business, see, if you have two businesses, assessee has two business. Business one, which is scientific research, and business two, it is normal business. You bought an asset for scientific research and claimed 100% deduction, and now you transferred this asset to business number two. Will you get any depreciation? Lawmaker says no. Lawmaker says no, no depreciation is given to you. Block is nil. Stock in trade is converted into asset for business and profession. What does this mean? Listen, I am a realtor, okay, a real estate developer. This is a big building made by me. But when I am selling the flats now, I have a umbrella outside my building. I sit in front in the sunlight and sell this building. Lalo, 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 building, lalo. I mean, I do this thing. It makes me feel sad. I thought if I am selling dream houses to everybody, shouldn't I have a good office of my own? So I decided to make this top-notch corner flat as my office. It is sea-facing flat, and I made it as my office. I made it as my office. Lawmaker says earlier this was capital asset, no? Sorry, earlier this was stock in trade, no? Because ultimately this was held for sale, but now you convert into capital asset. So, and that to depreciable capital asset, lawmaker says on the conversion date, FMV is important, and this FMV shall be used for, first of all, PGBP purposes, and this FMV shall be added as it is added to WDV for costing purposes, for depreciation purposes. WDV shall be added for depreciation purposes. Sir, for example, I receive any gift from inheritance, like in the morning only. In this early morning, I'm shouting like anything. In the morning, I'm overacting. In the morning, I am making these expressions which might spoil your day. My parents are my parents were sitting beside me. They were looking at me and they were very sad about me. They said, Rahul, everything apart, but we cannot see your expressions. She, I mean, they simply said, she, you will not believe this. I know, no, you will not believe this. He said, she, get lost from our house, and from today onwards, you will not take classes in this house. He said, you will not take classes. You will not take classes from this house. I was very sad. What do I do of the students? They are waiting for me. What do I do? He gave me a keys to the new house and said, Rahul, take this house. This is your house now. Take classes at this place. Make ground floor as your area of work and first floor as your office for classes or for a studio for classes. Wow. Lawmaker says earlier this is an asset acquired out of gift. My father had this asset. Now I got this asset for my business purpose. So I should be eligible for depreciation on this. Now on what value I will be getting? Lawmaker says the original cost to the previous owner. At whatever price my father this bought the house now, that same price I will be using for depreciation purpose. But if my father has claimed any depreciation, then his WDV shall be my cost of acquisition for the purpose of depreciation. Oh my God, sir. Oh my God. See, if there is an asset which can be acquired for 10 lakh rupees, but you forcefully acquire it for 70 lakh rupees to claim higher depreciation. Lawmaker says this will not be allowed. Only amount equaling to FMV approved by Joint Commissioner will be allowed, so that you are not, I mean, you don't claim depreciation on a higher price. Fair enough. Reacquisition of a sold asset. For example, I had asset WDV. WDV was 50 lakh rupees. I sold it for 50 lakh rupees and I reacquired that for 1 crore rupees. My understanding. I had an asset of 50 lakh rupees. I sold it 50 lakh rupees and I reacquired it at 101 crore rupees. That means, can I simply say that I reacquired to claim higher depreciation? I reacquired to claim higher depreciation. Right answer is yes, sir. Fair enough. You have reacquired to claim higher depreciation only. In that case, what happens? Sir, you will be given depreciation at lower of 2. WDV at the time of sale, which was 50 lakh rupees, or reacquisition cost, that is 1 crore rupees, whichever is lower, you will be given depreciation on 50 lakh only. Wow, sir, wow, what a logical thing. See, asset purchase and lease back to the same person. See, for example, Satish has an asset. I purchased the asset from Satish for 1 crore rupees and lease back to him. Ultimately, do I have an asset? Right answer is I don't have an asset. But sir, I am the beneficial owner of the asset and I will be getting the depreciation. On what value I will be getting? The WDV of the Satish. Whatever the WDV Satish has, on that WDV I will be claiming the depreciation. What Satish will claim? He will claim lease rental. Important point, sir. Very important point. Important. For example, this is Rahul. I have building used for personal purpose. I have computer used for personal purpose. I brought this building to business. I bought this computer to business as well. I brought this building from which was used for personal purpose to build to this business purpose. I had computer which was used for personal purpose. Now it is brought to business purpose. Sir, at what value I am going to claim the depreciation? See, if building has been taken from personal purpose to business purpose now, then original cost minus notional depreciation. If this was acquired 5 years back, then take original cost, reduce the depreciation on monthly basis, yearly basis. Whatever the current year depreciation is, you shall reduce that depreciation. And whatever the WDV turns out to be now, that WDV shall be added to my block, and on that I can claim depreciation. Fair enough. But what about other assets? Computer, if I have mobile phone, if I have bike, any such asset has been introduced to business, then we shall take it at original cost only. We shall take it at original cost only, original cost only. Wow, sir. These three things hold for a minute. See, if asset has been acquired out of borrowed fund, what do you do? See, if loan has been taken to buy any asset, then till the date asset is put to use, we capitalize that asset. We capitalize that loan. Okay? Capitalize that interest. Then 3580 again hold for some time. Customs and GST. See, if ITC is not available any asset, then in that case, what do we do? If ITC is not available now, then we have to add it to cost. If available, then we don't have to. Custom, sorry, grant and subsidy. If we have any grant subsidy with respect to asset, reduce from cost. Fair enough. Some other assets, some other pointers, what these pointers says. If you have any asset, if you have any asset, which is partly used for business purpose, partly used for personal purpose, then whatever the percentage that is used for business purpose only, that is the percentage you are going to get for the for the depreciation. For example, if there is a car which is 60% used for personal purpose, 40% for business purpose, so entire depreciation of 1 lakh will be divided into 40/60, and only 40% you will get for business purpose. Second point, cut this. Third point, if asset has been acquired in foreign currency, for example, listen. Sometimes I buy assets on 1st April. First, sorry, Jan 2026. Rate was 10,000 rupees, $10,000, and on that day, dollar exchange rate was 90. But something changed. Time passed, and when I went for payment on 31st March 2026, within 3 months, $10,000 turned to 95 rupees. That means 9,50,000 is to be payable now. Earlier, I had booked asset at 9 lakh rupees, but now 9.5 lakh are payable. Are you getting the issue? Are you getting the issue? Are you getting the issue? Prince says, is there any revision video for AOP, BOI? I have taken marathon only. Marathon, everything is covered. 10AA also, AOP also, firm also, BOI also. Okay. In marathon, we have covered this. You can refer that as well. Listen carefully, carefully, carefully listen. Carefully, carefully, carefully listen. We acquired asset on credit on which we booked the asset for 9 lakh rupees. Now, when we went for payment, we have to pay 9,50,000. So we have to pay extra money. We have to pay extra money. This extra money is whenever is paid now. Will this be transferred to P&L? Right answer is no. It will not be transferred to P&L. It will be added to cost. Any loss in on foreign exchange on account of asset is always adjusted from asset only. It is always adjusted from asset only. If there is profit, then it will be reduced from profit only. Depreciation in case of amalgamation conversion, we shall do after a small break. I think it's the right time to take a break. We have a lot to discuss, but time to time breaks are also important. Otherwise, I will be exhausted, you will be exhausted. We shall be continuing further. It is 12:05. Asset acquired out of gift is IFOS. If you receive asset because of business for the business purpose now, then it is PGBP. Business relation now, if it is for the business purpose asset now, then it is PGBP. See, the asset that you received is taxable under IFOS. If you receive for free of cost, is taxable under IFOS. But that personal asset you are bringing to business, so you will get depreciation also on that. So that will be. It is 12:05 to 12:25. Welcome back from break. Welcome back from break. Are you all back from break? Are you all back from break? Perfect. Okay. So before going to break, we started off with depreciation. We had to continue. We have to continue with depreciation only. See, depreciation in case of amalgamation, succession, demerger, and conversion. How depreciation is calculated? Understand, na? Whenever we have any asset, take it, and our entity is amalgamated with another entity, it is demerged into some other entity, or there is succession happening, there is conversion happening, any such thing happen. Okay? In that case, how things proceed? Understand. First of all, you have to assume that no demerger has taken place, no succession, no amalgamation has taken place. Assume that thing. Assume as if nothing has happened. If you assume nothing has happened, now what will happen? You will get depreciation for entire year, and this depreciation for entire year shall be apportioned to both the entities based on number of days asset is used. Every depreciation in every block is to be divided based on number of days this asset is used by old entity, this asset is used by new entity. Based on number of days, you have to reapportion this depreciation. Fair enough, sir. Fair enough. We got this point. Based on number of days, we have to apportion this. Example. For example, there is a plant and machinery which had a opening on 2025 as 10 lakh rupees, and it was depreciated at 15%. So depreciation for the entire year is 1 lakh 50,000. Now this depreciation is to be distributed into two parts. Okay? This depreciation is to be distributed into two parts. For example, on first October, company amalgamated with some other company. So whatever the number of days were this asset was used by old entity, that number of days depreciation will be taken by old entity. Whatever the days the asset has been used by the new entity, depreciation will be taken by the new entity. Closing WDV after charging depreciation shall become opening WDV of the new entity, and new entity is going to claim the depreciation. That is what we have studied here as well. If there is a transfer in case of amalgamation, what will be the WDV for new entity? Closing of old. Same to same thing that we have studied is covered here as well. Depreciation in case of power generating business. Acha, is there any lag between the class? I mean, anybody feeling lag? Anybody feeling lag in class? Any issue while watching the classes? Is it lagging? Kya? Kindly confirm me now, please. There is no speed issue as well. Anybody experiencing lag in the class? Am I not able to get your response? Are you all experiencing lag in the video? See, whatever is appearing in the screen, na, this I had spoke and a minute ago. Oh dear God. Hello. Now things seem fair to me. Now just confirm me with the audio video. Now are we going proper or not? Now things seems fair. Okay. Really sorry for the loss, but you know what? I am just. I mean, absolute illiterate about the technology. So sometimes it happens that technologically I might suffer during the process. Okay. Moving further, what we were discussing here, we were discussing depreciation in case of power generating business. See, whenever there is a power generating business now, we have an option. SSC has an option to either go for WDV method. If he goes for WDV method now, then whatever the method we have discussed is going to be followed. Block, rates, sale, we shall discuss, we have discussed already discussed. But if SSC follows SLM method, straight line method, then every asset will be accounted differently. Every asset's useful life will be calculated. Scrap value will be calculated. Based on that, depreciation will be calculated every asset wise. In if SSC is into power generating business, then additional depreciation will not be given to. And at last, when there is sale of such asset, now sale shall be accounted differently. How sale shall be accounted? Carefully listen. If asset is acquired for cost of acquisition is 1,000, WDV of that asset is 900, and in between you sell this asset for 700 rupees. Whatever the loss on account of sale is now, this loss shall be allowed under PGBP head. This loss is allowed under PGBP head. If you sell it any price above the cost, sorry, above the WDV but below cost, for example, you sold at 950. You sold at 950. Whatever the profit you make now over and above WDV up to cost, this profit shall be profit of 50 rupees shall be nothing, but this profit shall be PGBP. Whatever the profit you make over and above the cost, sir, whatever profit you make over and above the cost, this will go to short-term capital gains. Sir, for example, if you sold at 1200 rupees, so whatever 1200 minus 1000 is, this will go to short-term capital gain, and up to cost, whatever the profit is, this will go to PGBP. Fair and simple. So WDV below whatever you are selling, that is short-term capital gain. Above WDV, whatever you are selling, that is also short-term. That is all. Below WDV, whatever you are selling, that is PGBP. Above WDV, whatever you are selling, that is also PGBP up to cost. If you are selling over and above cost, then whatever profit you are earning over and above cost, that will be short-term capital gain. At last, we have unabsorbed depreciation. What does unabsorbed depreciation speak out? See, sometimes your profit is not sufficient to absorb your depreciation. So whatever depreciation is not absorbed, it is called unabsorbed depreciation. It can be carried forward for indefinite period. It can be set off against any head of income in future, except for salary. Even it can be set off against the business which it not relates to. For example, I have shoe business, I have apparel business, I have unabsorbed depreciation of garment business, and I can set off this unabsorbed depreciation on shoe business as well. At last, sir, what will be the sequence? Always current year depreciation to be reduced first, then brought forward losses, and at last unabsorbed depreciation. That completes our depreciation concept. Come on to next topic, that is 33 AB and ABA. Long breath, relax. Long breath, relax. 33 AB ABA. In the morning, we have discussed this point. See, if you are into manufacturing of tea, coffee, rubber in India, in that case, you get a deduction if you deposit some money to NABARD. How much deduction you get? Sir, you get deduction of amount deposited or 40% of the PGBP, whichever is lower, you get deduction. Amount deposited or 40% of the PGBP, whichever is lower, you get as deduction. In this entire process, now till when you have to deposit this money. You have to deposit this money up to the due date of ROI or within 6 months from the end of the previous year, that means up to 30th September. Earlier of two, you have to deposit this money. Whenever you deposit any money to NABARD, you shall use this money for the purpose prescribed by Tea Coffee Rubber Board of India. Whatever the purpose Tea Coffee Rubber Board of India prescribed, with that purpose you are going to use that asset. Similar section 33 ABA. 33 ABA, what this talks about, if you are into petroleum and natural gas extraction business, then you have to deposit some money to site restoration account at SBI. How much deduction you are going to get? You are going to get deduction of actual cost or 20% of PGBP, whichever is lower. Actual cost or 20% of the PGBP, whichever is lower. In this entire process, you have to use this money kept at site restoration account for the purpose prescribed by Petroleum and Natural Gas Ministry. In this case, you have to deposit money up to the end of the previous year. So two sections, 33 AB and ABA. Here we have tea coffee rubber business. Here we have petroleum natural gas. Here you have to deposit money at NABARD. Here you have to deposit money at site restoration account. Here up to 6 months of from the ROI. Or here we have up to end of the previous year. Here 40% reduction, here 20% reduction. Here you have to use as per Tea Coffee Rubber Board of India. Here you have to use as per Petroleum and Natural Gas Ministry. Kumar, asset acquisition on gift FMV is IFOS. Actual cost less depreciation treat and claim depreciation. Actual asset and less claim depreciation. No, if building is, then we can claim depreciation, but if it is not building, we don't have to claim depreciation, and we original cost can be added to block. Common pointers for both 33 AB ABA. Common pointers for both 33 AB ABA. What this common pointer says. First of all, sir, three violations are taxed. Yesterday in tax audit, we discussed these violations. First of all, whenever you deposit some money to NABARD and you withdraw that money for utilization purpose, lawmaker says use that money within previous year only. If you withdraw in a specific previous year, use that money in that specific previous year only. If you use it in some other year, it will become taxable. Money withdrawn and not used is taxable. Second thing, if money withdrawn is misutilized, then it is taxable. If money withdrawn and used for an asset, lawmaker says that if asset is sold within 8 years, it is also misutilized. In these three cases, these incomes shall become taxable. What is meant by misutilized? Lawmaker says if you have bought any machinery which is for office premises, residential accommodation, if you have bought any office appliances, not allowed. If you buy any plant and machinery on which 100% deduction has already been claimed, you cannot buy those assets. Remember, any kind of computer is allowed. What if our computer is allowed? Okay? See, what if we don't withdraw? Don't withdraw, no issue. There is no issue as to if you don't withdraw. Ultimately, what will happen to this money? You have to use it. That's it. See, it's like keeping deposit somewhere. Some or the other way, you have to use it now. If you don't withdraw, it will not be taxable. But once in a lifetime, this will continue withdrawing. It's like keeping a savings. Savings is for purpose now. If that purpose is required, this purpose is, upon you, you have to use that savings. That's like that only. Sale of the asset within 8 years, it is taxable in your hands. Now, remember, if amount has been utilized for a revenue expenditure, if you this is your personal thought. This is your personal thought. Yeah, for business, you don't invest. See, understand you are studying marathon first of all. Your intention should be from examination point of view. Okay? These ifs and buts you are allowed to ask in regular batches, exam oriented batches, power batches, you are allowed to ask. But in marathon, yeah, these doubts should not come. Your ability to process things should be fast. Otherwise, you will not be able to cover up syllabus a day before exam. Okay? So doubts are okay. But doubts which should not be a pile, that is not okay. Up to the relevant portion, if you don't understand, that doubt is okay. But if you will start digging these type of doubts, now believe me, a day before exam, you will not be able to end up the syllabus. I don't have any issue. I will clear every doubt. But at a day before exam, you might not be able to end up the syllabus. Now, what do I mean? See, if you withdraw any money from NABARD or site restoration account, you have to make sure if you do revenue expenditure, now the deduction on revenue expenditure is not allowed. Second thing, if you do capital expenditure now, capital expenditure will be allowed. Why capital expenditure will be allowed, sir? Capital expenditure, it's okay to do that, but depreciation on those capital assets will not be allowed to you. How calculation is done? See, we shall take net profit before 33 ABABA, before 33 ABABA. We shall reduce 33 ABABA. We have to add three things. First of all, amount misutilized, amount not utilized, amount of asset sold within 8 years. This is what will be taxable. Sir, whenever we have any asset which is acquired out of this NABARD money, and you sell that asset now, lawmaker says the deduction claimed earlier shall be taxable. Whatever deduction you have claimed earlier, that shall become taxable. See, the profit before 33 ABABA, deduction under 33 ABABA, misutilized amount, assets sold, amount withdrawn, not utilized. This is income before division. From this, you have to split into two parts, PGBP and agriculture income. PGBP income will be Whatever income it turns out to be from that brought forward losses, and this will give you the final income. What is the split? To see, if you are into tea business, 40% is business, 60% is agriculture. If you are into coffee, growing and curing, then 40% is the business, 75% is the agriculture business. If you are into coffee, growing, curing, roasting, and grounding, then 40-60 is the ratio, and rubber 35-65 is the ratio. Higher percentage is always understand the agriculture. Higher exemption limit, higher percentage is always agriculture. Always consider the higher one as agriculture ones. Sir, what if you withdraw on account of closure of business, on account of dissolution of the firm? Now, it will be taxable in the year of withdrawal. If you close the business or if there is dissolution of the firm, these are voluntary things. In that case, it is taxable in the year of withdrawal. But sir, if there is liquidation of the company, death of the assessee, partition of HO, these are natural acts. Therefore, these are not taxable. Whenever you want to claim 33 AB, you have to get a chartered accountant report in 3 AC and 3 AD before the due date of ROI. Sorry, before the due date of audit. Section 35 talks about two things. You are into scientific research or you donate somebody who is into scientific research. Two things are covered here. You are yourself into scientific research or you donate somebody who is into scientific research are covered here. If you do in-house scientific research, check out whether you have commenced your business or not. If your business is commenced now, any revenue expenditure 100% allowed. Any capital expenditure 100% allowed, but not on land. Any capital expenditure is allowed, but not on land. 100% is allowed. If you have not commenced the business, then what will happen? Lawmaker says find out the date you will commence the business. In that date, preceding 3 previous years. Preceding 3 previous years, whatever the revenue expenditure you have done for salary and for material. For salary and material, whatever the revenue expenditure you have done, that shall be allowed. That shall be allowed. Whatever the capital expenditure you have done in a 3 years, that shall also be allowed, but land shall not be allowed. Basic fundamental it is. This is about the person who does scientific research. This is also allowed in old regime as well. This is also allowed in new regime as well. But sir, if you donate to anybody, if you donate to any company involved in research and development, if you donate to any company who is into IIT or IIS, if you have donated to any approved college, university, research association, institutes for social and statistical research, then 100% disallowed. 100% absolutely disallowed. 100% absolute disallowed. Sorry, 100%. What I am saying is, after the breakfast, na, I mean, my mind has gone sleepy. 100% allowed. 100% allowed. Okay? So this allowance of 100% is not allowed under new tax regime. Remember. Small pointers. Small pointers. Whenever you are into scientific research business and you buy any asset, you are given 100% deduction of them. Right answer is yes, sir. We are given 100%. But sir, if depreciation, can we claim depreciation? Right answer is no, we cannot claim depreciation. Sometimes we buy land or building at a composite price. For example, 10 crore for both land or building. In that case, for land, we are not given any deduction. So lawmaker says in that case that you have to do bifurcation based on FMV. On land, you will not get any deduction. On building, you will get the deduction. Then nature of unabsorbed expenditure. For example, you have a lot of capital expenditure done, because of which you have a lot of unabsorbed expenditure. In that case, what will happen? This will be carried forward as if it was an unabsorbed depreciation only. Sir, for example, if any scientific research organization has bought an asset and it sold the asset, then in that case, what happens? Sales amount or deduction claimed earlier, whichever is lower, is taxable under the head PGBP. Fair enough. Sir, what about we donated money? I had money. I had donated 1 crore rupees to IIT Dholakpur. I donated 1 crore rupees to IIT Dholakpur. In that case, what if, sir, tomorrow's the status of IIT Dholakpur is revoked? In that case, will I get deduction? Lawmaker says, of course, you will get deduction. You will get deduction. You will continue getting the deduction. Only thing matters the most is the day on which you are donating. At that point of time, the company, the entity was approved. How you get the donation? See, once we donated to IIT Dholakpur shall file Form 10 BD up to 31st May of the assessment year. This 10BD declares the information of the payer, PAN number, address, and amount of donation. And once this 10BD is deposited, small 10BEs are generated. 10B, small 10B are generated. Based on that, now this 10B are nothing but certificate of donation. These are forwarded to different donors. 33 AB, I don't think that is relevant. Telecom license, telecom spectrum. It is only allowed on the useful life of the license. On license spectrum, now you don't get any deduction as such of 25%. You only get deduction on the useful life basis. If life spectrum is for 25 years, you get deduction for 25 years, not 25%. Section 35 AD is specified business. What does this specified business imply? Carefully listen. There are 14 businesses specified by the government where any capital expenditure you do now, it is allowed as deduction. 100% is allowed in first year only. Not on land, not on goodwill, not on financial instruments, any other capital expenditure you do now, you will get 100% reduction in first year. What are those businesses? See, there are 14 businesses. Out of them, 10 are good and 4 are 10 are good and 4 are what does that means? Bekar, bad. What are 10 good businesses? See, if you are into cold chain facility, okay, cold storage facility, that is good. If you are into warehousing of agriculture produce, for example, you grow potato and you get that warehousing done. Edible oil is not agriculture produce. I don't know why, but examiner is now very much obsessed with agriculture produce. Sorry, edible oil. They are obsessed with edible oil. Make sure that edible oil is not agriculture produce. If a company is laying cross-country pipeline for transportation of petroleum, for example, India to Dubai, a cross-country pipeline is set up. Does that qualify? Yes, it qualifies. If we have 2-star or bigger hotel, if we have 100 plus patient beds hospital, if we are working for slum redevelopment and affordable housing scheme, if we are into production of fertilizers, if we are warehousing sugar, if we are doing inland container depot, if we are doing development of infrastructure facility, new infra facility, or sir, if we are into beekeeping or production of honey wax, these are 11 businesses which are easy peasy. What are the difficult businesses? See this inland container depot. Inland container depot. Slurry pipeline for transportation of iron ore. That means if iron ore is to be transferred, liquid iron is transferred from one place to other place. We are laying down the pipeline for that iron ore. And semiconductor wafer fabrication manufacturing unit. This is set up. These are 3 bad businesses. 11 are easy peasy, 3 are difficult businesses. That's enough. Whenever you do such business, a lawmaker says whatever the plant and machinery you buy now, that should be new. Imported plant and machinery are considered as new only, even if they are second hand. 20% of the total plant and machinery can be second hand. That is allowed. Fair enough. Whenever you do 3580 business, such business should not be split off or reconstruction of existing business. For example, you were LLP once and now you converted yourself into company, not allowed deduction. Once you claim 3580, you do not get depreciation. Okay, sir. Okay. If you make any payment to a single person in a single day more than 10,000 rupees in cash, then such expenditure is not allowed as deduction. Whenever you want to claim 3580, then profits and losses of such business are calculated separately. Whatever the losses are there now, these losses can be carried forward indefinitely, and these losses can be set off against only the specified businesses. At last, sir, if you have any asset which is being sold, if you claim deduction on the asset and you sold that, then entire sales price shall become PGBP. Wait a second, just a second. For example, this is Rahul. I have 2 hotels. First one is Hotel Raj Mahal. It was incorporated in 1990 and it is a 4-star hotel. I had a loss of, sorry, not a loss, but profit of 3 crore. I have a hotel called Sri Maya. It is a three-star hotel incorporated in 2023. It has a loss of 1 crore. Can I set off this loss from this profit? Can I set off loss from Sri Maya three-star hotel with Raj Mahal, a four-star hotel, but Raj Mahal was incorporated in 1990s? Can we set it off? Right answer is yes, sir, we can set off. Both of them are specified, even though one of them is not eligible for deduction, but both of them are specified, therefore we can set off the losses. We can simply set off the losses. Both of them have to be specified. Either of them may get deduction, may not get deduction, that is a different matter, but specified should be the condition. See, whenever you lay cross-country pipeline for transportation of petroleum and natural gas, see, one third of the pipeline should be given to the other people as well. And such projects shall be done by the Indian company only with approval of the Petroleum and Natural Gas Board. If you do two-star or bigger hotel, in that case, what happens now? Sometimes hotel companies outsource their operations to somebody else. In that case, even if you outsource your operations, that is assumed that you are only doing the business. New infra facility. See, this should be done by Indian company with the government approval. That's it. Sir, what is new infra facility? You are making a road, toll road, bridge, rail system, highway project, housing project, related activities, water supply, water irrigation, sanitation, sewage, solid waste management, port, airport, inland waterways. That means big infra project. Big infra project are nothing but new infra facilities. This is what you have to do. Most important discussion of all. Most important discussion. Most important. You claimed 3580. You claimed a deduction on some assets and you sold those assets. If you sold those assets, what is the treatment done? If we sell any asset now, sales price is PGBP, flat sales price is PGBP, no questions attached. Sir, but what if it is destroyed? Then whatever insurance money is received, that is PGBP. Sir, what if we don't sell it, but we transfer it to somebody else? See, to whom you are transferring? To your specified business only you are transferring, to any specified business you are transferring. In that case, no treatment. No treatment in your hands. If specified business is there and we are transferring it to some other other specified business now, ours only, then it's allowed. That's fair. No treatment. But sir, what if asset is transferred to a non-specified business? For example, I was offering a hotel. I was working as a hotel in 2023. First April 2023, I acquired beds. 1 crore beds I acquired. On 1st May 2025, I decided that I want to make uh, a furniture shop as well, for which I took off the beds from hotel and displayed it in my furniture shop. So hotel business is a specified business, but furniture business is non-specified. How do we proceed in this case? Lawmakers are very clear, very clear. For example, this was 1 crore rupees of asset, and therefore you would have got deduction of 101 crore only. How much depreciated value of this asset would have been if no 3580 was claimed? So for it was acquired in 1st April 2023. 1st April 2024 value would be 90 lakh. 1st April 2025 value would be 81 lakh. So 81 lakh would have been the value now. Lawmaker says yes, this much amount shall be your PGBP. If you transfer any asset now from specified to non-specified, take the original cost, reduce the amount of notional depreciation from it, and find out the WTV. This WTV shall become your PGBP. And this WTV only shall become cost of acquisition for this non-specified business. Important discussion. Just put a star mark to it. Skill development project, agriculture extension project, any capital revenue, both are allowed. Expenses on demerger, it will be allowed, but only to the person who incurs that in 5 equal installments it is allowed. At last, sir, if somebody does VRS, voluntary retirement scheme payment, in that case, what happens? Sir, you will be allowed one third, one fifth, one fifth. If your company is amalgamated with somebody, then the other company would get one fifth, one fifth. Preliminary expenses, what this point says, see, if you are Opening a new unit. So for new unit, whatever the initial expenditure you incurred, na, that is preliminary expenses. How does that function? See, actual preliminary expenses you shall take, or 5% of the cost of project, whichever is lower. This is the allowed prelim expenses. What is cost of project? Lawmaker says nothing but fixed asset in the new unit are cost of project. Fixed asset in the new unit imply cost of project. But if you are a company, then cost of project or capital employed, whichever is higher into 5% you shall take, or prelim expenses, whichever is lower you shall take. What is capital employed? See, capital employed is share capital plus reserves and surplus, cut it down, plus long-term borrowings. This shall be taken as capital employed. Certain deductions. Anybody having any doubt up to this point or in this point? Anybody having any doubt up to this point or in this point? It's a lot of summer out there, to be honest. It's too hot out there. Always continue having a sip of water. Believe me, in exam, it will be difficult for you to sit in exam. In exam, it will be very difficult for you to sit. Always continue having water with you. Stay hydrated. You cannot compromise on health right now. Certain deductions. If you buy any stock insurance, allowed. If you pay, cut the second point down. If you pay health insurance premium for your employees, always allowed. But it should not be paid in cash, otherwise, it is absolutely allowed. If you pay any sum for on account of employee benefit expenditure, it is allowed, but it should be paid up to the rate of ROI. See, if you want to do any employee benefit expense, if you want to pay any bonus to employees, lawmaker says it is allowed, provided it should be paid up to the rate of ROI. If you are paying any bonus commission to the employees, it should be paid up to ROI, then it is allowed. Any interest on loan, lawmaker says that if you have taken loan from bank for the purchase of asset, then till the time asset is put to use now, loan is added to cost. But after asset is put to use now, after asset is put to use, interest is allowed in P&L. Similarly, in any other cases, interest is allowed directly. Remember, whenever interest is payable to any bank, any public financial corporation, public financial institution, state financial corporation, state industrial corporation, NBFCs, then in such cases, interest is only allowed if it is paid up to the rate of ROI, that is 43B. If you have taken any loan for payment of income tax, TDS, advance tax, in that case, any deduction, any interest paid is disallowed because these are your personal expenditure. Zero coupon bond discount. Discount on zero coupon bond. See, whenever we have zero coupon bonds outstanding, now we have issued zero coupon bond, then whatever the total discount is incurred, whatever total discount that we have given on zero coupon bond, that is allowed, that is divided by number of months that zero coupon bond is in force. And whatever months that are there in our year, in our previous year, we shall get deduction of that. For example, zero coupon bonds are in force for 24 months. So divide by 24, and whatever the months that are there in previous year, 25, 26, you will get deduction of that much. Let me take an example. For example, face value is 100, bond issue price is 70. That means 30 rupees discount on 5,000 shares. That means 1,50,000 rupees is the deduction amount. 1,50,000 rupees is the deduction amount. Date of issue is 1st October 2025 and redemption is 30th September 2026. That means 12 month is in force. 1,50,000 divided by 12 months, that means 12,500 is the per month reduction. In previous year 25-26, we have 6 months in force. 6 months into 12,500 will give us 75,000. 26-27, we have 6 months, again 12,500 into 75,000, this will give us the deduction for this year. So number of months you have to take. But sir, what if any month has more than 15 days? 15 days or more? Lawmaker says yes, 15 days or more is considered as entire month only. Let me take an example. For example, date of issue is 16th October. and redemption is 15th October. In that case, you would see now for previous year 25, 26, October, November, December, Jan, Feb, March, 6 months are there, and 26, 27, we have April, May, June, July, August, September, October. So we have 7 months. So out of this 150, this will be divided by 13 months, and 6 months deduction would be given in previous year 25, 26, and remaining 7 month deduction would be given in 26, 27. This is how things will proceed. Employers' contribution for the benefit of the employees. What does this mean? Employers' contribution for the benefit of the employees. Employers' contribution for the benefit of the employees. If employer contribute out of their own pockets for benefit of employees, statutory corporation, recognized provident fund, statutory corporation, SPF, recognized provident fund, approved superannuation fund, approved gratuity fund, or any other fund like ESIC, it is allowed to employer. It is absolutely allowed to employer provided he pays up to the due date of ROI. This money should be paid up to the date of ROI. Very simple it is. But if your employer contributes to your bad funds, what are those bad funds? Unrecognized provident funds, unrecognized superannuation funds, unapproved gratuity funds, and any other fund, it is disallowed. See, good things if your employer contribute, he is allowed. Bad things if he contributes, it is not allowed. Allowed will be only allowed when it is paid up to the date of ROI. Do you think that I have scope in Tollywood, South Indian movies? I mean, Bollywood, I have been rejected with by saying the overacting. But do you think I have a scope in Tollywood in South India? Do you think that I can do well in South India the way overacting I do? Sir, if employer contributes to pension fund, if employer contributes to pension fund of the employees, in that case, now, sir, it is allowed to employer actual contribution or 14% of the salary. It is flat 14% of the salary or actual contribution, whichever is lower. Remember, it will be allowed to employer only if it is paid up to the rate of ROI. If it is paid up to the rate of ROI, then only it is allowed. Important. Employees' contribution to provident fund. See, employees give their money to employers so that employees contribution to that respective funds. Employee giving money to employer and employer have to contribute this money to the fund. Employee give this money with an expectation that their money would be deposited directly. Now, what happens in this case? Now, employee's contribution cannot be delayed by the employer. It cannot be delayed by the owner. What will happen, sir, if employer delays this payment? Lawmaker says if it is even delayed by 1 day, it will be disallowed and it will never be allowed. If employees have given their money to the employer now, employer has to deposit employee's contribution up to the date of that fund. If it is delayed even by 1 day, now it will be disallowed in entirety. So what is the due date of the fund? 15th of next month. Just that means if it is April, then 15th May. If a May month, 15th June, June month, 15th July. So for every month, it is next 15th of next month. If you delay even by 1 day, it will never be allowed. It will never, ever, never, ever, never, ever, never, ever, never, ever be allowed. Animals used in business. For example, if you have cows in your business, you have buffaloes in your business, or if you have hens in your business, okay, which are capital asset, of course. In that case, what would happen, sir? If you have animals, they are not depreciable. Okay, you don't get depreciation here. Lawmaker says that if the animals become permanently useless, so you either sell them or you scrap them. Lawmaker says cost of animal minus a scrap is the amount of deduction you will get in the year in which they become permanently useless. No depreciation is allowed. Now here comes the best of all is bad debt. Baddie debt. Baddie debt. See, provision for bad debt is not allowed to anybody except for banks. Provision is not allowed. Fair enough. What about actual bad debts? See, actual bad debts are allowed. Actual bad debts are actually allowed. So if they are sales related, No, no, Janvi. There is a confusion that you are saying. Message you personally. I don't want to distract the topic. Message you personally. I will let you know. What you are saying is incorrect as of now. If you have any provision for bad debt, it is not allowed. Only to banks it is allowed. What about actual bad debt? See, if you have any sales related bad debt, it will be allowed. But if you have any loan related bad debt, it will not be allowed. It will not be allowed. See, bad debt must have been written off. See, what matters is department is not careful enough in this. Department says just write off the bad debt and we'll give you deduction. Just write down the bad debt. Write off the bad debt. We will give you the deduction. Second thing, sir, bad debt must have been taken into debt once. What does that mean? See, for example, if I sold goods to you, okay, next year I am not receiving any money, so I must have offered my sales in 1 year now. What my point is, data to sales, data to sales. If we have data to sales, then what happens, sir? Ultimately, we have offered this sales as our income. We must have paid taxes. This is what this point says, that if you want to claim any bad debt of this debtors, if you want to claim bad debt to debtor, at least you must have offered this under sales as well now. If you have offered this as your income, then only you can get the deduction of bad debt. Such debt should have been taken as income in any previous year. Fair enough. No need to prove that debt has become bad. We don't have to prove that debt has become bad. Okay, that's fine. Recovery of bad debt. Important point worth understanding. If you had, say, sold goods and you recover later on, sold goods, bad debt claimed, and then you recover. Lawmaker says if you had claimed 1,000 rupees of bad debt and you were allowed 1,000 rupees by the department now, and you recover any amount, lawmaker says any recovery is taxable. Claimed 1,000, allowed 1,000, but now if you have recovered 100 rupees, 200 rupees, whatever recovery you do is taxable now. But sir, what if you claimed 1,000? What if you claimed 1,000 but you were allowed only 700? You were allowed only 700 and you were disallowed 300. You were disallowed 300. That means department thinks that you are going to receive 300. Department presumes that you are going to receive 300. In that case, if you receive 200, that means 100 is extra allowed. Department thinks the receivable is 200. You receive just a 200. Then in that case, 100 is less received. 200 will be better. If departments think that 500 is recoverable, then extra 200 is to be offered as deemed PGBP. So this is how bad debt recovered function. Okay, bad debt recovered function, recovery of bad debt is taxable, the way I have told you. Recovery of the bad debt is the taxable in the year in which it is actually recovered. How much is the taxable amount? Whatever the bad debt recovered in excess of the writing off. Okay, whatever excess you have written off, whatever excess you receive is taxable. See, even if we do not do business, for example, we shut down the business, we sold goods, we shut down the business, and after 10 years, 20 years, I receive bad debt recovered, now it shall be taxable. But there is a catch. If there is a partnership firm who has sold the goods, who had claimed the bad debt, later on partners received the money. Partners received the recovered the bad debt recovered amount. In that case, it is not taxed because the person claiming the bad debt and person receiving the recovery should be same. Otherwise, it is not taxed. One example I want to take for which is used in exams. One example I want to take. What is that example? For example, you sold goods. 20 lakh I have sold goods. Next year, I realize that 10 lakh is bad debt. So this 10 lakh is bad debt, 20 lakh was sale, so 10 lakh is bad debt. So my recoverable amount is just a 10 lakh rupees. If I receive this amount, do you think that anything should be offered to income? Nothing. If 10 lakh is recoverable and I receive 10 lakh rupees, then nothing should go to P&L, nothing should go to expense, nothing. If I 10 lakh is recoverable to me and I receive 10 lakh, no treatment of this transaction. But sir, what if I receive just a 7 lakh rupees and credit this 7 lakh rupees to P&L? What will be the treatment? Try understanding this. See, if you are due 10 lakh rupees and out of that you will receive just 7 and you credited this 7 lakh rupees to P&L. First of all, whenever recovery you do, it is never credited to P&L. First of all, recovery was, see, ultimately you were due 10 lakh rupees now, so this has already been offered as income, so any recovery will never be credited to P&L. First of all, this should have been taken off, so the 7 lakh is to be taken off. Plus, out of this 10 lakh, you are recovering just the 7 lakh. That means 3 lakh is the additional bad debt. So 3 lakh would be allowed again. This is how adjustment is done. Just rewind this video and check it out again. Perfect, Janvi. Provision for bad debt. Provision for bad debt. Provision for bad debt. See, if you are an Indian bank, see, normally provision for bad debts are only allowed to banks only. If you are an Indian bank, then what happens, sir? 8.5% of GTI is allowed to as deduction. Plus, if you have branches in rural India, then whatever the advances are given by these rural branches, now on that advances, 10% deduction is also allowed to you. If you are a foreign bank, if you are a public financial institution, state industrial investment corporation, NBFC, in that case, 5% is allowed to you as provision. Whenever you have actual bad debts, now first actual bad debts will be adjusted from provisions. Once actual bad debts are taken care of, once actual bad debts are over, in that case, what will happen? In that case, over and above the provision will go to P&L. Over and above the provisions will go to P&L. Expenses on family planning promotion. If you spend any money for promoting family planning, okay, seminars and all, machines and all, whatever expenditure you incur, then what happens? It is allowed as deduction to company only. Revenue expenditure 100% allowed, capital expenditure in five equal installments allowed. Where did we else study this family planning? Sir, we studied in head office expenses. Buffalo was sitting in head office taking the action of family planning, and at Parakudu, if you remember. So this family planning is only allowed to companies. Revenue expenditure 100%, capital expenditure in 5 equal installments. Securities and transaction tax. What does this say? See, if you have securities held as stock in trade, then you get deduction of STT. If you have commodities held as a stock in trade, now then you get deduction of CTT as well. Otherwise, as capital asset, it is not allowed. The sugar cane you can cut down. Come on to the special reserve. See what this says. This is not also. It is also not relevant. See, if you are a financing company who provides long-term finances, in that case you get a deduction. How much deduction you get? PGBP into 20% from the core activities. Share capital plus reserves into 2 times minus opening balance, or amount transferred to this reserve, whichever is lower, you get deduction. Any withdrawal from this reserve shall be taxable under that PGBP. At last, if you have any mark-to-market losses. If you have any mark-to-market losses, these are always disallowed. But if these mark-to-market losses, if these are losses in compliance with the ICDS, then they are allowed. This was section number 36. When bad debt was happened, that time deduction allowed, and then recovery, it is added to P&L. No, it is not. Yes, it is added to P&L. It is added to P&L. I mean, not added to P&L. It should go to P&L as well as per accounting, but under Income Tax Act, it should be charged to taxes. It means it is added to profit. In that Buffalo format, what is the treatment of capital losses? If it is current year losses, no treatment. If it is brought forward losses, add back. Any kind of brought forward losses, whether it is capital assets, capital loss, whether it is speculative loss, if it is specified business loss, if it is any loss, it has been adjusted and always added back. Always added back. Buffalo format. It's Buffalo format. Buffalo. Section number 37. Lawmaker says if you have not been allowed any deduction from section 30 to 36 and you are doing any expenditure exclusively for the business, not personal purpose. If you are doing any revenue expenditure, not capital, and if you are doing any legal business, not bribery business, in that case, such business expenditure shall be allowed under section 37. Sir, there are certain list of expenditure from where you are going to say at least a 2 to 3 adjustments and exams. Let's understand them one by one. First of all, any freebies, purpose, it's free sample to doctors, absolutely disallowed. If you do any CSR expenditure, disallowed, clearly disallowed. But if you donate to PM Care Fund, now you get ATC deductions. If you give any gift to employees, it is allowed. If you distribute dividend and debit to P&L, yeah, chi. If you debit, if you debit any kind of dividend expenditure to P&L, registration fees incurred for increasing authorized share capital, sir, it is always disallowed. Always disallowed. It is a capital expenditure. If you have any expenditure for festival, for example, Diwali, for example, Pongal, freebies given to chemists, it is allowed. It might be allowed. It is an advertisement expenditure. It should be allowed. Medical practitioners, we say specifically, we say medical practitioners. So doctors are considered as medical practitioners. It should be allowed. Yes, it should be allowed. See, the fact is, the law is this only. Law is this only. Law states certain thing. Today you are saying if we are giving it to pharmacists, it should be allowed or not. Tomorrow you will say that if we are giving to a dispensary, which is not a doctor, will that be allowed or not? If we are giving free samples to a physiotherapist, he is not even considered as doctor, will that be allowed or not? I mean, questions may arise now. Many way question may arise. So that is not what is answered by income tax act. ठीक है? That is what, as per industry parlance, that is dependent upon case laws, which are not part of our syllabus. See, if you pay any secret commission, bribe, hafta, sir, that is a disallowed expenditure. Sir, whenever you spend any money on IPO, FPO, right, bonus, debentures, buyback, loan, will this expenditure be allowed or not? Will this expenditure be allowed or not? It, sir, depends. It, sir, depends. One litmus test I am telling to you, and this will help you out. If there is increase in share capital, plus there is increase in bank balance, in that case, it will be disallowed. Rest all allowed. If increase in share capital, plus there is increase in bank balance, then it is disallowed. Rest all allowed. What does that mean? Let me help you out. IPO, is there any increase in share capital? Of course, sir, shares increase plus bank balance increases, so it is disallowed. FPO, whether bank balance increases, yes, sir. Whether share capital increases, yes, sir. Again, disallowed. A right issue, share capital increases, yes. Bank balance increases, yes. Disallowed. Bonus, share capital increases, yes. Bank balance increases, no, so allowed. Debenture, share capital, no change. Bank balance, yes, allowed. Buyback, share capital reduces. Bank balance reduces, allowed. Loan, share capital, no change. Bank balance, yes, therefore allowed. So this is a thumb rule that has been found by me. Somebody might give a credit, somebody can give a credit to me. I don't want actually, but if you want to give, you can give credit to me. You don't have to do anything. You just have to like the video, subscribe to channel. That's it. And if somebody is watching this recorded, you too, you have not subscribed to channel, subscribe it as soon as possible. If you have any losses of subsidiary, deferred tax, diminution in the value of the asset, uncertain liabilities, in that case, it is not allowed. If you do any advertisement in brochure, souvenir, newspaper, and pamphlet of a political party, it is disallowed. Lawmakers are clear that if you donate to a political party, if a company donates to a political party, or if company spends any money on advertisement revenue of a political party, in that case, now such expenditure is disallowed here. But political parties would get deduction under 80 GGB. Sorry, companies would get deduction under 80 GGB. Any long-term provision like gratuity, leave, encashment, even as per actual valuation, it is disallowed. Only gratuity paid shall be allowed to you. Interest on loan taken for income tax. If you have any income tax payable, if you have taken loan for income tax, now that is allowed. That is sorry, that is not allowed. That is not allowed. Not allowed. Not allowed. Litigation expenses. If you have paid any money to lawyer or chartered accountant for filing appeal or for fighting the appeal, in that case it is allowed. Cash embezzlement, cash being theft, it is allowed in the year in which you got to know that cash has been embezzled. If you have incurred any expenditure for existing project, it shall be allowed, but for a new project and then such expenditure shall be disallowed. What does that mean? For example, I am into shoe businesses and I want to expand into apparel businesses. Apparel businesses means garment businesses, and not in India but even outside India. Later on, after doing too much of expenditure, too much of market research, I realized that I can never run this business. Therefore, what I have to do, I have to just let that money go. Whatever money I have incurred, I have to let that go. In that case, what happens? Lawmaker says that if there is new expenditure and new business, new line of business, in that case, now, if any expenditure is done, it will not be allowed. If a business is abandoned, now then expenditure is not allowed. But if business is not abandoned, I mean businesses flourish, then these will be allowed as preliminary expenses for new business. Fair enough. But sir, if it is expenditure with respect to existing business, for example, if I have shoe business in Indore, I want to start a branch in Chennai. If it failed, then it will be allowed to me because business is same. But if it is new business, it will not be allowed. Retrenchment commission. If business is closed, not allowed. If unit is closed, allowed. If you pay any remuneration to the directors, remember, it shall not be allowed beyond the limit prescribed under Companies Act. So Companies Act, you can pay. Beyond that, it is not allowed. Prior period expenditure, if liability to pay certain, then it is allowed. Compounding fees, not allowed. For example, I have paid any money to the consultant so that I want to start up a new business. For example, I want to start up ACCA classes. So I went to consultant and asked, should I take it or not? Whatever fees I have paid now for a new business, it will not be allowed to me in the current business. For new business, it might become the preliminary expenses, but for current business, it will not be allowed. Sponsorship fees, non-competition fees, branch inauguration fees, globe boards, expenses on ISO certification, these are allowed expenses. See, if there is a doctor who does his heart surgery and claims it as a business expenditure because of his heart only he is able to treat the patients now. So he is claiming surgery expense as the business expenditure. Will that be allowed? Right answer is no. From tomorrow you will say that whatever food I am eating, it is necessary for business. So food expenses will be business expense. It is not like that. Okay? So there is a difference between business and personal. One day there was a pain in my leg. You will not believe this. There was a pain in my leg and I went to doctor. And there is a diagnostic center near me. I went to diagnostic center. I asked, Sir, I want to get an X-ray done of my foot. Receptionist says, Acha, name which doctor has sent you. I said, Gupta ji. Dr. Gupta. Receptionist had a broad smile. Oh, Gupta ji, I sent you. Gupta ji, have a seat. Will you have a cup of tea? Acha, coffee? Acha, aam panna. Will you have it? I mean, just by hearing the name Gupta ji, there was a smile in the face of the receptionist. Why? Because these diagnostic center pay commission. The doctor refer cases to this commission diagnostic center, and diagnostic center pays commission to the doctors. In this case, any commission paid by diagnostic centers to the doctors is not allowed. It is also disallowed. If you forgot to incorporate any bill in your books, then it is allowed. You can incorporate today. If you have any direct expense, direct tax, interest, penalty, late fees, everything is disallowed. Direct tax, TDS, income tax. Remember, one question of MAT. One question of MAT, sir. What MAT has done, sir? What MAT has been? Lawmaker says in MAT, no, TDS, late fees on TDS return have been allowed once. Late fees on TDS was allowed by ICI. Other taxes like GST, custom, interest allowed, tax if credit is not available allowed, fees allowed, but penalty not allowed. This gives us to a conclusion. Penalty for any law is not allowed. Penalty for any law is not allowed. Rather, penalty for breach in contract is absolutely allowed. Right? Penalty for breach in contract is allowed. If I have paid any money to settle the proceedings in respect of contravention to act, it is also disallowed. Sometimes what happens is, na, my company comes up with an IPO. If I come up with an IPO, now what happens is I get application money. I keep this application money in bank and earn some interest. Lawmaker says that this interest is also not taxable. Why it is not taxable? Because ultimately IPO related expenses were disallowed, so interest will also be not taxed. That completes section number 37. What the question is, treatment of preliminary expenses. There you go. 5% and 5%. This is how much it should be allowed. Come on to section 40. Just give me 2 minutes. Huh? Just give me 2 minutes. I'll be back in 2 minutes. Okay. Amount not deductible. What does the section says? If you are paying any sum on which TDS is required to be deducted and you did not deduct the TDS, you have to deduct TDS, but you did not deduct the TDS. In that case, what will happen? First of all, if you are required to deduct the TDS not deducted in previous year or not paid up to ROI, up to due date of ROI. What did I say? Not deducted in previous year or not paid up to the due date of ROI. In that case, 30% in case of resident and 100% in case of non-resident, it is disallowed. Expenditure is disallowed. What did I say? Deduction should be done in previous year and payment should be done before ROI. If any of the thing is missed out, if I did not deduct in previous year, if I did not pay up to ROI, it shall be absolutely disallowed. Sir, what if we deduct late or what if we pay late? What happens? Is it possible kya ki we deduct late and pay late? Is it possible? Right answer is yes, it is possible. We can deduct late, we can pay late. In that case, once you delay the limit, it shall be disallowed in current year for sure. It will be allowed in the year in which it is finally paid to government. So if we deduct late or if we pay late, in that case, it's whatever they was disallowed, 30%, 100%, whatever it was disallowed now, it will be allowed in the year in which it is finally paid to the government. Sir, what if deduction is not an option? We have paid the money to somebody and he's not giving us the tedious amount. We cannot even pay out of our pockets. What if deduction is not even an option? Then what happens? Lawmaker says that if the payee, the recipient, furnishes the return of income, takes into account such income and pays taxes and furnishes Form 26A. Form 26A from chartered accountant to this payer, in that case, the payer, the deductor shall be allowed 30% or 100% in the year in which taxes have been paid to the government. So, if deduction is possible, but we deducted late or we paid late in any of the case, it will be allowed in the year of payment. But if deduction is not even possible now, then in that case, the year in which the payee considers such income in his ROI and declares taxes now, in that year he shall be allowed. In that year he shall be allowed deduction. Equalization levy cut down. See, if you pay any salary to a non-resident now, salary to non-resident is exceptional. It is not like other payments to a non-resident, it is exceptional. Whenever you pay any salary to a non-resident, it TDS has to be deducted at that moment only, and it shall be paid up to the due date of TDS payment. Salary to a non-resident, you cannot wait up to ROI. You have to pay it even up to the date of TDS only. Beyond that, you will not be allowed. Any payment made beyond the due date will be disallowed 100% and will never ever be allowed, even if it is paid before ROI. Disallowed 100% and will never ever be allowed. Oh dear God. Oh dear GAWWWD God. Perfect, sir. Tax on non-monetary perquisite. What are non-monetary perquisites? See, Sarthak sir gives me home to stay. So this is a non-monetary perquisite. But see, sometimes the home benefit is so much that my salary is not enough to bear that. So Sarthak sir also bears the taxes on this home. Sarthak sir also bears the taxes on this home component as well. Lawmaker says that if employer bears the taxes on this non-monetary component now, this shall be disallowed to the employer and it is exempt in the hands of the employee. Disallowed to employer and exempt in the hands of the employee. 40 A 48 2 you are my relative. A2 you are my relative. A2 you are my relative. If you make any payment to a specified person, who is a specified person? Your mother, father, brother, sister, elderly spouse. Mother, father, brother, sister, elderly spouse. Mother, father, brother, sister, elderly spouse. If you have any mother, father, brother, sister, elderly spouse, if you make any payment to them, and if it is beyond reasonable, if it is excess payment, now it shall be disallowed. Access payment to their mother, father, brother, sister, LLD shall be disallowed. Okay. Next thing, what is excess payment? See, excess payment over and above the FMV. What is FMV, sir? FMV is the amount determined fair market value. Fair enough. Who are relative for individual mother, father, brother, sister, LLD spouse. For HUF, their members and their mother, father, brother, sister, LLD spouse. For a firm and LLP, their partners and their mother, father, brother, sister, LLD spouse. For a firm, directors and their mother, father, brother, sister, LLD and spouse. AOPBY members and their relatives, and for every other SSC. For example, any person has a substantial interest, that means 20% or more shareholding or voting power or PSR in any business, or any person is having substantial interest in, any person is having a relative and relative is having substantial interest now, then these two shall be related party only. That is why subsidiary and parent are also relative. Now, 48.3, this is cash payment. What does this cash payment says? Understand. Whenever you pay any payment to a single person in a single day more than 10,000 rupees, it shall be disallowed. Or it shall be paid, if it shall be paid in cash, it shall be paid via account pay check, account paid demand of electronic clearing system only. If you pay more than 10,000 in cash, it is absolutely disallowed. Okay? Fair enough. Now there are certain intricate points in this entire explanation. Try understanding this. For example, last year you took some expenditure on accrual basis. For example, salary expenditure you took on accrual basis. Electricity bill expense you took on accrual basis. Today you are paying that expense in cash. Today, if you are paying any expense in cash, now lawmaker says that it shall be added to your income. Clear cut, it shall be added to your income. Perfect, sir. Perfect. Sir, if you pay any money to a transporter, if you pay any money to a transporter now, then instead of 10,000 limit, there is a limit of 35,000. If you pay any money to a employee or his family at his retirement, up to 50,000 in cash is allowed. If you pay any money via account, paycheck, demand draft, electronic clearing system, IAPS, Bheem, credit card, debit card, UPI, UPI, Aadhaar enabled payment system, if you make any payment via these methods now, in this case, any payment can be done. There is no limit of 10,000. If you make payment to bank, LIC, RBI or government, then there is no 10,000 limit. If you make payment via book entry, sir, what is book entry? For example, I purchased goods from Anshul and sold to Kumar. I purchased goods from Anshul and sold to Kumar. In this case, what happens? I have to pay to Anshul and I have to receive from Kumar. I requested them to give this money to each other. Then this is book entry. Now, whatever payment they do, it should not affect it should not affect me. Now, if I make any payment to in a village or a town where there is no banking facility, then I can pay more than 10,000 in cash. If you are making any payment to the producer of agriculture produce, forest produce, poultry products, fish products, and livestock, payment can be made in cash. If authorized dealer purchases any forex in cash in his ordinary course of business, it is allowed. If you are an employee who have been posted at any other place than employment, for example, you work at Gurgaon, but you have been posted in Chennai, in that case, your salary can be paid in cash. Similarly, if somebody has been posted in a ship, in that case, salary can be paid in cash. At last, if you are paying any sum to a cottage industry which is processing or which is producing goods, manufacturing goods without the aid of power, then also you can pay in cash. More than 10,000 it is allowed. Last time, if you pay any payment to if commission agent pays any money to the principal who works on commission basis now, then payment is allowed in cash. Ignore this point. Last point you can ignore. Provision for gratuity not allowed. Actual gratuity absolutely allowed. Point number 29. Deemed PGBP. What does this deemed PGBP imply? See, sometimes there is an electricity bill expense outstanding. Electricity bill to electricity bill outstanding. This is the general entry. For example, 50,000 rupees is the electricity bill outstanding. Sir, break, 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 break. Kya, kya, kya? Just let us complete this topic. I will take 15 minutes to complete this topic. We can have lunch break. Huh? We have had a long break. We can study for 15 minutes. 15 minutes after topic will be over, and then we can move on to next chapter after break. Okay, we need to complete this chapter first. Deemed PGBP. Whenever there is any expenditure outstanding and it is not payable now, it is not payable. Or we received a loan and now we don't have to repay the loan. This is considered as deemed PGBP. These are considered as deemed PGBP. What does this mean? See, if SSC has taken deduction of an expenditure and that expenditure is not payable now, right now, or if I have taken any loan and that loan is not payable right now, so either there is an expenditure I have claimed which is not payable, or either I have got free of cost money and that is not repayable now. In both the cases, it is a remission of liability and it will be our deemed PGBP. For example, waiver by the waiver of the loan by the government, it is always our income. If waiver is done for a capital nature loan, for example, for a car, building, then it is added to cost. If there is any working capital loan, principal amount is remitted, it is taxable. But if interest amount is remitted, it is not taxable. Why? See, the taxability would come if you have received some money and then not repayable. Then, if you have claimed deduction and you were allowed deduction then. But interest is neither received money, it is not even claimed as deduction. Interest is already disallowed under 43B because it is not paid up to the ROI, it is already disallowed. So there is no taxability of interest component. Okay? If there is any time barred liability, in that case, what happens? Sir, if you write it off, it is your deemed PGBP. If unilaterally, if you write off any liability, it is also deemed PGBP. See, there are some expenses which are allowed on payment basis. Some expenses allowed on payment basis. What are those expenses? See, any expenses on taxes, duties, cess. You have to pay up to the due date of ROI. If if you are an employer and you contribute towards SPF, RPF, approved gratuity fund, approved superannuation fund, new pension fund, if you contribute to any of such schemes, employer's contribution to SPF, RPF, approved gratuity fund, approved superannuation fund, and new pension fund. In these cases, what happens is, in these four cases, you have to pay up to the rate of ROI, then only you will be allowed in 25-26 previous year. Bonus and commission to employees, if paid up to ROI, it will be allowed. Interest on loan to any PFI, State Financial Corporation, State Industrial Investment Corporation, Scheduled Bank. In this case, you have to pay this interest up to the rate of ROI, then only you will be allowed, otherwise you will not be allowed. Interest to NBFCs, it has to be paid. Any leave encashment has to be paid up to the rate of ROI, then only it shall be allowed. At last, sir, if you use railway assets, in that case, if you make the payment, then only the expenditure is allowed, otherwise you will not be allowed any expenditure if you have not paid for railway asset. So this 1 to G points have to be paid up to the rate of ROI, then only they are allowed. Otherwise, they are not allowed. Sir, when they will be allowed? See, it will be disallowed in current year. So the due date paid, allowed in current year. If after the due date they are paid, then they will be allowed in year of payment. The year in which you make the payment, you shall get the deduction. 7. Taxes, employers contribution to different funds, interest, bonus and commission, railway payments, and leave encashment. Then we have 43BH. This is what it says. If any sum is payable to micro and small enterprises. Now, what is a micro enterprise? Micro enterprise is nothing but any enterprise which is having PP capacity up to 2.5 crore and turnover to 10 crore. Small enterprise is nothing but whose PP is up to 25 crore and turnover up to 100 crore. These are the micro and small enterprises. These are micro and small enterprises. If you are making any payment to these MSMEs, micro small enterprises, SMEs, in that case, what happens? You have to make payment within the agreed time. What is the agreed time? See, if there is agreement between the two, then take the agreed time or 45 days, whichever is lower. If agreed time is 10 days, make payment in 10 days. If agreed time is 20 days, make payment in 20 days. Agreed time is 40 days, make payment in 40 days. Agreed time is 60 days, make payment in 45 days only. If there is no agreement, then payment is to be made within 15 days. If we do not pay within the agreed time, then what happens? It shall be disallowed in the current year and shall be allowed only in the year of payment. Some common pointers to be taken care of. See, sometimes we have some outstanding liability, outstanding interest. We have to pay that interest, then only it shall be allowed. But instead of paying now, what we do is we convert that interest into fresh loan. Does that amount to payment? Right answer is no. Conversion of interest into fresh loan does not amount to payment. It only amounts to payment when this freshly converted loan is repaid back. Then only it is allowed. Second thing, sometimes what happens is we have outstanding interest. We convert them into equity shares. Will that be allowed? Right answer is, sir, it shall be allowed. If outstanding loan is converted into equity shares, it is allowed. It is absolutely allowed. Absolutely allowed. So sometimes we have to pay the interest. We have to pay some liabilities. Instead of paying the liabilities, we have submitted the bank guarantee. We have given an assurance that we will pay it. And along with that, if we do not pay, anybody might invoke the bank guarantee and he might collect the payment. So legally, does it amount to payment? Does furnishing of bank guarantee amount to payment? Clear cut, no. Sometimes what employers do, you know what? Employers want to give a bonus to employees. But instead of bonus, they make a trust and deposit this bonus to trust. with an expectation that this trust would remit this bonus to the employees. Now, whether just by giving bonus to the trust will entitle you deduction, very clearly understand, just because you are donating money to the trust or you are giving money to the bonus money to the trust does not mean employees have received here. Here, in basic condition is employee should receive. If employees have received up to the date of ROI, then you will get deduction. If they have not received, you will not get any deduction. See, whenever you acquire any forex asset, then any gain or loss on such forex asset or any kind of foreign exchange fluctuations or hedging loss added to block. If there is profit, reduced from block. Any other gain or loss, this shall be adjusted from P&L only. 43 CB service contract and construction contract. Now, whenever you do construction contract, always understand, always understand the construction contract. See, you have one option, that is percentage of completion method. Whatever the percentage work is completed, you shall recognize revenue, you shall recognize cost based on that. That's enough. Sir, but what about the project completion method or service contract? Sir, in case of service contract, it depends. If your contract is for more than 90 days, then percentage of completion method shall apply. But sir, if it is for less than 90 days or equal to 90 days, in this or project completion method apply. As soon as project is completed, then only revenue is recognized. This NPA not to be studied, 44A not to be studied, 44AA not to be studied. Yes, books of accounts related. One thing I want to tell you is, see, if you are opting for presumptive taxation, no books of accounts required. You will be charged penalty of 25,000 if you do not maintain books of accounts. And at last, sir, whenever books of accounts are maintained, it shall be maintained for 6 assessment years. 6 assessment years that shall be maintained. Audit. See, we have already covered this under audit. See, if your turnover is up to 1 crore, you have to get yourself audited. But if your total receipts into 5% are only cash receipts, or total payments into 5 payments are cash payments, in that case, now your 1 crore limit would become 10 crore. Now, in this total receipts, you shall take every sales, every capital gain receipts, every rental, every interest, every receipt you have to take. Revenue receipt, capital receipt, every receipt you are going to take. And in payments as well, every payment you are going to take. Sir, if you are into profession, then if your gross receipts exceed 50 lakh rupees, then if your gross receipt exceed 50 lakh rupees, in that case, you have to get yourself audited. If you are opting for 44 AD and you are paying taxes lesser than 8%, 6%, and your income exceeds basic exemption limit, in that case you have to get yourself audited. Similarly, for 44 ADA, if you declare lesser than 50%, then you have to get yourself audited. If you opt for any presumptive taxation and you declare lower than that, like 44A, you are declaring lower, 44BB, triple B, you are declaring lower, in that case you have to get yourself audited. Sir, if you are opt for special provisions, if you opt for special provisions, then no audit is required. If you fail to get yourself audited, now in that case, what happens? 0.5% of the turnover or 1.5 lakh, whichever is lower, shall be applicable. This much penalty shall be applicable. Presumptive taxation. See, if you are a resident individual HUF firm, not LLP, who is not into agency business, brokerage business, commission business, or any transportation business, is referred under 44A. Plus, you do not have any deduction under 10 or 80 IA to RRB. In that case, what happens, sir? Whatever the gross receipts you have now, of that gross receipts, whatever is received via banking channel is 95% or more. If you have received 95% or more via banking channel now, in that case, your instead of 2 crore, sir, 3 crore limit would be given. Sorry, 3 crore limit would be given to you. Okay, normally 2 crore limit for presumptive taxation, but 3 crore limit would be given if out of the total gross receipts, 95% are received via banking channel. Now, what to do? Out of this 2 crore, 3 crore, sir, whatever the money that has been received via banking channel, on that you have to offer 6%, and otherwise you have to offer in cash, or not received, you have to offer 8%. This will give you the presumptive income. So best part of presumptive taxation is once you opt for a year, you have to opt for next 5 years, next consecutive 5 years. And once you opt out, then for next 5 years, you are not entitled for 44 AD. 44 ADA, what this point says, it's the same thing. Individual HUF firm who is not an LLP, in that case, if you are a 44 AA professional, in that case, sir, if your gross receipts are up to 50 lakh rupees, then you shall offer 50% as your PGBP. But if your 95% of the gross receipts are 95% of the gross receipts are received via banking channel, in that case now you can declare presumptive taxation up to 75 lakh rupees. So there is no such provision that once you opt, then you shall continue for 4 years. Common pointers. Any deduction under section 30 to 38 will not be allowed. Similarly, if a partnership firm opts for 44 ADA, in that case, any remuneration to partner, any interest to partner shall also not be allowed. But yes, block shall continue to reduce. 44 ADA, important point here. You don't have to maintain books of accounts. You only have to pay one installment of advance tax, that is last installment, and your due date for ROI is 31st July. If you are into transportation business, take a transportation business, then you have an option to go for presumptive taxation. Now, who can go? Anybody who has 10 vehicles. Here, presumptive taxation is to be offered when you own the vehicles, not the date you use the vehicle. Owning is important. How the structure goes, see, if you have heavy vehicles more than 12,000 kg or 12 tons, in that case, 1,000 rupees per truck, per ton, per month. And for other vehicle which are lesser than 12,000 or equal to 12,000, in that case, 7,500 rupees per truck per month. Per truck per month. No deduction under section 30 or 38 would be given. But here 40B will be given. If a partnership opts for it, 40B will be given. So one thing. Can a company opt for 44A? Right answer is yes. Even company can opt for 44A. No need to maintain books of accounts. On all four installments of advance tax required to be paid. Sir, in all the cases, partners inter remuneration shall be allowed in 44A, not in 44AD ADA. Always understand, sir, whenever we compute the profit under 44AD and ADA, 44AD and ADA, in that case, what happens, sir? 44AD and ADA. We are not allowed unabsorbed depreciation from these presumptive profits, but we are allowed to set off brought forward losses of last year's from this current year profit. Current year profits from other businesses also can be set off against this presumptive income. That is allowed. That is fairly allowed. Unabsorbed depreciation is not allowed in any case, but brought forward losses is allowed in every case. 44DA. If you are a non-resident who has permanent establishment in India and through this PE he is providing the technical services for which he is earning royalty or FTS. In that case, so this P will create a P&L, offer the income as royalty, FTS, write down the expenses, and this will give out the net profit. On this net profit, 35% tax or slab rate, whatever is applicable, that shall apply. This is 44DA. Sometimes what happens is, if a non-resident doesn't have P in India, but he operates outside, but this is not approved by government not approved, then again the same P&L provision will take place and you will reduce the direct expenses. Net will be taxed. Other topics. If you receive any grant subsidy from the central government, it shall go to PGBP. If you receive grant for a asset, it is reduced from cost. If you receive any subsidy, then it is not taxable. LPG subsidy received is not taxable as of now. ICDS yesterday we did in lecture day 2. Clubbing we did, set off we did. Deductions also we did. Come on to next chapter. Before that, I can give you break. It is 2:07. We will take break till 2:30. Plus minus 2 minutes. Have a proper lunch. And after that, we shall continue with the finest topics of the syllabus. What we have, even if vehicle is not in operations during the half of the year due to maintenance, do we need to consider? Yes, you have to consider. If you own the assets, you have to consider income. You have to consider the income. Moving on, we shall meet after the break. Welcome back from break. Are you all back from break? Are you all back from break? Sorry. Yes, sir. We are back from break. Before PGBP, when I saw, we took 4 hours to complete the 3 chapters, 4 chapters, which is very good enough, very fair enough. Moving forward to next chapter, assessment of various entities. Okay? It is not a single chapter in itself, but it is a compilation of very, very small topics. Right away, starting from firm taxation. See, what is the tax rate for firm? A firm is taxed at the rate of 30%. We are aware of that. Can you tell me one thing? Can you tell me one thing? Sir, a firm is taxed at the rate of 30%. Is there any alternate regime available for a firm? Do we have any alternate regime for a firm? Sir, whatever the long-term capital gains are, that are taxed as usual. Whatever short-term capital gains are, that are taxed usual. A firm is taxed the way a normal assessee is taxed. There is no differences as such taxation. There is no difference in taxation terms. Tax it is 30%, 12% surcharge if total income exceeds 1 crore. 4% education cess mandatorily it will be imposed on. So there is no difference as per taxation. With respect to partnership, with respect to expenses, see, a partnership firm gets an additional deduction of interest paid to partner and remuneration paid to partner. It is the extra deduction that a firm gets. After that, whatever the profit remains now, this profit is taxable in the hands of the firm, and this profit, when it is distributed to partners, it is exempt for the partners. But how much profit, sorry, how much interest, how much remuneration will be allowed to firm, that is our subject matter. How much of the interest, how much of the remuneration will be allowed to the firm, that is our subject matter. If partnership firm pays any interest or remuneration on interest on loan, interest on current account, interest on capital account, interest on anything, if it is not authorized by deed, it is not allowed. As simple as it can be. If interest is not authorized by deed, it can never be allowed. So what if it is authorized by deed? Then what will we do? See, if interest is authorized by deed now, then maximum interest that will be allowed is 12%. Not authorized by deed, not allowed. Allowed by deed, so maximum 12% would be allowed, not more than that. Sometimes what people do now, instead of just giving interest, they give commission, they give bonus. Sorry, they give some finance charge, they give some brokerage. Lawmaker says everything that is the nature of finance cost as interest only, which is a finance charge, which will it will be classified as interest only. Sometimes partners are given remuneration, bonus, commission, salary, royalty, multiple other things which are in the nature of salary. In that case, it will be disallowed if it is not authorized by deed. If it is not authorized by deed, it will be disallowed. If it is authorized by deed, then if it is paid to non-working partners, it will not be allowed. But if it is paid to working partners, it is allowed as per a limit. What is that limit? Let me tell you. The remuneration allowed shall be, you have to calculate the book profit. What is the book profit? Out of that book profit, first 6 lakh, 90% or 3 lakh, whichever is higher shall be allowed. And whatever the balance book profit is, 60% of that shall be allowed. This is the remuneration allowed to you. What is the book profit? Lawmaker says as P, you have to calculate PGBP before remuneration, after unabsorbed depreciation, before losses. PGBP before remuneration, after unabsorbed depreciation, before losses, whatever the figure turns out to be. Now, this is your PGBP. Is your net profit under PGBP. Seems fair enough. Seems fair enough. In this entire process, the two or three important things I want to tell you. First of all, can partnership amend its deed? A firm can amend its deed and give interest and remuneration. Right answer is yes. Deed can be amended to provide for interest and remuneration. But there is a catch. Deed can never be amended retrospectively. Even if it is amended retrospectively, na retrospective interest and remuneration will never be allowed. First thing. Second thing. Sir, whenever you pay any interest to partner, maximum interest allowed is 12%. But what if you pay interest to partner's wife? What if you pay interest to partner's HUF? Then in that case, any reasonable interest is allowed. Any reasonable interest is allowed. That's okay to pay paid. Third thing, with respect to 44 AD and ADA, a firm can opt for 44 AD ADA, but LLP cannot opt. This is the third important point worth understanding and worth noting. We have section number 78, which says losses by firm only. See, if there is a reconstitution in a firm, say a partner retired or a partner died, lawmaker says that his share of losses cannot be carried forward by the firm. We are not talking about unabsorbed depreciation, we are talking about losses. Retired partner's share or deceased partner's share cannot be carried forward by the firm. For example, let me draw that example for you. You will understand that. ABC are three partners. A retired on 1st October 2025. So this is entire previous year. On mid-year, A retired. Profit for previous year 25-26 was 15 lakh. So profit for entire year was 15 lakh rupees. Brought forward losses on the 1st April were 9 lakh. And unabsorbed depreciation has been given 3 lakh rupees. A retired on 1st October. So A is the retirement date. See, total profit for the year is 15 lakh rupees. So for half period, half would be. And for half year also, A's share of profit would be 1/3. So if I consider now, 2.5 lakh is the A's share of profit for this first 6 months. 2.5 lakh would be A's shares of profit. That's enough. That's fair. What is A's share of losses? Out of this brought forward losses, 3 lakh would be A's share of losses because out of 9 lakh, 3 partners are there. A's share of losses is 3 lakh rupees. Ideally, this should be disallowed, but there is A's share of profit as well. If we set off now, 50,000 profit remains. 50,000 worth of profit losses remains. Lawmaker says that this shall not be allowed. Provision says this shall not be allowed. This shall not be allowed to carry forward because this is A's share of losses. He had actually 3 lakh of share, 3 lakh of losses, but 2.5 lakh is the profit he has that will be set off. Ultimately, he has 50,000 of share which cannot be set off. Which cannot be set off. If you will see 15 lakh, instead of 9 lakh, 50,000 has been reduced and 850 is only allowed. 3 lakh unabsorbed depreciation, 350 is the final total income figure. Section 184, very important. Section number is not relevant in this chapter, but content is. If you want to assess a firm as a firm, then there has to be a deed. There has to be a profit sharing ratio in the deed, and that deed shall be submitted up with the first return. Then only department will assume that it is a partnership firm if there is no deed or if there is no profit sharing ratio, or if deed is not submitted with first return. In that case, what happens? Sir, profits are taxable in the hands of the partners and losses are allowed to the partners only. In case of succession of firm, for example, if there is a firm ABC and this ABC is entirely sold to somebody else called XYZ, lawmaker says that in case of succession, the date of succession is marked, two P&Ls are created, two returns are furnished for both the entities. For old entity, different return would be filed, and for new entity, different return would be filed. So in succession, two P&Ls, two returns. But in case of reconstitution, there are two P&Ls, but return of income is only one filed. Fair enough. Remember, if there is a partner in a partnership firm, and later on it was found that in that respective year, the partnership firm has done the fraud. So in whatever year partnership firm has done the fraud now, whoever are the partners for that year, they shall be jointly and severally liable for all the acts of the firm. Jointly and severally liable for all the acts of the firm. All the partners would be jointly and severally liable. Very, very, very okay. For the purpose of income tax, LLP is not unlimited liability. LLP is not limited liability. LLP will have unlimited liability. Even if their capital contribution is not sufficient to pay the taxes, government might come up and take away their personal assets for recovering the liability. So for LLP purposes, sorry, for income tax purposes, LLP is not limited liability, it is unlimited liability. Last and the last bazooka, what this says. If partnership firm was working, it has committed a fraud and it has dissolved that partnership firm. Firm has been dissolved. If assessing officer finds out that partnership firm has been dissolved after doing the fraud, in that case, what happens? Assessing officer will do the assessment as if no dissolution has taken place. All the partners are split apart, nothing relevant. Assessment shall be done without assuming that dissolution has been done. Second thing, every person who was a partner at the time of dissolution shall be jointly and severally liable for all the acts of the firm since incorporation. Since incorporation, whatever the acts that have been done, whatever the liabilities that have been done, this single partner would be held liable. These single partners, few partners will be held liable. So if on the date of the dissolution, it was found that firm has been dissolved because of fraud, whoever the partners are there, they shall be held liable for all the acts of the firm since incorporation. That's it. Partnership firm is this much only. See, partnership firm is not a difficult topic. Difficulty in a topic arises only if it is merged with NAA. It is merged with other topics like AMT. This is only what makes difficult. Individually, this topic is not difficult at all. Taxation of a cooperative society, we have already discussed tax rates for cooperative society. BAT, BAE also we have discussed. ATP we have discussed yesterday. Here only one point we have. If a cooperative society is a housing cooperative society, people come and people go. These members pay incoming and outgoing fees. Lawmaker says that this is an exempt income because of principle of mutuality. Local authority. See, if there is local authority, in that case, whatever the income local authority earns, that is absolutely exempt. Only one income of local authority is taxable. And what is that income? If local authority sells any asset other than water and electricity, whatever local authority sells to outside jurisdiction. For example, if Indore local authority sells any of the helmets to Mumbai, then in that case it will be taxed. If helmets are sold in Indore, no provisions, no taxability. If water and electricity sold anywhere in the world, no taxability. Only the assets other than water and electricity sold outside their jurisdiction is taxed. And what is the tax rate for a local authority? 30%. I personally doubt it has not been asked from multiple attempts. I mean, it has never been asked. One day it will be asked and you might not remember. So it always take care. 30% is the tax rate for local authority. Then we have AOP BOI. I have made a shortcut for AOP BOI. If you would request, sir, please share the shortcut with us. I will share that. If you ask, sir, please share the shortcut, I will share that shortcut with you all. If you will say, sir, please, we want shortcut, we want shortcut. Shortcut, shortcut, shortcut. Sir, please give us a shortcut. See, this is the AOP taxation, a chart that summarizes your entire AOP taxation in just few pages. I mean, in a single page actually. This chart summarizes your entire 44 or entire AOP taxation. Entire AOP taxation. Let's do it. See, AOP is a group of people where members are there. Correct. Members are there. First thing, first of all, AOP pays any interest or remuneration to the member is always disallowed. AOP is paying any interest remuneration to members is disallowed. In partnership firm, 12% was allowed. In partnership firm, any remuneration paid was allowed, but here it is not allowed. It is clear cut disallowed. Clear cut disallowed. Always disallowed. Now, what if AOP's share is not known? AOP's share is not known. Members are sorry, AOP has members and share is known how much each member holds. Each holds 33%, each holds 35%. What happens? What happens, sir, in case shares of members is known? Then in that case, you have to check whether all the members are having total income up to basic exemption limit or not. Two steps. First of all, share should be known. Second thing, income of all the members up to basic exemption limit. Then what will happen? AOP will pay taxes as per slab rate only. What slab rate? Up to 4 lakh, no tax. 4 lakh to 8 lakh, 5%. 8 lakh to 12 lakh, 10%. 12 lakh to 16 lakh, 15%. 16 to 20, 20%. 20 to 24, 25%. More than 24, 30%. Same slab rate that we have shall apply. Sir, if AOP pays taxes as per slab, then special income of AOP will be taxed at special rates only, like capital gain income, whatever tax rate we have, special rate will apply. Simple fundamental. What if share of member is no share of member is known, but if any of the member has income more than basic exemption limit, if any of the member has income more than basic exemption limit, then what will happen? Sir, AOP will pay taxes as per MMR. Or if share is not known, then again AOP will pay taxes as per MMR. Now, what is MMR? Sir, MMR as per old regime is different, and as per new tax regime 115 BAC is different. How do we learn that? As per old regime, it is 30 plus 37 plus 4. As per BAC, it is 30 plus 25 plus 4. How do we learn this MMR? Try speaking after me. 3, 3, 4, 3, 3, 3, 4, 3, 3, 4, 3, 3, 3, 4, 3, 3, 4, 3, 3, 3, 4. 3, 3, 4, 3, 3, 3, 4. Like this, you have to learn. 3, 3, 4 is nothing but 30 plus 37 plus 4. 30 plus 37 plus 4. 30 plus 37 plus 4. Simple it is. Yes, Janvi, that is the point. That is the point. I will come to that point. I will come to that point. See, if AOP for pays tax under old tax regime, then 30 plus 37 plus 4 will be surcharged. If AOP pays tax under BAC, then in that case, 30 plus 25 plus 4 will be charged. Remember, if AOP pays tax with MMR, then every income, even which is taxed at special rate, it shall be charged at MMR. If AOP pays tax with MMR, then every income which is charged to taxes at special rates also shall be taxed at MMR only. Fair enough? Fair enough? Yes, sir, fair enough. Now, some logical pointers I want you all to process. Okay? If AOP pays any interest remuneration, it is disallowed for AOP. Yes. That means, can I say AOP has already paid taxes on the interest and remuneration to the members? AOP, whenever it pays any interest remuneration to the members, AOP already it is always disallowed for AOP. Now, so AOP has already paid taxes on that. Since AOP has already paid taxes, it should be exempt in the hands of the members. Lawmaker says that if AOP has paid MMR now, taxes at MMR, then any interest remuneration is exempt for the member. Any interest remuneration is exempt for the member. Let me take an example for you to illustrate. For example, there is an AOP. There is an AOP whose income is 45 lakh rupees. Interest paid is 9 lakh. Remuneration paid is 24 lakh. And after that, profit remains as 12 lakh rupees. This is how AOP structure is. Case number 1, we have Jassi, Mohit and Divakar. Let's assume Jassi has 4.2 lakh of income. Mohit has 3.5 lakh of income and Divakar has 3 lakh of income. If you take out now, whether share is known, sir, we assume that share is equal, it is known. But whether all members have income more than basic exemption limit or up to basic exemption limit, right answer is no. Jassi has income more than basic exemption limit. Jassi has income more than basic exemption limit. In that case, what will happen? If Jassi has income more than basic exemption limit now, then AOP will pay taxes as per MMR. This 12 lakh of profit, disallow interest, disallow remuneration, whatever the profit turns out to be on this profit, 30 plus 25 plus 4, that is 39% will be charged, that is 17.55 lakh taxes would be charged. Flat MMR tax rate would apply. And since flat MMR tax rate is there, whatever interest, profit, remuneration is distributed, it is exempt in the hands of the members. Very simple it is. It is exempt in the hands of the members if AOP pays taxes as per MMR. But what if, sir, AOP pays taxes as per slab? Then what happens? Sir, interest, remuneration, profit is not exempt for the members. It is not exempt for the members. Sir, it is added to total income first. It is first of all added to total income of the members. Then taxes, surcharge, education cess is considered including such share, and then rebate under section 86A is given to the AOP, that is total taxes into AOP share upon total income. This is amount of relief. This is the amount of rebate that AOP gets. Sorry, this is amount of rebate that members get. How things happen? Let me take the same example. Profit 45 lakh, interest remuneration 9 lakh for 24 lakh, and profit 12 lakh rupees. Case number 2. Jassi has income of 3.9 lakh, Mohit has income of 3.5 lakh, Devakar has income of 3 lakh rupees. All the incomes share, member shares is known, share is known. AOP is paying taxes, share is known, all the members have income up to basic exemption limit. So in that case, what will happen? Sir, AOP will pay taxes as per slab only. AOP will not pay taxes as per MMR, they will pay slab. But what will happen to member? So whatever the interest, remuneration, profit is received, it will be added to the income of the member. Interest, remuneration will be added to the income of the member. Total income of member would be computed, and on that total income, taxes would also be computed. Total income would be computed and taxes would also be computed. And later on, what will happen? Sir, he will get a relief. Taxes amount into AOP share, whatever it was, divided by total income in that ratio, 15 out of 18.9. This is the ratio in which a relief would be given, a rebate would be given, and final tax payable would come out. Final tax payable would come out in this manner. Seems fair? I hope you understood that whenever AOP pays tax as per slab, then this income is included in the hands of the member and members get rebate. But if AOP pays tax at MMR, then this income is absolutely exempt. Now question arises. What if, sir, a company is a member of AOP, a cooperative is a member of AOP? The fact is, for a company, there is no slab rate available. There is no basic exemption limit. That means when a company becomes a member of AOP now, there will always be a member whose income is above basic exemption limit, whose income is always more than the basic exemption limit. In that case, what would happen? In that case, what would happen? Entire income of AOP would be taxed at MMR only. Entire income of AOP will be taxed at MMR. Entire income. So there is no relief to anybody. Entire income of AOP will be taxed at MMR only. And that is why whatever the interest remuneration, if a company receives now from AOP, it is absolutely exempt. If you are a member in a company, sorry, if company is a member of AOP, then whatever the interest remuneration this company receives now from AOP, it is always exempt. Therefore, MAT is also not applicable on this. If you remember, I will tease this. I tease this thing in MAT. MAT is also not applicable on this. This was about AOP. One more thing to be discussed. See, sometimes what happens is AOP pays interest to members. It is disallowed. We know that it is disallowed. But sir, what if AOP pays interest to the relatives of a member? For example, wife of a member, HUF of member, then it is allowed. Second thing, what happens sometimes now? Sir, AOP receives interest from members and pays interest to member. Receives the interest and pays the interest. Receives the interest, pays the interest. Receives the interest, pays the interest. Then in that case, what happens? If AOP receives the interest and pays the interest simultaneously, now, in that case, net interest paid to member is only disallowed. Whatever you should know in AOP has already been covered in just the one page. In just one page, very logically, very beautifully, with a very nice full handful example, I have covered this topic. Got clarity, sir. Thank you. Most welcome. Come on to topic number 34, that is minimum alternative taxes. Minimum alternative taxes. Or with humbleness, with politeness, I call it MAT, or everybody calls it MAT. Every company, not just Small company, public company, private company, government company, foreign companies, dormant company, one person company, every kind of company. Every kind of company has to comply with MAT. Now, how much MAT compliance every person has to do? You have to calculate taxes as per regular provisions of Income Tax Act. Whenever you consider taxes, now you have to consider taxes plus surcharge plus education cess. Taxes plus surcharge plus education cess you have to compare. And you have to offer 15% of the book profit. It's not just 15%, but 15% plus surcharge plus applicable education cess. And we have to compare, and higher of two is to be paid. So normal income tax, including surcharge, including education cess. Similarly, 15% of book profit, including surcharge, including education cess, is to be added. Whenever, whenever you consider surcharge, how do you consider? Sir, you consider surcharge based on book profit. Here in MAT, you don't consider total income, you consider book profit. What is book profit? Sir, if we will understand, but if book profit is up to 1 crore rupees, na, no surcharge is added. But if book profit is more than 1 crore rupees, na, then 7% for a domestic company and 2% for foreign companies added. If book profit is more than 10 crore, then 12% for domestic company and 5% for a foreign company is added. Fair enough. Once we add surcharge, 4% education cess is added, and after that, the MAT profits come out. 15% of the book profit. 15% means 15% plus surcharge plus education cess. You have to compare. Now, what is book profit? The book profit is nothing but profit as per Schedule 3 of Statement of Profit and Loss. Of Profit and Loss of the Companies Act. Whatever Companies Act profit and loss you make. In that Schedule 3, Profit and Loss of the Companies Act. No. Profit and loss. Okay, Companies Act, Schedule 3, profit and loss. See, in that profit and loss, whatever the profit is there, na, that is nothing but normal profit. In that profit, you have to make 28, or I should say 24 adjustments. You have to make 24 adjustments, because 4 adjustments are always irrelevant. They are never tested, and they will never be tested. Okay. So there are 24 adjustments you have to do. What 24 adjustments you have to do? Let's understand one by one. For example, if you have debited any kind of dividend expense or proposed dividend to the P&L, should this be allowed? Just think of it. You have debited dividend expense to P&L. Should this be allowed to reduce your profit? Right answer is no, sir. So it will be added back. It will be added back. If you have debited any kind of dividend expense, it will be added back. If you have taken subsidiaries losses in your books of accounts to reduce your profit, do you think that government is going to allow that? Right answer is no now. Such profit shall be adjusted and such profit shall be added back. If you have debited any income tax paid provision, anything, income tax paid provision, surcharge, interest, late fees, anything income with respect to income tax, advance tax, TDS, it is always added back. This is a disallowed expenditure. Late fees and TDS is allowed in one case, otherwise every other income tax expenses added, provision, everything is added. Next point we have, sir, sometimes we have provision for diminution in value of asset. For example, provision for bad debt, provision for loss and loss in investments. Every such thing is not allowed. It will be added back. If you have any unascertained liability, it will also be added back. So these 5 adjustments are very simple. These are to be done, always to be done. What are the other adjustments? Let me try. See, if you have debited deferred tax expense to P&L, deferred tax P&L, deferred tax to P&L, will this be added? Sir, if you have debited deferred tax expense to P&L, it will be added. For sure, it will be added. Deferred tax expenditure is not allowed. It is below the line item. It is not allowed. Similarly, if you have deferred tax income, if you have deferred tax in credit side, deferred tax in the credit side, it shall not be charged to taxes. It shall be taken off. It shall be taken off. It shall not be charged to taxes. If you have any deferred tax income, it will not be charged to MAT. It will not be charged to. Similarly, if you have any exempt income is not subject to MAT. Remember, exempt income is not subject to MAT. So you shall take it off. Similarly, if you have any expense with respect to exempt income, now such expense shall also be added back. It shall be disallowed. If you have any share of income from AOP, right now we studied this point. Right now only we studied this point. Sir, for example, if I have income from AOP, A company having any income from AOP. So AOP must have paid taxes at MMR only. If we receive any income from AOP, it should be exempt in our hands. So if it is exempt in our hands, why would MAT be applicable now? So we shall take it off from here. And any expenses relating to earning that income shall also be disallowed. It will be added back. Simple points. See, if you remember, there is a section called 115 BBF. Section 115 BBF says that if you have done royalty, if you receive royalty in India for patent developed registered in India, in that case, such royalty is taxed at 10%. If royalty is taxed at the rate of 10%, in that case, what happens? Sir, we should not be charged to MAT now. If it is taxed only at 10%, why MAT should be charged? In that case, it shall be reduced. MAT will not be charged. If you have any expenditure for earning the royalty, that shall also be disallowed. Fair enough. If you are a foreign company, if you are a foreign company who has certain incomes which are taxed at a percentage lesser than 15. For example, foreign company sometimes earns dividend tax at 10%, sometimes earns interest tax at 5%. There are many other incomes of the foreign company which are taxed at a lower price. Then MAT should not be charged now. Lawmaker says in that case it shall be reduced. Any income from the MAT shall be reduced. Book profit shall be reduced. Similarly, any expenditure earned to earn that income, any expenditure incurred to earn this income now which is taxed at lesser than 15%, it shall be added back. These 4 pointers you can cut down. These are with respect to business trust. I personally don't think it is relevant. This says that if there is a company who has shares in other company and shares of the other company are taken off and you got shares of business trust, so any notional gain or loss on exchange is not charged to MAT. Any actual gain will be charged to MAT. This is the 4 points. Otherwise, these are not relevant. They are not relevant at all. If you have debited any reserves through P&L, if you have created any reserves through P&L, it shall not be charged to MAT. It will be added back. I mean, it will not be allowed. It will be added back. Similarly, if you credit P&L with reserves and those reserves have been created out of P&L only, in that case, sir, it is not charged to MAT. We shall take it off. Any depreciation debited to P&L, any depreciation debited to P&L should be added back. Any depreciation would be disallowed. Any depreciation would be simply disallowed. But there is a catch. There is a catch, sir. What there is a catch? See, depreciation will be allowed excluding the depreciation on the revaluation component. So if I have an asset of 100 crore, I revalued it to 300 crore rupees. Depreciation will be only allowed on the 100 crore only. Before revaluation, whatever the asset is now, depreciation will be only allowed. Exclude the revaluation component and declaim depreciation. That is only depreciation you will get. Now there is a point which is a pure chotta panti. Let me tell you. Now there is a point which is a pure chotta panti. Let me tell you. Sometimes what happens is now you revalue the assets during the course of your regular business. Now you revalue the assets. How do you revalue the assets? How do you revalue the asset? Let me tell you the accounting treatment. There is an asset appearing in balance sheet. For example, 50 crore. You revalued it to 30 crore, and whatever the profit is there, you revalued it to 80 crore. So whatever the profit is now, you never took it to P&L, rather you transferred it to a revaluation reserve appearing in SOKI or appearing in general reserves or reserves. So 30 crore is appearing in reserves. One day you sold this asset. How entry will be passed? Bank account debit 80 crore to asset 80 crore. And what this revaluation will go? Revaluation debit to general reserves 30 crore. That means without doing anything, you saved MAT on this 30 crore. You saved MAT on this 30 crore because this should have gone to P&L. Whatever revaluation balance is there, that should be transferred to P&L. And MAT is charged on that. Whenever you sell any asset, then profit on revaluation is transferred to P&L and you charge tax on that. But as of now, there is no MAT, there is nothing transferring to P&L because you have done a pure accounting adjustment. In that case, in that response, provision says balance in revaluation surplus on retirement of an asset if it is not credited to P&L. If you have any balance of revaluation with respect to any asset and that asset is sold, then ideally you should take this revaluation balance to P&L. If you don't take it, add it during the MAT calculation. Similarly, sometimes balance is withdrawn. Balance from revaluation surplus is withdrawn. In that case, what happens if balance from revaluation surplus is withdrawn? Now, take that or take the depreciation on revalued component. Whatever the revaluation is taking now. On that revaluation component, whatever the depreciation is there, take that. Whichever is lower shall be reduced. This is a technical point. I am just asking you to learn the formula a day before exam. Only formula is going to help. Understanding concept is not going to help. What I mean is, whatever the revaluation surplus has been credited to P&L, take first thing. Second thing, whatever the depreciation is on the revaluation component, take that. Whichever is lower shall be reduced while calculating MAT, and this will give you the final conclusive answer. Then we have, if your profit includes profit of a sick industrial unit. Sick industrial unit is a sick industrial unit as per tribunal. Then only you can call it sick industrial unit. If your profit includes any profit from sick industrial unit, that shall be taken off. Then what do we have? See, if you have brought forward business losses, if you have unabsorbed depreciation, then lower of two, total of brought forward losses of all the years, total of unabsorbed depreciation of all the years shall be taken, and lower of two shall be reduced. At last, brought forward losses and unabsorbed depreciation of the company. Brought forward losses and unabsorbed depreciation of the company. What does this point says? If a company has been selected for insolvency proceeding under section 7 or section 10 of IBC, or if a company whose board of director has been suspended under 242, in this case, brought forward losses plus unabsorbed depreciation shall be allowed. Brought forward losses plus unabsorbed depreciation shall be allowed. Normally, brought forward losses total, unabsorbed depreciation total, whichever is lower is allowed. But brought forward losses plus unabsorbed depreciation shall be allowed if the company is under insolvency or company's board has been suspended. So these are overall 24 adjustments. Can you all speak out? 24, 20, 28 only we studied. We studied 28 only. Can you all recall? See, I don't see what happens is now. You only have to do this 28 adjustment. No extra adjustment is going to be asked. And even if it is asked, you have to ignore. For example, your profit includes profit from 10 AA. Shall we take it off? Shall we take it off? Right answer is no. You have debited of penalty for infraction in law. Shall we add it up? Right answer is no. Sir, interest is debited to P&L, not paid up to ROI. Shall we add it up? No, Baba, no. These are things are not added. These things are not added. Okay. What are the 28 adjustments? Just repeat after me. Okay. Just repeat after me. Or shall we write it once? Shall we write it once? Because writing will help a lot. For sure, writing will help a lot. First of all, deferred tax expense added, deferred tax income reduced. First thing. Second adjustment we have, what is the second adjustment? So depreciation added, depreciation reduced, excluding the revaluation component. Third thing, AOP income take off, AOP expenses add back. Then we have royalty income take off, which is taxed at 10%, royalty expenses add up. Fifth, if you have any exempt income, take it off, expenses on exempt income add back. If you're a foreign company's income which is taxed lesser than 15% shall be taken off, expenses on foreign company shall be added up. So then we have seventh one is revaluation surplus transferred to P&L. Any revaluation surplus transferred or depreciation on revaluation component lower of 2 shall be reduced. What did I miss out? Did I miss out anything? Then we have 4 with respect to business trust, business trust, business trust, business trust, and business trust. These 4 are not to be studied. 9th, okay. 10th, what we have? We have one more thing. Let's see 11th. Income tax. Up till now, 20 adjustments are there and 8 more adjustments. Income tax, subsidiary losses. Then we have unascertained liabilities. Then we have dividend, reduction in value of assets. Reduction in assets. Then we have a 16th sick industrial unit. Then we have unabsorbed losses, unabsorbed depreciation, wood and buffalo, whichever is lower. And then we have um, IBC or 242 EUD plus BFLO. This shall be allowed. One thing I missed out, maybe exempt income revaluation, foreign company exempt income AOP, reserves one. Yes, 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 reserves. If you have taken any reserves, then add back. If you have credited in reserves, we shall take it off. These are the 28 adjustments to be done. See, whenever doing these 28 adjustments, always make sure, wow, sir, wow, wow, so simple. Wow. People are able to use the same accent I do. Thank you so much. Ha. Whenever you do the adjustment, now these adjustments are done only in P&L as per Companies Act. Okay? But there are some companies who do not follow Companies Act. What companies do not follow? Sir, for example, banking companies, they follow their Banking Regulation Act. Insurance company follow their Insurance Regulation Act. In electricity companies have their own respective acts. So you shall take profit as per the respective acts. Here you are not going to take Companies Act profit. Now, under MAT, now sometimes you are given with provision for gratuity. Oh my God. Provision for warranties. Oh my God. Provision for leave encashment. Oh my God. So this should be disallowed. This should be disallowed. Right answer is it should not be disallowed because we are not studying income tax. Last thing, wherever we have heard the word depreciation, losses, unabsorbed depreciation, unbrought forward losses, everything is as per Companies Act. See, in option number 4, point number 4, we study depreciation. We study depreciation here as well. In last point, we had brought forward losses. We have unabsorbed depreciation, brought forward losses, unabsorbed depreciation. Wherever the word unabsorbed depreciation, brought forward losses, current year depreciation has been given, it is as per Companies Act, not as per Income Tax Act. Now, moving forward to as per MAT, as per Indies, MAT as per Indies. How do we proceed further with MAT as per Indies? MAT as per Indies. Listen, as per accounting standard profits, whereas as per Companies Act profit, there is a minor, sorry, as per accounting standard profit and as per India's profit, there are two differences. Both of them show the net profit, but as per India's, now two things extra are there. First of all is OCI reclassifiable, some other comprehensive income that are reclassifiable. Sooner or later, these incomes are going to be reclassified as P&L, reclassified under P&L. The second thing extra India's possesses is OCI NR. There are certain incomes which are never going to be reclassified to P&L, and this will go to general reserves when the conditions for earning are fulfilled. Okay? What did I say? AS or India's, both the shows net profit. But in AS, we have two extra things. In AS, we have, sorry, in AS, we have two extra things. First of all is OCI R and the other one is OCI NR. Okay? Two things extra we have. Sir, what happens to OCI R? Sir, nothing. OCI R is to be ignored. The way you are ignoring the smaller chapters. Sir, we are not ignoring. We saw your marathon. We are not ignoring. Malab, the way normal people are ignoring the smaller chapters is the way you have to ignore the OCI R. Other comprehensive income which is reclassifiable, you have to absolutely ignore because whenever it will be reclassified, you will be paying MAT on that. But those which are not reclassified, you have to consider that, sir, provision says if it is not reclassified now, always charge MAT in current year only. If any income is OCI NR, pay MAT in current year only. Pay MAT in current year only, except two case situations. Two situations. What are two? If there are fair value changes in equity instrument as per India's 109. India's 109 has gives you one time option to recognize equity instruments at OCI NR. So if you have any fair value changes now through OCI NR, this is not charged to MAT in the current year. Similarly, any revaluation surplus on the asset, it is also not charged MAT in current year. But on these two, MAT will be charged in the year in which it is sold. Asset is transferred in that year, MAT will be charged. What did I say? I said two things. First thing, OCI NR always in current year, but revaluation surplus not in current year. Changes in fair value of equity instruments, not in current year. Both of them will be charged to MAT in the year in which it is transferred, disposed of, sold. Okay. Similarly, for loss as well, any OCI loss will be reduced current year only. But any loss on revaluation loss, any changes in fair value of equity instruments loss will not be reduced in current year. It will be reduced when it is sold, when asset is sold. Did you understand this point? Every asset is charged to MAT right now only. Every OCI NR income is charged to MAT right now only. Expenses are allowed in current year only. But changes in fair value of equity instruments or revaluation surplus is charged to MAT when the assets are finally disposed of. Sometimes what happens is two companies demerge. For example, from Reliance, Geo Financial Services demerges. Now, if Geo Financial Services demerges, it receives multiple assets. These assets are to be recorded as fair value. As per Ind AS, we know that these assets are to be recorded at fair value. Now, see, at the time of demerger, what happens is, see, assets are transferred to resulting company. Resulting company might recognize these assets as at fair value. So there are fair value gains or losses. There is fair value gain or losses. Lawmaker says whatever the fair value gain or losses are there, these fair value gain or losses are not subject to MAT. These whatever gains you have now or whatever losses you have now, on recognizing these assets, these are not charged MAT. MAT is not charged on these things. Not at all. This is what is mentioned here. Any amount debited to P&L, any loss if you have not debited to P&L on account of loss of recognition is added back. It is not charged to, it is not allowed in MAT. Any item credited, any gain credited to P&L on account of demerger is not charged to MAT. You shall take it off. So gain is not charged, loss is not allowed if you have any gain in demerger. Sir, what happens is, see, whenever you comply Ind AS for the first time, whenever you comply Ind AS for the first time, for current year financials, you have to prepare as per Ind AS. Preceding years closing financials, you have to prepare as per Ind AS. Preceding years opening financials, also you have to prepare as per Ind AS. If you remember, you have to do that. The preceding financial year's opening balance sheet date is called convergence date. Correct. On convergence date, you have to comply with every asset. Every asset is to be restated at as per Ind AS. So there is gain or loss in the restatement, retrospective restatement you do. There is gain or loss. It is possible that you might have gain or loss on retrospective restatement of these assets. It is possible. You might have gain or loss on considering them. Lawmaker says that whatever it is called transition amount actually. Whatever the transition amount is there now on convergence rate on compliance with Ind AS. Whenever you comply with Ind AS, you have to retrospectively restate your assets, because of which you might have profits, you might have losses as well. Whatever profits you have or losses you have on compliance with Ind AS, it is called transition amount. On this transition amount, MAT will be charged. On this transition amount, MAT will be charged. If there is profit, then it will be added back. If it is loss, it will be reduced. But transition amount is charged to MAT in 5 equal installment. Therefore, one-fifth profit is taxed, one-fifth loss is reduced. Sir, what is the transition amount? See, transition amount is very simple. Lawmaker says whenever you have an other equity balance, just check out the other equity balance. In that other equity balance, take off five things. Any capital reserve, it is not transition amount. Any security premium reserve, it is not transition amount. In other equity, if there is any item which is OCI reclassifiable, which will be transferred to P&L later on, so this shall not be charged to MAT. If there is revaluation surplus on assets, it will not be charged to MAT today, rather it will be charged to MAT in the year in which asset is finally sold. Changes in fair value of equity instruments, take it off, it will not be charged to MAT in current year, rather it will be charged in the year in which asset is sold. Any PP or intangible, any investments in subsidiary and JV, and at last any translation difference in foreign operations. These 4 or 5 things are to be removed from other equity balance, and this will give you the transition amount. Of this transition amount, one fifth is charged to MAT. Remember, if you are a unit located in IFSC, then MAT rate applicable for you is not 15%, it is just 9%. Sometimes what happens is there are many companies who are not required to comply with MAT. They are not required, so they are not required to comply with income tax because their income is always exempt. They claim 10 AA, they claim 35 AD, so they are not required to comply with income tax. Many a times their income tax is zero. In that case, now they might have to pay advance tax as well as per MAT. And if they don't pay advance tax as per MAT, now then 234A, B, C interest will be applicable to them. MAT is not applicable for life insurance company. MAT is not applicable for any company who opts for BAA and BAB. MAT is not applicable for those presumptive taxation company which are covered under 44 series. MAT credit, see what happens is whenever your income tax is 5 lakh and tax as per MAT is 8 lakh. So whatever extra tax you have paid as per MAT, this extra would be given to you as credit. You can carry forward this extra credit for whatever extra credit you have. So whatever extra you have paid, now this will be allowed to you as MAT credit. This can be carried forward for 15 years. For example, you convert yourself into LLP, then this MAT credit shall lapse. How this MAT credit is utilized, always understand. Sometimes, for example, our income tax was 5 lakh, MAT was 8 lakh, so 3 lakh was credit. Next year, Uno reverse happened. For example, next year income tax is 7 lakh rupees or MAT is 5 lakh rupees. So extra 2 lakh now, whatever over and above MAT is, you can pay from MAT credit as well. So this MAT credit can be utilized for 15 years. Fair enough. This extra shots you might ignore. Next topic, AMT. What Janvi says, one-fifth is allowed from the financial year of conversion date or from the year in which Ind AS is applicable. See, Janvi, important thing is it is a profit. Profit is charged to MAT now. First, if you are applying Ind AS in current year, okay? If you are applying Ind AS for the first time in current year, so MAT will be charged from current year only. But figure will come from last year's opening balance sheet. Last year's opening balance sheet will tell you the transition amount. That transition amount will be taxed from current year, the year in which you apply MAT for the first time. Okay? The year in which you apply Ind AS for the first time. Alternate minimum tax. Alternate minimum tax, AMT. See, for companies, we already know, Anna, that MAT is applicable. But for other than the companies, what they pay? If you are not a company, you are an LLP, you are a cooperative, then in that case, what you have to pay? You have to pay AMT. Lawmakers say that whatever your normal income tax plus surcharge plus education cess is, just pay that or 18.5% of adjusted total income. Sir, please can you kindly shut your accent? Okay, noted. Normal income tax you have to take or 18.5% of the adjusted total income. Now again here 18.5% might look lame, but 18.5% plus surcharge plus education cess is to be compared with normal provisions. Okay? Then only whichever is higher has to be taken. The point here is what is adjusted total income? Sir, mimicry. I don't know how to do mimicry. Okay? I don't know how to do mimicry. I just know how to make the lame jokes. Okay? Now, what is adjusted total income? Total income as per income tax provisions we shall take. Any 10 AA deduction taken shall be added back. Any 3580 deduction shall be added back. But if 3580 is added back, so depreciation shall be reduced as if 3580 was never allowed. That shall be reduced. Any chapter 6A part C deduction, that means 80 IA to RRB deduction will be added back. Remember, ATP is never added back. ATP is never added back. ATP is never added back. Remember, this will give you adjusted total income. On this, 18.5% is charged to MAT. Charge to AMT. AMT. AMT is not applicable on individual HUF, AOP, BOI, artificial vertical person whose adjusted total income is 20 lakh rupees. See, if you have adjusted total income up to 20 lakh rupees, then AMT is not applicable. AMT is not applicable to those people who do not have a tan double A. Just imagine yourself. You don't have a tan double A. You don't have a 35 AD. You don't have 80 IA to RRB. So MAT will not be applicable. Sorry, AMT will not be applicable at last. If you opt for a BAC, BAD, BAE, then AMT is not applicable. See, this is what happens. Your tongue starts to twist when you take very long lectures. Remember, ideally AMT rate is 18.5%, but for cooperative societies it is 15%, and for IFSC units now it is 9% only. If you are not required to pay income tax but you have to pay AMT, then in that case what happens now? You have to submit advance tax as per AMT. You have to submit advance tax as per AMT. 234 A, B, C, you have to submit advance tax as per AMT. And you have to get a CA certificate from CA certificate certifying the adjusted total income as well. What about AMT credit? Sir, AMT credit is as good as MAT credit only. If your normal income tax is 5 lakh, AMT is 8 lakh rupees, 3 lakh will be given to you credit. This credit you can use for 15 years. As simple as it can be. That's it. That is it. Come on to next topic, that is buyback. Now how buyback runs? Very simple. Let me take an example. You will understand it very easily. Rahul has 100 shares. 100 shares of Reliance bought at the rate of 2000 rupees each on 1st April 2025. Company proposed a buyback on 1st November 2025 at 2500 rupees per piece. Whenever buyback happens, money received by the shareholder is always deemed dividend. Company no treatment, but shareholders receiving any money shall be deemed dividend. How the process will go? 200 shares, 2000 shares into 100 each. That means 2 lakh will be the deemed dividend component. Sorry, this is the cost. No, sorry, my bad. This is the cost. Company paid 2500 now. So 2,50,000 will be deemed dividend. And whatever the cost of acquisition of these shares are, whatever the cost of acquisition, sir, what is the cost of acquisition here? 2000 shares on 100 rupees each. This cost of acquisition shall become the short-term capital gain. Because we have held for less than 1 year, it will be short-term capital gain because of this. Now, what will happen to the short-term capital gain? We can set this off against any other head of any other short-term capital gain later on. This will be short-term capital loss. You can set off the short-term capital loss from other incomes sooner or later in future. You can set it off. But see, this is a very vague treatment. I personally don't like it at all. Next topic, that is tonnage taxation. How tonnage taxation works. Understand. Before starting tonnage taxation, I want all of you to write a number, a mobile number. This is my personal mobile number. 70534229. 70534229. 70534229. 70534229. 70534229. Can you all write it once? I want all of you to write this once, at least in comment section. If you are watching live, then you should like, subscribe, and write. If you are watching recorded, then like, subscribe, hype, and then write. 70534229. 70534229. 7053. See, mobile numbers you can learn. This is also doable. 70534229. 70534229. 70534229. 70534229. You can learn this. Remaining two numbers are 00. 00 at last. 70534229. 70534229. Now, what happens with a buyback and with tonnage? Listen, tonnage taxation is very special in itself. Now, how it is special in itself, understand. First of all, if you are a shipping company, ठीक है, Indian company who is into shipping business and who has only one, at least one qualifying business, one qualifying ship. What is a qualifying ship? See, qualifying ship is nothing but a ship having 15 tons ton weight or more, 15 tons or more weight. This is a qualifying ship. You can opt for tonnage. Perfect. What happens when you opt for tonnage? See, qualifying ship also, and if you are an inland vessel, then too you can go for tonnage. It is an optional scheme. You might opt, you might not opt. What happens when you go for tonnage? Listen, whatever the daily weight you carry, based on that you are being given with a slab. Based on that daily tonnage, you have to calculate daily income, and the daily income has to be multiplied with number of days you are working. Daily ship having weight net tonnage has to be multiplied with the slab rate. This will be the daily tonnage income, and this daily tonnage income has to be multiplied with number of days this ship is operating. Very simple. Weight carried, then calculate total weight or total income of the day based on the given slab. And beyond this, what you have to do, you have to ship multiply it with number of days it is operating. Now, how to calculate? Let me take an example to illustrate. For example, a ship is carrying 42,325 kg. It is carrying 20 this much weight. Always understand this much weight it is carrying for 74 days in a year. 74 days it is operating. Fair enough. 42,000. Whenever tonnage weight is given, always take it in nearest 100. So it is 325, so we shall take 300. If this would have been 350, we would have taken 400. Simple. Of this weight, first 1000 kg, we have to offer 70 rupees per 100 tons. 70534229, 70534229. So first 1000 tons is 70 rupees per 100 ton. This will give us 700 rupees. Then next 1000 to 10,000. That means on next 9,000 kg, we shall take 70534229. Then we have to take 5 9,000 divided by 100 into 53. 4770. Next 10,000 to 25,000. That means on 15,000, we shall take divided by 100 into 4229 into 4229. 50,000 divided by 100 into 42. It shall be 6,300. And at last, so from 25,000 to 42.3 thousand, 42,300 minus 25,000, 17,300 divided by 100 into 29. 5017. Highlighting all will give us the daily tonnage income. Daily tonnage income. 700 plus 4770 plus 6,300 plus 5017 into 74 days. Since ship has been working for 74 days, so 1242238. This is the income of the ship. This is the final income of the ship. Wow, sir, wow. Easy peasy doable. Easy peasy doable. Sir, we can do it. We can do it. We can always do these type of question and try doing it once, because I personally think tonnage is important for your exams. I personally think that tonnage can be asked in exams, so always try doing this once. Now, tonnage shall be rounded off in nearest 100 always, as I have told you, tonnage is rounded off nearest 100. See, whenever you opt for tonnage income, you are not given any deduction. No deduction of any expenditure is allowed. No chapter 6 deduction allowed. No losses can be set off against this tonnage income. You cannot set off. Sir, if you opt for tonnage now, then MAT is not applicable on you. Along with that, sir, what is a qualifying ship? Sir, what is a qualifying ship? See, normally, sir, for foreign company or NR, no tonnage applicable. For foreign company into shipping, we have now. What we have? Sir, we have 44B. We have cruise shipping companies. Why will we give tonnage benefit to them? Why will we give tonnage benefit? We have 44B for them, shipping business. Now, what is a qualifying ship? Normally, every ship is a qualifying ship, but a seagoing ship is not qualifying ship. A fishing ship is not. A factory vessel, a river, a harbor or river ferries, a pleasure crafts, a ship that has gone for offshore installations. These are not considered as qualifying ships. Other apart from that, every ship is a qualifying ship. I personally think tonnage is important for your attempt. I personally think, I mean, instinct is coming. Okay. Later on, once you opt for 10 years, then you shall, once you opt now for tonnage, you shall continue to opt for 10 years. Once you opt out, then for next 10 years, you are not allowed. Maximum capacity utilization is 49%. Why this 49%? I really don't know. Maybe they don't want you to drown. Maybe they don't want your access utilization. Therefore, they have given 49%. At last, you have to maintain books of accounts and get yourself audited. See, tonnage scheme is given to you based on certain conditions. Remember, there are three types of terms used. First one is book profit. Book profit is nothing but profit as per P&L Companies Act. There is a concept of relevant shipping income. What is relevant shipping income? Relevant shipping income is nothing but PGBP. And third thing is tonnage income. Tonnage income is nothing but income as calculated above. So these are the three terms used: book profit, relevant shipping income, and tonnage income. Lawmaker says whatever the book profit that you have, out of that book profit, at least 20% shall be transferred to tonnage reserve account. Sir, what will we use this money for? You have to buy a new ship within 8 years. And if you transfer that ship within 3 years now, then proportionate amount shall be taxable in the year of transfer. Sir, we will not create reserve. What they can do, if you don't create reserve for 2 years now, then tonnage scheme would become invalid for you all. Sir, we will create a shortfall. We will not deposit 20%. 20% is too much. We don't deposit 20%. Lawmaker says, okay, if you do any shortfall now, then current that year's relevant shipping income, 20% is to be minimum created. If you create 1-2% shortfall, then 20% out of 20%, 2-3% will be taxable. If you utilize it for some other purpose, for example, this money should be used for shipping purpose only, buying new ships. But if you utilize it for some other purpose, in that case, what happens? Sir, amount of misutilized upon total reserves created, that shall be taxed. Whenever you want to go for tonnage, now you may have to apply for its application to Joint Commission. You have to apply for tonnage. Okay. Within 3 months from the incorporation, you can go, or within 3 months from getting a ship, from getting a qualifying ship, you can apply for tonnage. If your entity located in IFSC, then you might apply after getting 80 LA. After completion of 80 LA, you might apply. After that, sir, whenever you apply, within 3 months from the end of the quarter of the application, Joint Commissioner either approves your request or rejects your request. This is all about your tonnage, my dear friends. Moving on to business trust. Business trust. I don't know how long the session is going to be, but this is going to be very valuable session. I mean, we are not teaching like as if I'm teaching a marathon. It feels like I'm teaching a regular revision or regular power batch. I'm telling. See, there is a concept of business trust which is run by unit holders. Business trust invests in a company which is a SPV. Now, this business trust can be in the form of a real estate investment trust, and this can be in the form of infrastructure investment trust, REIT or InvIT. It can be in any of the form, any of the two form it can be. The business trust might be listed, might be unlisted as well. Businesses might be listed, might be unlisted as well. Okay. If it is listed, then period of holding is 1 year, and long-term capital gain is taxed at 12.5%. Short-term capital gain is taxed at 20%. Of course, 1.25 lakh benefit would be given because this is listed securities. If it is unlisted, then period of holding is to be checked for 2 years. Long-term capital gain would be taxed at 12.5%, and short-term capital gain would be taxed at slab. Basic capital gain provisions. How taxation would work? See, this company, we don't have to study anything. No taxation of company is to be studied. Why no taxation of company is to be studied? Because this company is company. This company would pay tax at that of 25%, 30%, or BAA, that is 22%. Companies taxation we have studied now in entire PGBP. We have studied this only. Why we need to study this again? We don't have to. We don't have to. We really don't have to. How taxation for business trust would go, let me help you out with simple things. If you want to draw this, you can draw this. Otherwise, I have covered this in Bhula series as well. You can refer that. See, business trust can earn some incomes from SPV. It can earn some interest from SPV. It can earn some dividend from SPV. It can earn some other income from SPV. Business trust earn whatever it earns from business trust, whatever business trust earns from SPV, whatever it earns from SPV now, it is absolutely exempt. It is absolutely exempt. It is absolutely exempt. Fully exempt. Fully exempt. No questions attached. Fully exempt. If business trust invests, sorry, business trust earns any rental income from self-owned properties, it is also exempt. Exempt. Or I should not cut it down because cutting exempt would might create a confusion. Exempt, 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 exempt. Sir, what this business trust can have is this business trust can have capital gain as well. Because it is holding the units of SPV, it might have capital gain. It is holding some properties as well, so it might have capital gain. Sir, if capital gain is 112A, then 12.5% over 1.25 lakh. 111A, 20%. 112, 112, 12.5%. Like regular capital gain. If this earns anything extra, any other income, maybe because short-term capital gain, maybe on developmental properties, maybe interest income from outside, any other income if this business trust earns now, it is taxed at MMR. And MMR is by default 30 plus 25 plus 4. And if it goes for old regime, then 30 plus 37 plus 4. This is how business trust is being taxed. That's it. Taxation of business trust is this simple only. Taxation of business trust is this simple only. Any income received by the business trust from SPV is exempt. Be it interest, be it dividend, be it other income, it is always exempt. Any rental income earned by business trust from its self-owned properties, it is also exempt. Absolutely also exempt. Similarly, any capital gain earned, taxed at regular rates, 112A, 111A, 112. At last, any other income of the business trust is absolutely taxed at MMR. Any other income, short-term capital gain on developmental securities, developmental properties, any interest on unlisted bonds and debentures, any other income is taxed at MMR only. I hope taxation of business trust is clear to you all. How business trust is being taxed. Very simple it is. Now, when this income is transferred to unit holders, I have to tell you the taxation of that, and that is important and that is more technical. Business trust enjoys a pass-through status. Whatever business trust earns, now it distributes to the unit holders. And there is a small function that government follows. It has to be either taxed in the hands of business trust or unit holder. That's it. It has to be either taxed in the hands of the business trust or unit holder. In one of the hands, income has to be taxed. Now you tell me, if income has already been taxed, if this other income is distributed by business trust, if other income has been distributed by business trust, this will be exempt in the hands of the unit holder. Exempt in the hands of the unit holder. Similarly, any such capital gain distributed to the unit holders, it shall be exempt. If these incomes are distributed, for example, interest income is distributed, if dividend income is distributed, if rental income is distributed, then it has to be taxed because it is exempt in the hands of the business. It will be taxed. How it will be taxed? Listen, resident, non-resident. Very simple taxation. Sir, anywhere resident will always be taxed at slab. Resident will always be taxed at slab. Resident will always be taxed at slab. Try reading it out like this only. That is, resident will always be taxed at slab. Resident will always be taxed at slab. Resident will always be taxed at slab. That's it. Any income from business trust which is taxable in the hands of the resident, it will always be taxed at slab. And TDS rate is always 10% for resident. TDS is 10%. There is no questions, no ifs, no buts. Very simple it is. But when it comes to non-resident, if any non-resident earns now, then for interest 5%, dividend 10%, this rental income slab rate 510 slab, 510 slab, 510 slab, and whatever the tax rate is, that is the same TDS rate. So TDS is 5%, here it is 10%, or here it is slab rate. That's it. Done with the taxation of business trust. Majorly done. Majorly we are done with the taxation of business trust. Did you understand? Was it easy peasy? Sir, it was easy peasy. Now I have to tell you some intricate pointers. I know it is easy peasy, but some intricate pointers are yet to be studied. Okay? What are those intricate pointers? Understand. What are those intricate pointers? Listen, this entire taxation is absolutely correct if SPV pays tax as per 115 BAA. Wow, sir, wow. Oh, nice, 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 nice. See, this taxation is absolutely correct if SPV pays tax under BAA, 115 BAA. But what if, sir, SPV pays tax under old regime? That means 25%. This SPV pays tax under old regime. Then in that case, now this dividend would become exempt. Dividend is exempt for every unit holder if SPV pays tax under section under old regime. Old regime. Fair enough. Fair enough. Fair enough. Fair enough. Fair enough, sir. We got this. There is another catch. Okay? Sometimes in a question, it would be given to your exam that total income that SPV has business trust has earned now is 17.32 crore rupees. It is possible that in one of the question, it would be given to you SPV has earned 17.32 crore. It is possible that they have given this. It is possible. If SPV has this much earned money, it has to be distributing this much only. But they might have distributed something extra, might be 20 crore. It is possible that it is distributing more than what it has earned. It is possible. They might give. These TOTA people's examiners might give some extra distribution. SPV earning very less people, very less earning, but distributing more than what it has. How do you deal with that situation? See, whenever SPV earns this much, total of all the earnings, if you do, it will be coming to 17.32. But distribution, when you check out now, you will see that distribution is 20 crore rupees. Sir, why there is difference? Sir, there is a difference because some incomes of SPV, like other income, is not told to you, and whatever other income is there, we shall assume it is exempt. How much other income is? 2.68 crore. 2.68 crore is the extra income that has not been told to us. See how business is distributing. It is earning and then distributing. Earning and then distributing. So we have been told that 17.32 business trust earns. But there are certain hidden earnings of business trust which is not told to us. That is why only it is able to distribute. How come it distribute 20 crore rupees when it has not earned? There must be some extra earnings. This extra earnings is nothing but extra money, some other income from SPV. This is the extra earning from SPV. If you didn't understand, rewind this video, you will understand. Rewind this video by 30-40 seconds, you will understand. Extra earnings from SPV, is exempt in the hands of the business trust. And when this extra earnings would go to unit holder now, very carefully listen, very carefully. When this extra earning would go to unit holders now, this would be taxed under 56 to 12. How much? How much? Sir, total distribution minus total earnings Total distribution is 20 crore. Total earning is 17.32 crore. That means 2.68 crore would be taxed in the hands of the unit holder. But sir, it is not directly taxed. Lawmakers assume that it is a kind of a repayment of the share capital. So a cost of acquisition. If somebody has acquired shares, units of business trust now, then cost of acquisition would be allowed. For example, 1.5 crore was the cost of acquisition. So finally, 1.38 crore would be taxed in the hands of the unit holders. 1.38 crore would be taxed in the hands of the unit holders. What did I say? Businesses earning less but distributing more. So whatever extra is being distributed now, this is nothing but repayment of share capital. This is repayment of share capital in the hands of the unit holders, and this will be taxed under 56 to 12. Business just earning, distributing beyond that is earning now. It is nothing but repayment of share capital. Repayment of share capital. This is 56 to 12. This is 56 to 12 for you all. In this entire process, of last portion now, TDS on this is not applicable. This is applicable to resident as well and non-resident as well. TDS on that is not applicable. So there are a lot of unit holders now. How that will happen? See how that will happen. Whatever extra is distributed now. For example, Kumar holds 1%. So for example, 1 crore is distributed. So 1 lakh would be your share of receipt, and 1 lakh, whatever your cost of acquisition is, you shall reduce that, and this will give you your share of 56 to 12. If there are multiple unit holders now, whatever extra these unit holders are getting, this will be shared by business trust, and that is what brings us to our next topic. Next topic, that is, whenever business trust earns anything, it shall share the information to the unit holders. This information shall be shared. Whatever the ratio, whatever the nature of the income is in the hands of the business trust, same nature and ratio shall apply to the unit holders. How much distribution has been done by the businesses, that shall be that shall be told to every unit holder. And the best part of all is, taxable under wages, they said this will go to IFOS. 56 to 12 will go to IFOS. This will go to IFOS. But every other income, for example, rental income for business trust goes to PGBP. So that rental income, if it is transferred to you, it will go to PGBP. Interest income earned by business trust might go to PGBP, then you have to offer such income under PGBP. If dividend income earned by business trust goes to IFOS, you shall offer under IFOS. This sheet of what proportion, under which head it should go, it will be shared to you by business trust. That's it. Nature proportion remains the same. Businesses is mandatorily required to file return under 139(4)(e). Now, if somebody has shares of a company and business trust forcefully acquires the shares of that company, and in return it issues the shares, it issues its own units, then any transfer is absolutely exempt transfer. We don't have to worry about it at all. Any else thing to be studied? Nah, done with business trust. Done with business trust. Done with business trust. Done. Business trust. Did you understand business trust? Did you understand business trust? Refer this video multiple number of times so you will understand. Okay? I have told you with grave depth. Okay? This is not the over and above information. This is the grave depth of a topic. Now, before starting investment fund, I want you all to write a word with me. What is that word? It is pitfall. Everybody who is watching live, everybody who is watching recorded, write a word called pitfall. How do we write it? Pitfall. Pitfall. You have to write this word pitfall. Why am I saying that? Just write it down. I will tell. Now, what is an alternate investment fund? Alternate investment fund can be of 2 or 3 types. Alternate investment fund can be AIF1, AIF2, and AIF3 as well. One is nothing but who invest in risky investment, SMEs, angel funds, These are AIF ones. AIF2 are normally relatively less riskier ones, invest in debt market, equity market, private equity funds. And AIF3 are hedge funds. We have studied specified fund in NR taxation, a specified fund. Day before yesterday in marathon, day one, we have studied this entire topic. Then this is called specified fund. AIF category 3 specified fund. Here we have to study AIF 1 and 2. Now, again for AIF as well, there are many unit holders and AIF invest in securities. Whatever income from securities, if they have a business income, they might have even have they might have capital gain income, they might have IFOS income. Only these are the possible incomes. AIF cannot have salary income. AIF cannot have house property income. Fair enough. So these are the three possible incomes that AIF might have: business income or capital gain income or IFOS income. This is the only possible income avenues they can have. And this will be distributed to unit holders only. This will be distributed to unit holders. Okay. Okay. Sir. Correct. Lawmaker says that business income is taxable for fund. And when this business income would come to unit holder now, it is exempt. This IFOS income is exempt for the fund. And when this IFOS income or capital gain income would come to the fund, it is tax unit holders, it is taxable. So business income is taxable for fund, but it is exempt for unit holders. IFOS cap gain income is exempt for fund and it is taxable for unit holder. Sir, so much confusion. So much of confusion. How do we learn that? This will be learned by the format I have told you. Pitfall. What does the word pitfall imply? Pitfall imply PGBP income is taxable for fund. PGBP income is taxable for AIF. PGBP income is taxable for AIF. PGBP income is taxable for AIF. You have to learn in that way. Once you are done now with that PGBP income is taxable for AIF, you will automatically understand that this income is exempt for unit holders. Once you will see that this income is taxable for AIF now, so other incomes would be exempt for AIF and this other income would be taxable. So with this pitfall, you will be able to learn everything. With everything, you will be able to learn. Now, how unit holders are being taxed? Unit holders are being taxed with regular provisions. Whatever cap gain is applicable, 112A, 111A, 112. Or if interest dividend earn, then slab rate. Non-resident also slab rate. Whatever it is, we got to know. Okay? We know. TDS rate applicable is 10%. But what about sir fund? What is the tax rate applicable to fund? See, if this investment fund is in the form of company, then tax rate applicable is 25%, 30%, or 22%. If this AIF is in the form of body corporate or LLP, then it is 30%. For firm, it is 30%. But sir, if it is in any other form, for example, AOP, it is in the form of individual, HUF, then this would be taxed at MMR. And by default, MMR is nothing but 30 plus 25 plus 4. This is how much this investment fund would be taxed. Investment fund are mandatorily required to file return under 139 4F. Any income. Acha, this investment fund are very chota people. These investment funds are very chota people. Let me tell you what happens. Try understanding this. Try understanding this. For example, dividend. Dividend is always IFOS. In the morning only we understood that dividend is always IFOS. Always IFOS. We already know that. Now, whenever dividend is IFOS, if dividend is earned by this investment fund on, say, 15th March, this will not be taxed in the hands of the funds because dividend is exempt for fund. Yes. It distributed this dividend to unit holders on 15th June 2026. So unit holders are willing to tax on in 26-27. So just imagine for 25-26, no tax on this dividend. Government received no tax. Are you understanding this point? Distributed in current year, fund received it, but fund distributed in next year. So for previous year 25-26, no taxation is happening. No taxation is happening. In this case, the lawmakers say that if fund earns any income In that case, even if they distribute or not, it shall be taxed in their hands. Even if they distribute or not, it shall be taxed in their hands. There are no questions attached. If fund earns anything, even if they distribute or not, it shall be taxed in their hands only. The ratio and proportion, the nature shall remain the same as if it was received by the fund. So if dividend is IFOS for fund, then the same shall be IFOS for unit holders as well. Carry forward of losses. See, fund has any kind of losses now, any kind of business losses, this can be carried forward by fund only. But if fund has any other losses, for example, IFOS losses like capital gain losses, in that case, fund shall first set off these losses, and whatever the losses are remaining, this can be carried forward by unit holders. This can be carried forward by unit holders. Sir, only carry forward is allowed if unit holder has been holding hold units for more than 12 months. If you have been holding units for more than 12 months, then only fund will give you the losses of IFOS and cap loss. If held for less than, cannot carry forward. At last, securitization trust. Investor investing in securitization trust giving the money. This money is exempt in the hands of the securitization trust. Every income is taxed in the hands of the investor at the normal rate. TDS rate applicable is 10% or rate in force for non-resident. That's it. So for securitization trust also, nature proportion shall remain same. If trust does not distribute the income, it is assumed it to be distributed on 31st March only. At last, information is to be shared with the department. Information is to be shared with unit holder up to 30th June of the next financial year. IT department, this information is to be shared up to 30th November of the next financial year. But investment fund has to ensure this information up to 15th June of the next financial year. That's enough. Enough. Done with assessment of various entities. Oh, any doubt to anybody? Sir, break. Okay. You know what? We are already lacking behind. You want break? Okay, chalo break. Let's take break. I am okay taking break. I want my throat to be safe. I will take break. It is 408 to 425. Okay? After that, we shall resume. We shall start with trust taxation, and then after we shall continue. Welcome back from break. Are you all back from a break? Are you all? Sir, we are absolutely back from break. Well, absolutely back from break. Chalo. So before going to break, we started off with we completed the assessment of various entities. Now moving further with trust taxation. Taxation of charitable trust, political parties, yes, and electoral trust as well. Who is considered as charitable? Who is considered as charitable? See, charitable is defined under section 2, clause 15. Anybody who works for relief to poor. Relief to poor. Second thing, cloth distribution activities, Annadanam. These people are called charitable. Any person who is into education, school and all, any yoga, any medical relief, any person who is into preservation of environment, watershed or wildlife, Namami Gange, and these are charitable trust only. Anybody who is into preservation of monuments, places, objects of artistic or historic interest. For example, in Indore, now we have a Devi Ahilya Bai Holkar's fort where her sari is kept. So that is also a monument that is also run by a charitable trust only. So these six businesses are charitable. Consider these six businesses are unconditionally charitable. Whenever these six businesses are being considered, na, they might do business as well, and any percentage of their receipts can be business receipt. There is another class of activities which can be considered as charitable, which is advancement of general public utility. If anybody is into advancement of general public utility, for example, I am into swimming teaching classes. I think that swimming should be known to everybody. In this hot summer, everybody should be able to deep dive into the river, and he should be able to bath. Or at least if not, then he should be able to dive at least in swimming pool. So swimming is the path breaking. I think everybody should learn. So I started teaching swimming. Lawmaker says it is also advancement. If you are doing work for general public utility as a whole, you are doing something beneficial now, it is also called charitable. But in this advancement of GPU now, what happens if your business receipt exceeds more than 20% of the total receipts? Whatever the total receipts are, take 20% of that. If it is if business receipts are more than 20% of the total receipt, 20% of the total receipts are more than 20% of the total receipts now, in that case, sir, exemption will not be given. No exemption will be given to you. Exemption will not be given to you, sir. They will not even cancel your registration. Cancellation of registration will not take place. It's just that they will not give you exemption for that relevant year. For a charitable trust, what are the possible avenues of income? See, charitable trust earns via donation. Donation can be corpus donation, anonymous donation, regular donation. Very carefully listen. Corpus donation is a very comprehensive term. Corpus donation means any donation which is made with a specific direction for doing something, or it is made with a direction that it is towards corpus. It is corpus donation. Corpus donation given to a trust is absolutely exempted provided it is invested in 11.5 safe investment. Anonymous donation, for some trust it is absolute as normal donation, for some trust it is taxable. We shall discuss later on. Regular donation we will study. Apart from that, a trust can have income from government grant, a regular government grant, a corpus grant. Corpus grant is exempt provided it is invested in 11.5 safe investment. A trust can be in the form of school, college, hospital. They might have receipts from the school, college, hospital. A trust can have capital gain as well. A trust can have house property, IFOS, agriculture income. Any income trust can have. All these incomes clubbed together will form the gross receipts. Out of this gross receipts, now, if whatever the corpus donation this trust has received, whatever the corpus donation this trust has received, now this shall be taken off. This shall be taken off. This shall not be considered. Why this shall not be considered? See, because this is exempt. Excluding the corpus donation, whatever the receipts the trust have, whatever the receipts that trust is left with, out of those receipts, 15% will be unconditional standard deduction. Corpus is exempt. 15% is the unconditional standard deduction. Without any questions attached, it is exempt. 85% is to be used by the trust for the activities, charitable activities. Now 85% can be used for any purposes. See, are you understanding what benefit this trust is getting? This charitable trust is getting so many benefits. Corpus is exempt, unconditional 15% standard deduction. Then any revenue expenditure done is allowed. Any capital expenditure is also allowed. If a charitable trust does any capital expenditure, that shall be allowed, and that too allowed as a whole. Wow, sir. Wow, wow, wow. Sir, if donation is done, that is also allowed. If loan repayment is done, that is also allowed. We shall study this later on. Trust can spend their money in these manners. In these ways, trust can spend their money. Lawmaker says, even after doing all the expenditure, all the loan repayment, all the donation, still trust is not able to use their 85% of the receipts. What they can do is, they can do one thing. They can do one thing is, sir, they might go to assessing officer requesting that they were not able to use. There might be two reasons why they were not able to use. First reason is because it was received towards the last. Trust got a bumper donation towards the last, so it would go to assessing officer. Requested to assessing officer, AO, listen, AO, we could not use it because we received it towards the last. In that case, at least 2 months prior to ROI, they shall go to a assessing officer. Assessing officer will give it as deemed apply. Only condition is that trust has to use this in next year. It is also possible why trust might not be able to use it. Second reason might be, so trust has not even received that money. It is possible that trust has not even received that money. It is possible now trust follows accrual system of accounting. Trust has not even received the money, because of which it has not been able to use that money. So in that case, what happens? Again, you would go to at least 2 months prior to ROI to assessing officer. To assessing officer, you would go to ROI. You would 2 months prior to ROI, you would go to assessing officer and request AO, please give us deemed apply. We shall use it as soon as received. You shall give deemed apply. AO will treat it utilized in previous year 2026. Only obligation with you is to use it in next year. So many benefits right now. See, so many benefits. Only thing you have to do is you have to give the declaration in Form 9A to AO at least 2 months prior to ROI. Explanation 2 to Section 11(1). What this says? This says if you want to donate to any of the other trust now, we shall also give deduction of donation. See, under PGBP, donation is a personal expenditure. It is always disallowed. But if trust donates to any other trust, it is allowed, provided donation is made to a registered trust. Second thing, donation is not towards corpus. And third thing, sir, whatever donation is being made, out of that only 85% is given to you as deduction or application. Got it? You can even donate to somebody, but provided your donation should be not towards corpus, it should be towards a registered trust only, and only 85% will be allowed to you as application. Third condition, third explanation, what this says: if trust does any of the expenditure, trust has done any of the expenditure. Now, if trust has done any expenditure, now what happens in this case? Then any payment made to single person in a single day exceeding 10,000 should not be in cash account pay. It should not be via cash, cross check, bearer check, uncross check. It should not be done. It should be via account pay check only, demand draft only, electronic clearing system only. In addition to that, if trust has taken deduction of any expenditure on accrual basis, right now it is not allowed, but in 2021 it was allowed if they have taken deduction on accrual basis. Right now, if they are paying in cash, now it has to be added to the income of the trust. At last, sir, if trust is liable to deduct TDS on any payment and it has not deducted the TDS, in that case 30% or 100% of that expenditure shall be disallowed. Fourth explanation, what it says, or not actually fourth, but third. See, another benefit. If you are a 80G registered trust, in this case, what happens? Listen, carefully listen. If you are a 80G registered trust, sir, non-resident is not mentioned in this TDS point. Yes, non-resident is not mentioned in this point. Even law has also not mentioned this, but later on you will see that some payment to non-resident can be made, and on which TDS is required to be deducted. Okay. Now, explanation 3. What this explanation says, see, whenever there is a 80G registered trust, 80G registered trust. It receives donation for repairs and renovations. Whenever you receive repairs and renovation donations, it is normal donation only. You might have to claim standard deduction on it. You have to use it, and then only it will be exempt. But lawmakers are very clear in this. Lawmakers are really very clear. If you receive repairs donation, you might claim it as corpus and you might claim it as exempt. If you receive donation for repairs, you might claim it as corpus and that will be exempt. Provided four conditions are fulfilled. First of all, amount is used for repairs. Received for repairs, used for repairs. It should not be donated to anybody. It should be separately identifiable and it is invested in the 11.5 safe investment. If you fulfill four conditions now, then whatever donation you have received shall be considered as corpus donation and it will be exempt. Sir, what if you violate? What if you violate, sir? It will be taxed at the rate of slab. It will be taxed at the rate of slab. It will not be taxed under 115 BBI. It will not be taxed at slab. It will be taxed at slab. Of course, if you violate this fourth condition, then of course 115 BBI would be triggered. By default, it is slab only. Then we have 11.4. This is also a beneficial clause. See, before 11.4, I shall come to 11.5. What this is. See, whenever trust does the access application, for example, incomes are 10 lakh rupees, expenditure is 30 lakh rupees. So whatever extra 20 lakh you have spent, this cannot be carried forward. This will lapse. This literally cannot be carried forward. This has to lapse. Very simple it is. It is very simple. As simple as it can be. So access application will lapse. It will be allowed in current year only. So what happens is now if trust is already into losses, if trust has not even sufficient received, if they don't have sufficient receipts, then what they will do, they will use money out of corpus. They will take loan to do the expenditure. They are already in losses. If they take loan and if they do spending via corpus, it will increase their losses and losses are even already not allowed to carry forward. Are you understanding the issue? Losses cannot be carried forward. They are already in losses. That is why they want money from corpus. They want money from loan. Therefore, if they are allowed loans and corpus money now, then their losses would increase. And if their losses would increase, this cannot be set off. So it will be absolutely wastage of expenditure. Lawmakers have given a benefit to these trusts. What benefit has been given? Sir, amount applied out of the corpus shall not be treated in the year of application. Once you apply money out of the corpus or you apply money out of the borrowed funds, in that case, it will not be given to you as application in the current year. Rather, it will be treated as application in which either you deposit back to corpus or it will be treated as application in the year in which you repay the money and to the extent it is repaid. It is beneficial because in today we are already having losses. So again, increasing the application will have no extra benefit. But deferring these application to the year of deposit back, we will deposit back in that year only when we have profit. So in that case, it is delayed. Our application is deferred in this manner. So it is always a beneficial point. Always a beneficial point. What did I say? Out of loan taken, it shall be repaid. When it is repaid, it will be allowed. Out of corpus, when it is deposited back, it shall be allowed. So there are 6 conditions attached whenever you are spending money out of corpus. 6 conditions are to be fulfilled. What are those 6 conditions? Application shall be made in India. Out of corpus, if you are doing it, shall be made in India. You shall not donate to anybody's corpus amount. See, you cannot donate to anybody in the form of corpus. Normal donation is allowed, but corpus donation is not allowed. You cannot carry forward the access application. Whenever you are making payment via corpus or via loan, you have to make sure that any payment exceeding 10,000 should be done via account paycheck only. Second thing, any accruals, any payment taken on accrual basis has to be paid via banking channel only. And if TDS is required to be deducted, you have deducted the TDS. Any expenditure should not be done for the benefit of a related party. And at last, whenever you do any spending from corpus or you do any spending from loan, sir, you shall deposit back to corpus. You shall repay the loan back within 5 years from the end of the financial year in which applied. So if previous year 2026 you would withdraw from corpus now, within 5 years from the year end, that means up to 31st March 2031, you shall deposit back to corpus. You shall deposit back to corpus. You shall deposit back to corpus. Done, sir. Last additional explanation. Lawmaker says If you want to claim application of any expenditure, then it will be only allowed on payment basis. See, if you are following cash system of accounting, expenditure are already allowed on payment basis, income are also taxed on payment basis. But if you are following accrual system of accounting, then incomes would be taxed on accrual basis, but expenditure would be allowed only on payment basis, not on accrual basis, only on payment basis. So this isn't this wrong? For March month of electricity, we pay electricity bill on 8th April, 10th April, we pay that. So it will be disallowed. Yes, it will be disallowed. Salary, if not paid in March, will it be disallowed? Yes, it will be disallowed. It will be disallowed. Sir, isn't it wrong? We are getting deduction for just 6 months, so 11 months only. Hey, Baba, it's not wrong. Last year's deduction you got in current year you would get in last year, next year. It's simple. It's not difficult at all. Now, these are sufficient benefits. Apart from that, you get a lot of more benefits. First of all, for example, if you don't want to spend money anywhere, okay, you want to accumulate and get a temple constructed. If you want to accumulate the money, then you can even do the accumulation, but 5 conditions are to be fulfilled. 5 conditions. Can you all speak after me? First of all, you have to submit Form 10 to assessing officer at least 2 months prior to ROI. 2 months prior to ROI, you have to submit Form 10. Second thing, you have to specify the purpose for which you are accumulating money. Third thing, you have to keep this money at the safe investment. Fourth thing, you cannot donate it to anybody. And at last, you shall use this money within 5 years. What did I say? Listen, please. Oi, shh. You are back from break. I know it feels sleepy, but you have to be awake. 5 purpose. At least 2 months prior to ROI for submit Form 10 to assessing officer. Specify the purpose for which you are accumulating. Third thing, sir, deposit in 11.5 safe investment. Do not donate it to any other trust. And at last, use it within 5 years. If any of the 5 conditions are violated, sir, not any of the. If you did not submit to AO at least 2 months prior to ROI, it's okay. You can submit the money up to ROI as well. Up to ROI as well, you can submit. But beyond ROI, you cannot submit. Up to ROI, you are allowed. Sir, if you specify some purpose and you misutilize that, if you donate to somebody, if you didn't keep in 11.5, if you did not use in 5 years, then what would happen? Sir, this would be taxable. This would be taxable. This would be a violation under 11.3. And this would be taxable under 115 BBI at the rate of 30%. Misutilized, donated, and uh, did not keep in safe investment and not used in 5 years, it would become taxable in your hands under 115 BBI. Some important pointers we need to understand here. Now, first important pointer. See, we were about to use the money. I mean, we had 5 years to use the accumulated balance. I was about to use. But for some purpose, court intervened and put a stay on my purpose. For example, I was willing to make a mosque. Okay, I was willing to make a mosque or any temple I wanted to make. But court intervened that I cannot make. For example, in that case, what happens? Whatever the period of court stay is there, that shall be excluded from considering the 5 lakh limit, 5 years limit. That means extra time will be given to me. Second thing, so sometimes what happens is now I do not specifically prescribe for what purpose I am constructing. For example, I want to do construction. I have not prescribed I want to construct school, temple, mosque, any library, any hospital. I have not prescribed any new temple I want to create. I have not prescribed. Is it okay just to mention the word construction? Right answer is it is absolutely okay to mention this word. It is absolutely mentioned to okay this generic word. It clearly prescribes as to what you are doing. Business income of the trust, section 11.4. What this says. See, whenever a trust does any business, this business is considered as regular income of the trust. On this business income as well, trust can claim 15% standard deduction. If this money is used for revenue expenditure, capital expenditure, donation, loan repayment, set aside, accumulation, anything can be done from this business income as well. If trust does the business, this business income can also be considered as the exempt income. It can be used for the exemptions provided 3 conditions are fulfilled. First of all, trust is doing the ancillary business. For example, in our city, now there is a Mata temple. There is a temple where chunri, what do we call it? Stall, a chunri dupatta, what that ladies wear now. The dupatta is the chunri is sold and that chunri is laid to Mata. Okay. There is a coconut shop beside the temple. So these coconut shops are ancillary to the main objects of the trust. Now, what if from tomorrow the temple starts a shoes shop? It is not ancillary. So important is business should be ancillary. Second, books of accounts of this ancillary business should be maintained separately. Books of accounts has to be strictly followed separately. And third thing, sir, if you are following advancement of general public utility, then maximum business receipt you can do is 20% of the total receipts, not more than that. Okay? Not more than that. That is how much you can do. If you fulfill three conditions now, whatever your business income is there, we shall give all the exemptions on this business income as well. Got it, sir. Got it, sir. Got it. Acha, if AO finds any income concealed, then he shall make it fully taxable. If AO finds that you have concealed any income, he shall make it fully taxable. Of course, your registration would also cancel. Later on, we'll study that. Safe investment. Sir, what are safe investment? See, ultimately, we studied safe investment at three places. At first, we said corpus is kept at safe investment. Second, we studied when revenue donation is received for repairs, we want to claim exemption, so we deposit it at a safe investment. Third thing, we studied at 11 too. Whenever you want to accumulate our money, now we have to keep this money at safe investment. In these three cases, what happens? What are safe investments? Sir, immovable property is a safe investment. Any bond which is which is of approved financial corporation, any bond of a public company into long-term finance is a safe investment. Any deposits means fixed deposit, recurring deposits of post office, scheduled bank, cooperative bank, public sector company, industrial development bank, these are safe investments. Any government saving certificate or SGBs, any units of mutual fund UTI, any debentures which are backed by the government, any CDSL shares, NSDL shares. Do we need to learn this? Honestly, not. Make sure that normal company shares are not safe investment, cryptocurrencies are not safe investment. That is the bottom line. Power grid infrastructure investment trust is also safe investment. Remember, if we have shares of a public company, for example, SAIL, for example, Hindustan Aeronautics Limited, this is also considered as safe investment. But sir, sometimes what happens, these companies disinvest themselves. And after disinvestment now, PSU might cease to become PSU because percentage is so low, percentage of holding by the government is so low that PSU ceases to be PSU. In that case, what happens if PSU ceases to be PSU? Then you have an option. You have a window of 3 years to take out money from that PSU and invest it at some other safe investment. You can take out money from there and invest it at some other safe investment. Then it is absolutely valid. Absolutely valid. Section 11.6 we have already covered this. See, whenever you buy a capital asset, for example, you buy a machinery, you have an option. Either you can claim depreciation or you can claim cost of asset. Whatever is beneficial to you, you might claim it. Very simple. Sometimes what happens is you buy a immovable property. Immovable property, many trust buys. In that case, now it is possible that stamp duty value of immovable property, say, is 100 lakh rupees. You buy at 40 lakh rupees. Whether 56 student would be applicable? Not applicable. In the morning only, we have discussed under IFOS that 56 total is not applicable to trust. Therefore, 56 total is not applicable even if trust receives the asset at a lower price. Fair enough. Section 11.7. If we have a charitable trust or if we have a registered institute under 1023C, 1023C, in these cases now, are we allowed any other exemptions of Section 10? For example, Section 10.15, AOP exemption. If a trust is a partner in a partnership firm, then profits are exempt. Right answer is no. If there is a trust, then no exemption under Section 10 is allowed except for Section 10.1. For any trust, only agriculture income is exempt. Otherwise, no other income is exempt. No other income is exempt. Every income has to be part of your gross receipts. You shall claim 15% standard deduction on that, and then you shall apply that. No income is exempt. Believe me, no income is exempt except for 10.1. For every other income exemption you will not get. You have to use that money and then only you can claim the exemption. Capital gain. How capital gain is proceeded? How capital gain is worked out in a trust? See, always full value of consideration minus cost of acquisition without indexation. This will form part of your gross receipts. Full value of consideration minus cost of acquisition, this will form part of your gross receipts. Basics, that it is. After this, you will get standard deduction of 15%, and this will give you net, this will give you amount to be utilized. On this amount, you have to reduce one thing, that is cost of new asset minus cost of old asset. This is the figure you have to just reduce. Cost of new asset minus cost of old asset will be simply reduced in the application component, and this will give you 100% marks in every question. Wherever this adjustment is tested, this is how answer has been done by ICA. Whatever the capital gain is, that shall form part of your gross receipts. 15% standard deduction, and you have to reduce what the cost of new asset minus cost of old asset, and that's enough. Oi, focus. If you want exemption, then you have to be registered. Government will not give you any registration. I mean, government will not give you any exemption without registration. You need to have registration. Second thing, if you are registered, get your return filed under 139(4)(a). And in addition to that, if your total income before any exemption crosses basic exemption limit, then maintain books of accounts and get yourself audited. Done, sir. We will take care. Section 13(1), denial of exemption. There are instances where government is going to deny you exemption. Government will not give you any exemption. There are instances. What are those instances? First of all, if you apply any income for private religious purposes. If you apply any income for private religious purposes, you will not be given exemption on that. For example, if trust has 1 lakh rupees of income, and the entire 1 lakh has been applied for example, trust has 1 lakh rupees of income, it has applied for personal purpose only. For personal purpose only means to particular person only, for no reason. There has been a Bhagavad Gita, there has been a Sundar Kand, and only a family is allowed to enter private religious purpose. Thus, exemption will not be given to that. Second thing, if income is applied for particular religion, community, caste, then exemption is not given. If income is applied for a particular religion, community, and caste, it is not allowed. It is not allowed. Exemption on that is not allowed. Income applied for particular religion, community, and caste is given, it is not allowed. But sir, there are 4 exceptions to this. 4 exceptions. Not mentioned here, but there are 4 exceptions. If income is applied for women community, allowed. If income is applied for children community, allowed. If income is applied for labor community, then too it is allowed. At last, if it is a religious trust, then religious trust can apply income for their particular religion, community, and caste. Sir, how is it possible? Let me give an example. Like we have Jagannath temple in Puri. We have Jagannath temple. Now, Jagannath temple specifically restricts any other person other than Hindus. Only Hindus are allowed to enter. There are many temples in India as well where only particular religion people are allowed to enter. There are many other places like that. Like we have Hajj, Mecca, only Muslims can enter. Of course, it is in Saudi Arabia. We don't consider in India. If there is any religious trust now, if there is religious trust, then religious trusts are excluded from this ambit. If religious trust apply income for particular religion, na, we cannot deny their exemption. Okay? This is customary practice. We cannot deny their exemption. Third thing, if income has been applied for the benefit of a founder or for a specified person, if income has been applied for a specified person, then in that case, benefit would not be given. Income applied means, for example, we have to receive rent from our relative. Trust has to receive rent from a relative. Rent received is 10 lakh, whereas ideally ideally rent could have been received 25 lakh. So 15 lakh shortfall we are receiving. If we are receiving 15 lakh as shortfall now, in that case, what would happen? This 15 lakh will become our income. Later on, I will tell. On this 15 lakh, we will not be given any exemption. Extra 15, the shortfall 15 lakh that we are having, we will not be given any exemption. Apart from that, sir, if we apply that money for the benefit of the person, for example, if we have to pay the interest to a related party, 10 lakh interest is payable. We pay 20 lakh rupees. Then extra 10 lakh, whatever we have paid on this, we will not be given any application. And this 10 lakh would become your income under 115 BBI. I will refer this point again to you. Sir, if funds wherever required are not kept at 11.5 safe investment, we have studied corpus is to be kept at 11.5 safe investment. 11.2 accumulation is to be kept at 11.5 safe investment. Apart from that, that third 3A explanation where you receive a revenue donation which is to be used for repairs purpose, it is also exempt, but only if you keep at 11.5. In these three cases, if you don't keep at 11.5 safe investment, you don't get exemption. It will be taxable in your hands. So these are the 4 areas. There is a one common question being asked. Let me tell that point to you. Sometimes what happens is now a trust gives loan to any related party. Now, related party interest is charged, interest higher than market rate of interest is charged, but loan given is unsecured. Can I say it is a benefit given to the related party? Right answer is absolutely. Absolutely, absolutely. If any of the loan has been given to any specified person related party now, then it is a definite benefit given to it. Whenever trust gives any benefit to a related party, now it is not just taxable later on. I will tell you, it is just taxable, but you are penalized for that. Section 271A trust 271AA says that if you benefit any related party, now then 100% of the benefit given to that person is charged as penalty in first violation. And if you do subsequent violation, then 200% penalty is charged. 200% penalty for subsequent violation is charged if you give any benefit to related parties. Who is a related party? Listen, this is important. Who is a related party? For a trust. Let me draw that for you. For a trust, his founder, trustee, manager, and author. These 4 people are related party. By default, these 4 people are related party. These people are related. Any benefit given to these 4 people now would attract denial of exemption. Apart from them, who are related parties? Sir, their relatives under 56(2)(10). In the morning only we understood. Trustee himself is a related party, trustee's spouse, trustee's children, trustee's brother, sister, and their respective spouse, trustee's spouse's brother, sister, and their respective spouses, trustee's mother, father, trustee's spouse's mother, father, trustee's mother's brother, sister, and their spouse, trustee's father's brother, sister, and their respective spouses, and their legal ascendant. These all for trustee, founder, manager, author, these all are relatives, second layer relatives. Apart from that, who else is a relative? Sir, if these members hold any substantial interest, that means 20% or more in a company, then this company is also, or if it is a firm, then this is also related. Just think of it. Trust is having a trustee whose mother's brother holds 20% in a company, then that company is a related party of a trust. Trustees, authors, brother holds 20% in any entity, then that is also a related party. Any benefit given to them shall attract denial of exemption. Apart from that, there is another person who is considered relative, a donor who donates more than 1 lakh rupees in a year. He shall be trustee, he shall be related party. Or if there is a donor who not in current year gave 1 lakh, he has not given 1 lakh rupees, lesser than 1 lakh donation given, but since incorporation he has donated more than 10 lakh rupees, so he shall also be a related party. Individually, in 1 year, more than 1 lakh, he is a related party. But not more than 1 lakh, but since incorporation till today, he has given more than 10 lakh, he shall be related party. Wow, sir. Wow. 115 BBI. It has been almost 7 hours and we have just reached to concept number 44. And we have to go to 100 concepts. Okay? Do not feel demotivated. Okay? We have to focus a lot. We have a lot of energy with us and we will tackle it in the best manner we do. Okay? Section 115 BBI. See, there are certain violations that are taxed under 115 BBI. Let me recall that. Let me recall that for you, if you remember. Under explanation 1, 11.1 explanation 1, we were said that if we could not use 85%, then we would go to AO. Inform 9A and we requested AO that we will use it next year. What if we don't use it next year? In that case, it is taxable under 115 BBI. If we don't use it that year, no, it will be taxed under BBI. Second thing, sir, we were said that we can accumulate money for some specific purpose. We do not donate it. We keep it in safe investment, and at last, we have to use it 5 years. If we misutilized them, donated them, did not keep in 5 investment, could not use in 5 years, in that case, it would be taxed under BBI. If we apply any sum to specified person, if we apply any sum for the benefit of the related party, in that case, it is taxable. If income is not kept at safe investment wherever they are required to be kept, it is taxable. If corpus donation is not kept at 11.5 safe investment, it would be taxed. And if income is applied outside India, it would be taxed. Income applied outside India, it would be taxed. Oh dear God. Oh dear God. Hmm. Such income would be taxed at the rate of 30%. No deduction shall be allowed against any such income. Come on to section 115 BBC. Come on to BBC. What this says. I mean, in Hindi, we call na Gupta Dan. I don't know what we call in South India. I mean, if you go to a temple, there is a donation box na, where you keep your money. In Hindi, we call it Gupta Dan. In English, we call it anonymous donation. Somebody please point out what do you call in your local language? What donation you call it? Okay. Now, whenever you donate money in the form of anonymous donation, what is the treatment? See, if you donate any money to a religious trust, to a temple, to a mosque, to a church, to a gurudwara, wherever you donate anonymously, it is as good as normal donation only. It is as good as normal donation only. These temple, mosque, religious trust, what they do is they form part of the gross receipts. They claim 15% exemption, standard deduction, and then they apply 85%. Whatever they are able to apply, they will get the exemption. They will get the exemption. For resident, for religious trust, it is very simple. Whatever anonymous donation received is there now, that should be normal donation only. But what about, sir, charitable trust? If we have a charitable trust now and the charitable trust receives some anonymous donation, then some portion is considered as normal and some portion is considered as taxable under 115 BBC. Some portion is considered normal and some is taxable under BBC. What is normal and what is taxable? Let me tell you. You have to take voluntary donation or normal donation, whatever you call. Voluntary donation, normal donation, plus corpus donation, plus anonymous donation, plus government grant. Write it down and cut it down. We never take government grant. ICI might give government grant suggested answer, but it will always be an alternate answer. In first answer, they never give government grant. They never take government grant. Okay. What did I say? Voluntary donation, corpus donation, anonymous donation. Take 5% of that or 1 lakh rupees, whichever is higher. Many students in Jan 26 have done this mistake that they forgot to take 1 lakh, whichever is higher. They forgot to take this is a blunder, and it is an unforgivable sin. It is a kind of, I mean, fault that which will never be forgiven. Okay? So always remember normal donation, anonymous donation, corpus donation into 5% or 1 lakh, whichever is higher, you have to take. And this much would be considered as normal. And apart from that, everything would be taxable under BBC at the rate of 30%. That is all we have in anonymous donations. Now, sometimes what happens is now we donate to a charitable trust and religious trust, a blend of that. For example, Shirdi Trust at Sai Baba Trust at Shirdi. It is a religious trust as well. It has hospitals as well. It has schools as well. Satya Sai Trust. It is religious trust as well, and it is charitable trust as well. What if we donate to a trust which is partly religious and partly charitable? What do we do in that case? So if we donate to somebody who is partly religious, partly charitable, we have to check. If we specifically donate with a direction that it should be used for charitable activities, then some portion would be normal, 5%, and remaining would be taxable under BBC. But but if we specifically give for religious purpose, or if we don't prescribe what purpose we are giving, if we prescribe specifically for religious purpose, or if we don't prescribe for what we are donating, in that case, what would happen? In that case, what would happen? Lawmakers clearly say that it would be considered as normal donation only. Normal only. For religious purpose and for unsaid purpose, it will be normal only. Format to solve the question, always adhere to the format. Always stick to the format. Examiner will never deduct any of your marks. If you do not follow the format, now there are chances you might do some mistake and examiner would take a revenge from you. Okay? He would take a lot of marks. How do we solve the question? Always take the gross receipts. What gross receipts are there? See, never take corpus donation as gross receipts, never take agriculture income as gross receipts, okay? And never take anonymous donation which is taxable under BBC under gross receipts. These things are not to be taken in gross receipts. So what else to take, sir? You shall be taking gross receipts from school, hospital, government grant, incidental business, normal donation, and some of the limited anonymous donation that is allowed. See, out of anonymous donation, some is now normal now. So that limited you shall be taking here. If you have any capital assets transfer, then capital gain would be here. If you have any house property, you shall also take it here as well. Total. Apply standard deduction. Apply for charitable and religious purposes, or for school, college, hospital, whatever purpose you have. Sometimes you are not able to apply because it was received in last or it was offered as accrual basis. So reduce it here. If you want to accumulate for future purpose, accumulate it separately. If you donate it to another trust, then 85% would be allowed here. Whatever the income turns out to be, this will be taxed at normal rate. Whatever anonymous donation is there, which was taxed under BBC at the rate of 30%, take it here. If you have any other income which is taxed at 30% now under BBI, it shall be referred here. This will give you the total income. Now, what tax rate trust follows? See, trust follows slab rates of an individual. It shall apply to trust. By default, it is BSE. If trust opts out of BSE, then old tax regime shall apply. Registration process. Let's have a sort of. Just give me a second. I'll get a glass of water and we shall continue. Back with water. Now, if trust receives corpus donation from a person with name, PAN, address not mentioned, will it form part of corpus donation? No. Yes, it will be. It will be anonymous only. It will be anonymous only. See, donation means details of donor is to be known. Unless details of donor are not known, it is not donation. Okay, remember. So if details are not known now, it is always anonymous, be it corpus, be it normal. If details of donor are not known, it is always anonymous, be it corpus donation, be it normal donation. Perfect. Done, sir, done, sir, done, 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 sir. If loan is secured to related party, then how much interest you are charging, Janvi? It matters the most. If you are charging less than market, then whatever the benefit you are giving, that will be added to your income. Yes, if secured loan is given, then see there are two aspects now. Charging lesser interest and without security. These are two different aspects. If you are not if it is not secured, entire loan given is benefit given. If it is secured but you are charging lesser interest, then the difference is the benefit given. If it is secured and you are charging more interest, then no benefit is given. Registration process has undergone a lot of changes, and this registration process is important as well because there is amendment in that. First of all, if you are a trust registered under old provisions of Income Tax Act 12AA, in that case now you have to get yourself converted into new provisions. You have to get yourself converted. The last day to convert is 30th June 2024. This is the last day to convert. After that, you cannot convert in new tax regime. Your registration would expire and you will have to go for fresh registration. So this conversion is not relevant as of now. Now, whenever you want to go for a fresh registration, you have two options. If you have commenced your activities, then you can go for directly final registration. If you have not commenced your activities, you might go for provisional registration and then confirm it to final registration. Okay. If you have commenced your activities, then directly apply for final. Not commence your activity, take provisional and then convert it to final. Fair enough. How do we apply for provisional registration? The date on which you want to start the business, now at least 1 month prior to that date, apply for provisional registration. The date on which you want to start the business activities, why you will do business, you will do activities. The date on which you want to start your activities, now at least 1 month prior to that, apply for provisional registration. You shall be given registration within 1 month from the end of the month of the receipt of application. So as soon as application is submitted, within 1 month from the end of the month, you will be given registration. That's it. No questions attached. No inquiries done. Without any inquiries, that to CIT, PCIT would be giving to you, and it will be given for 3 years. Wow! 3 years free registration given without inquiries, but it is provisional registration. Why it is given? So that you might commence your activities first now. No inquiries done. Okay? Once you apply, within 1 month from the end of the month of the application, you will get the registration. Let me take an example to illustrate how do we actually go. For example, this is previous year. It is year ending 31st March 2026. I want to commence my activity on 1st December 2025. So till when I have to apply? Up to 1st November, that means up to 31st October I have to apply. Up to 31st October I have to apply. I applied well on time. End of month is on 31st October only, plus 1, that means up to 30th November I will be given registration. 30th November 2026 5 I will be given registration. 30th November. 1st December actually, 1st December. 30th November I will be given registration. This registration would be applicable for previous year 25-26, 26-27 and 27-28. 3 years it would be valid. Now, when I have to go and convert this into final registration, we have two dates mentioned. Check out the actual date you commence your activities. Let us assume that you commence your activities on 1st April 2027. Add 6 months to that. Actually commencing the activities plus 6 months. This would be 1st July 2027. And last date of expiry of the registration. Last date of expiry of registration minus 6 months. This would be 30th September 2027. This is date 1. This is date 2. Earlier of both the dates, you have to apply for final registration. Earlier of 2, you have to apply for final registration. Assuming you applied well on time, you applied on 25th June 2027 you applied. So end of quarter plus 6 months will be the final registration date for you. That means up to 31st December 2027, you will be granted final registration, and this final registration will be valid for 5 years. 5 years, including the 3 years for provisional registration. That means 2 years extra, 28, 29, and 29, 30. This is the period for which your final registration would last. What did I say? I'm repeating that point. Huh? Listen, 6 months from the commencement of the activities till when you have to apply for final registration. Listen, 6 months from the commencement of the activities. Once you commence the activities within 6 months, or 6 months prior to expiry of the provisional registration, whichever is earlier. 6 months from the commencement of the activities, or 6 months before the expiry, whichever is earlier, you have to apply. Then you will get registration within 6 months from the end of the quarter in which application is received. 5 years, including provisional registration, and this will be given with inquiries, and CIT PCIT is going to give the registration. Sir, what if your existing registration is about to expire? What if your existing registration is about to expire? In that case, see, whenever about to expire is there, now at least 6 months prior to go for recovery, go for renewal of registration. Within end of the quarter of the application, 6 months will be added, and within that time you will be given the fresh registration for next 5 years. Again, it will be given by CIT PCIT with inquiries. Sometimes you modify your objects. See, Modi is the brand name of change. Okay. So you modify your objects. If you modify your objects, if you change your objects, then within 30 days you have to apply. Within 30 days you have to apply. Okay. As soon as you apply, within 6 months from the end of the quarter, you will get the registration. For 5 fresh years you will be getting, and remember, registration would be given by CIT PCIT with inquiries. So when there is modification, in that case you will get the registration for 5 years. Thus becomes operator not relevant as of now. Now, what happens, sir, when you have already commenced the activities? Then how do we apply for final registration? See, we don't go for provisional, we directly go for final. If activities have been commenced, now we directly go for final. Now, how do we go for final? Understand. If we have already commenced the activity and we have not been claiming deduction, exemption, what do we do? Just simply go go for final. Go for final registration. At any point of time you go, you can go. That's absolutely fine. As soon as you go now, within 6 months from the end of the quarter, you will be given registration. That's it. By CIT PCIT with inquiries. So I told you 4 or 5 registration methods, I guess, out of 6, 4 are there. Five methods I told you, 5 manners. Either you can go for provisional within 1 month, that will be given for 3 years, and then provisional will be converted into final. This is the first way. Either you can directly go for final whenever you want. Whenever these registration are about to expire now, at least 6 months prior you have to apply, and within 6 months from the end of the quarter, you will be given fresh registration. Whenever you modify your objects, in that case, what will happen? Within 30 days, you will be given fresh registration. Okay? Within 13 days, you have to apply, and within 6 months from the end of the quarter, you will be given fresh registration. Now, there is a best of all amendment. Very carefully understand. If on the date of application, check out the date on which application you are making. Date of application and check the year of application. For example, you are applying on 1st December 2025. Then what is the year going on? Previous year 25, 26 going on. The year of application is to be checked. If preceding 2 previous years, that means 24, 25, 23, 24. If your gross receipts as a trust are up to 5 crore rupees, if gross receipts are up to 5 crore rupees, in that case, what would happen? Wherever you were given 5 years of registration, at that position, you will be given 10 years of registration. Instead of 5 years, you will be given 10 years of registration. And this is the amendment. And I strongly believe this is going to be asked in exam. Normally, amendments are not tested in upcoming attempts. They are tested in late coming attempts. Okay. So, less likely to be asked, but my instinct says that it is an important, very important amendment. You must be aware. If on the date of the registration, For two preceding years, if your gross receipts are up to 5 crore rupees in each of the year, in that case, you will be given registration for 10 years instead of 5 years. We have cancellation of registration. Before cancellation, we need to understand, sir, what are specified violation? There are 8 specified violation. What are those 8 specified violation? First of all, a trust is not doing. Acha, if trust is doing a business which is not incidental to the main objects of the trust. For example, there is a yoga school, okay, which is selling, I mean, which main business is yoga clothes only. If there is a yoga institute registered for yoga classes, its main purpose is not to teach yoga, but to sell the yoga suits. So if your business is not incidental to the main objects of the trust, or if it is incidental, but you have not maintained separate books of accounts, in that case, what would happen? Sir, your registration might get cancelled. It is a specified violation you are happening. So two, with respect to businesses, your business is not incidental, or if it is incidental, separate books not maintained. Second thing, if income is applied for private religious purpose or if it is applied for particular religion community caste. Third thing, sir, objects of trust are not genuine or income applied for other than objects. For example, I am there to teach yoga, but since 10 years I have only taught 5 people yoga. So I don't have any genuine objects. In that case, our registration might be cancelled. Or I am applying income other than objects of the trust. What happened? I am applying income which is not for the objects of the trust. Not for the objects of the trust. Okay. At last, I have not complied any law. See, I am not allowed to receive any foreign donations, but I received foreign donations as well. So that is also, I am see actually I am allowed to receive foreign donations, but with stipulated guidelines. FCRA guidelines have to be complied. I have not complied with FCRA. So that is also a violation. Or if I have been registered with false or incorrect information, in that case, it is a specified violation. Remember, till last year now, if you would have given any incomplete information, that was also specified violation. As of now, it is not specified violation. Incorrect information, yeah, incomplete information does not amount to specified violation. Remember, okay? So if you do 8 of these specified violation, two of related to business, two related to incomes, two related to objects, and two related to non-compliances. If CIT PCIT himself notices the specified violation happening, or if assessing officer informs that see, this trust is doing specified violation, or a risk management strategy of CBDT informs to assess CIT that specified violation has taken place. In all the 3 cases, CIT PCIT will call for information. CIT PCIT will call for information and check whether actually specified violation has taken place or not. If specified violation has taken place, he will pass an order cancelling the registration of the trust. If there is no specified violation taking place, in that case, he will pass an order for refusing to cancel the order, refusing to cancel the registration of the trust. Whatever he does, he shall do within 6 months from the end of the quarter in which first order was passed by him. As soon as his first notice was sent, the CIT first notice was sent by the CIT, within 6 months from the end of the quarter of that application, now CIT has to pass whether cancellation or not cancelling. He has to. So this is the cancellation of registration. Basically, almost the last topic of the trust taxation. Give a small focus to this. Small focus, just 10 to 15 minutes, and we'll be done with the chapter. 10 to 15 minutes. So, do you believe in multi-universe? How many of you do you believe in multi-universe? I mean, there must be a universe across. I mean, just beside this universe, there's another parallel universe. Like you are sitting in front of me, sitting in front of computer, listening to class. There would be a hoo copy, a duplicate of you sitting in front of the screen, listening to some other person. Do you believe in that multi-universe? Sir, we do believe in multi-universe, but whether you believe or not, that is not relevant. Income tax has multi-universe. Like we understood Section 12 AB. Once you get registered under 12 AB, you get multiple exemptions. Corpus is exempt, 15% standard deduction. You get multiple other exemptions. Like if you could not use, you can request to AO, you can accumulate as well, you can do capital expenditure as well, you can is that universe not require studying? Is that universe? Is this universe not requiring study? Yes. Acha, acha, acha. Oh, 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 oh. Studying cannot be left alone. Okay? You have to study in every universe. Okay? In every universe, you have to study. Baap re. Okay? Listen, listen, listen. Under income tax, now we have two similar sections which give almost identical exemptions. Like we have 12 AB. If trust is registered under 12 AB, they get corpus exempt, 15% standard deduction, whatever exemptions we have studied. Same exemptions are given to institutes registered under 1023C. Same registrations are given to institutes, same exemptions are given to institutes registered under 1023C. What institutes are there in 1023C? School, colleges, hospital, medical institutions. These are the institutions. It is very, very identical to 12AB, but there are three broad differences. First broad difference is 1023C has notified two institutions which are over and above 12AB. What are those? See, if there is an institute which is wholly or substantially financed by the government, what does that mean? If there is an institute whose more than 50% of the gross receipts are being given by the government only, if it is wholly financed by the government, in that case, now this institute is not required any registration. And income is fully exempt, fully exempt. Even if it makes profit, it is fully exempt. If there is any institute which is wholly or substantially financed by the government, it is fully exempt. Fully exempt. In addition to that, if there is a school, college, hospital whose gross receipts are up to 5 crore rupees now, those institutes are also fully exempt, no registration required, no registration at all required. They are fully exempt. No registration at all required. Wow, sir. Sir, what about others? Sir, others have to get themselves registered at least 1 month prior to taking the exemption. They have to get themselves registered. This was the case. So this third are all the institutes under 12AB as well. But these are the two institutes extra mentioned under 1020C which have special benefits. Fair enough. We got that point. Sir, what about there is a person who is having a school having 4 crore of receipts and he has a hospital as well where 2 crore of receipts are there. Overall is 6 crore. Can he claim exemption? Right answer is no. He has to get himself registered. He cannot claim exemption under 1023C. He cannot claim. Now, the other institutes were supposed to get registered, but government came with a guideline that they will not issue a fresh registration under 1023C. With effect from 1st October 2024, government will not issue any fresh exemption, will not issue any fresh registration for 1023C. Government will not issue. So now what happens to these institutes? If an institute is registered, can continue to claim exemption. Once the registration expires, it has to switch to 12AB. It has to switch to 12AB. No questions attached. It has to switch. Sir, what about these two? These two shall continue because these two don't even require approval. These two don't even require approval. If somebody wants to freshly claim the registration, can he get in 1023C? Right answer is no, he cannot get in 1023C. He has to go to 12AB. He has to go to 12AB. Oh dear God. Oh dear God. That completes your trust taxation majorly. Now we have exit tax. Now, very carefully listen. If trust does some violations, what kind of violations? If trust merges itself with another trust which is not registered. For example, I am a school registered, somebody else who is not registered. If we both do a merger, then in that case, it is a violation. If trust does the dissolution, can trust dissolve itself? Yes, it can dissolve itself. But whenever it dissolves, there is an inherent requirement to distribute all of your asset to a registered trust within 12 months. If trust dissolves and it does not distribute its asset to other trust within 12 months, in that case, it is a violation. If trust is converted into non-eligible form, what is non-eligible form? Sir, for example, I was earlier not for profit making, later on I became profit making. Or if my registration has been cancelled, or I have done modification in my objects and fresh registration has not been applied, or if I have applied but fresh registration has been rejected, or I had registration under old section, I did not get the registration in newer section, or my registration was expired and it did not get for fresh registration, or I had a provisional registration, I did not get the final registration. These are all violations. If I do any of these violations, I will be charged exit tax. I will be charged exit tax. How much exit tax will be charged? For that, I have a trick. For that, I have a trick. Once you will request me for the trick, I will trick. I will tell you the trick. If you request me, I will tell you the trick. So tax rate is 30% plus 12% plus 4%. This is the amount of tax that will be charged. If you request me for the trick, I will tell you the trick. Otherwise, I will not tell you the trick. If you request me. Now, what is accredited income? What is exit tax? On what income this tax is being charged? If you will ask only, then only I will tell the trick. Otherwise, I will not tell the trick. Now, what happens? Sir, trick, 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 please tell. Oh, ho, ho, ho. If you are asking, how can I deny? How can I deny? See, can you say this thing? 1, 2, 3, 4, get on the dance floor. Can you say this? Without feeling ashamed. Can you say this? Can you say this without feeling ashamed? 1, 2, 3, 4, get on the dance floor. 1, 2, 3, 4, get on the dance. Can you say this once? Can you say this once without getting humiliated? Okay? Can you say, sir? We can say once if you are able to utter this thing out of your mouth, now you will always remember this thing. What is this 1, 2, 3, 4? It is nothing but 12% surcharge, 30% tax, and 4% education cess. Wow. 12% surcharge, 30% tax, 4% education cess. This is what is the exit tax rate applicable for you. 1, 2, 3, 4, get on the dance floor. Oh, oh, oh. Got it, sir. Got it. Now, one basic fundamental, how do we charge exit tax? Okay. Somebody please put a timestamp if you are watching a recorded lecture, na? Then please put a timestamp. Now, what happens sometimes, na? Accredited income. What happens in case of accredited income? Let me tell now. Whenever trust claims any exemptions, it is either directly, indirectly invested in the form of assets only. It is accumulated in balance sheet only. For example, you saved, you do any savings. That savings is accumulated in balance sheet only. It is in the form of either FDs, it is in the form of gold, it is in the form of mutual funds, it is invested in the form of property, it is ultimately saved in the form of balance sheet only, assets in the balance sheet only. So at the time of exit tax now, government just focuses on balance sheet and whatever the assets are there with the trust, it charges taxes on that. FFV of assets are charged to taxes. Fair enough. How do we compute the accreted income? To compute the accreted income, we shall take the FMV of the total assets minus liabilities. This will give us the accreted income. Now, while computing the value of the total assets, there is a formula as to how do we find out the value of each asset. But three assets are never charged to exit tax. Three assets are never charged. What are those three assets? See, assets acquired out of agriculture income. See, if you buy assets from agriculture income, it is never charged to exit tax. Reason being, agriculture income was already exempt. So we had not claimed any separate exemption from that. Therefore, you will not be charged exit tax on these assets. Second thing, asset acquired before registration date. See, if you have acquired asset after registration, that means you must have acquired it by claiming exemption. But if you have acquired any asset before registration period, in that case, you are not charged exit tax on that asset. And third thing, if trust dissolve itself, lawmaker says that after dissolution, if trust has distributed the assets within 12 months now, then on such asset exit tax is not charged. On such assets exit taxes not charged. Okay. Now, how values are derived? See, if trust has liabilities, liabilities are taken at book value. But remember, corpus fund, accumulated fund, these are not liabilities. Reserves and surplus, provision for tax, unascertained liabilities, contingent liabilities, these are not liabilities. Okay, these are not liabilities. How we are going to take the value of the asset? See, value of assets are taken based on FMV. All the assets FMV shall be taken. Okay? Do not take income tax. Do not take any deferred revenue expenditure. You don't have to take them. How will you derive the FMV? See, if the trust has quoted shares. For example, there is a trust who has shares of, say, Hindustan Aeronautics. Then we shall take average trading price on the date of valuation. If no trading has been done, then last trading session we shall take. If trust has unquoted shares, we shall take A plus B minus L divided by PE into PV. We have done the same thing in black money law yesterday. If trust has any boolean, this is not actually trust. This is not about trust. This is about unlisted shares. If trust has shares of Rahul Private Limited, assume. So we will come to balance sheet of the Rahul Private Limited. If Rahul Private Limited has any bullion, jewelry, precious stone, artistic work, shares, securities, immovable property, then take FMV of that asset. Apart from that, if you have any other assets, like you have debtor, you have creditor, you have inventory. Of course, creditor you won't take, debtor, inventory. If you have cash balance, bank balance, these are taken at book value. Reduce the liability, but these are not liabilities. Divided by total share paid up share capital multiplied by paid up share capital held by you. So this is considered as unquoted shares value. This is how you will arrive at the unquoted shares. For example, if you have unquoted preference shares, unquoted securities like bonds, in that case, you shall take FMV as per merchant bankers or chartered accountants report. If trust has immovable property, in that case, SDV or FMV, whichever is higher, shall be taken. If trust has a sweet shop, 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 in that case, we shall take A plus B minus L. If trust has any other asset, for example, trust might have some FDs, वगैरह, trust might have some gold coins as well. In that case, valuation dates FMV we shall be taking. FMV on the valuation date we shall be taking. That is how we would arrive at the total assets. Now, on what day we do the valuation, that is less relevant. You can skip out. Whenever you are required to pay exit tax, within 14 days, you have to pay the exit tax. If you do not pay exit tax within 14 days, then what will happen? From 15th day onwards, you will be charged interest. From 15th day onwards, you will be charged interest. And how much interest you will be charged? 1% per month and part of the month till the date of actual payment. Sir, remember, if exit tax is not paid, then principal officer, trustee, trust institution will become assessee in default. They shall be treated as assessee in default. Apart from them, if dissolution happens and trust does not distribute its assets after dissolution, now, in that case, what happens? In that case, the recipient trust, sorry, if dissolution happens and trust distributes its assets to somebody else who is unregistered, in that case, such unregistered trust shall become assessee in default as well. And whatever your income is there, income tax will be continued to be applicable. But remember, exit tax is on the asset, this is on the accumulated income, and this shall continue to be charged. Last point, sir, till within 14 days, 14 days have to be calculated from when. See, if dissolution happens, so you have to distribute asset within 12 months. Okay. If within 12 months you cannot distribute, after the expiry of 12 months, within 14 days you have to pay. If not, then interest will be charged. In case of merger, within merger, 14 days you have to pay the exit tax. If you did not pay, then in that case, date of merger, 14 days, date of merger plus 14 days. After that, you will be charged exit tax. In case you converted yourself into non-eligible format, that means your registration is cancelled. Your registration is cancelled. You could go to IT80. If you did not go to IT80, then last day to go to IT80 plus 14. If you went to IT80 and order was passed against you, then in that case, order date plus 14 days, you have to pay the exit tax. If application for renewal was not made, then 14 days from the previous year end, If you did the modification in the objects, in that case, if application was rejected, then IT gone, not gone, plus 14 days. If you did not apply, then previous year and 14 days. That's it. That completes your charitable trust. We have electoral trust as well, and we have political parties as well. Just give me a minute and we will understand this with beauty. If political party has income from house property, income from capital gain, income from other sources, income from donation, it is absolutely exempt. Only income of political party that is taxed is PGBP. For example, Aam Aadmi Party sells brooms, it is taxable. BJP sells lotus, it is taxable. Samajwadi Party selling Harpik, it is taxable. DMK selling something. Communist Party selling something. This is taxable. You tell me which political party is ruling in your state, so that I will get to know which state you belong to, which political party is in your state. Please comment down in comment section. Okay? Now, only business income of the political party is taxable, and it is also taxed at slab rate. Okay? Slab rate of an individual. Remember, to claim the exemption, there are certain conditions that are to be fulfilled. Political party must maintain books of accounts and get themselves audited. And this political party shall file return under 139 4B. Remember, any donor who donates more than 20,000 rupees, now his name and address should be given. And any donation received more than 2,000 shall be via account, paycheck, demand draft, electronic clearing system only. If political party fails to fulfill the first three conditions, then entire exemptions of political party will be withdrawn. If political party fails to fulfill these two conditions, then only relevant income is taxed. That means, for example, out of 1 crore of donation received, political party has not maintained the details of just 6 donors. So only 6 donors' income would be taxed at slab. Rest all would be exempted. Electoral trust. Up till 50th concept we have reached. We have to reach 100 concepts. Oh dear God, 100 concepts. In TDS only we'll have 30-40 concepts. Okay, don't worry. Taxation of electoral trust. See, for example, like there is Tata Electoral Trust. Tata Electoral Trust is, for example, there is TCS, there is Tata Elxsi, there is Tata Motors, there is Tata Powers. All of them contribute to this entity. All of these institutes contributes to this Tata Electoral Trust. Now, what happens in this case? Huh? Sir, this electoral trust receives donation. It pays the donation to political party. It also earns interest as well. Oh, Janvi has BJP in her state. Janvi is from North India. Oh, half century. Which state she belongs to? She's from Maharashtra. I mean, Maharashtra, MP, Chhattisgarh, Rajasthan, Delhi, UP. With whichever state you count, BJP is there. Now, the electoral trust receives donation, pays the donation, receives the interest income. This is what electoral trust earns. Now, it's the duty of electoral trust to distribute at least 95% of their receipts. Current year receipts plus brought forward receipts. Out of that, 95% should be distributed by electoral trust. 95% should be distributed by electoral trust. That is what this point says. Okay? And this electoral trust shall function as per in accordance with the central government. This should function as per in accordance with the central government. What they say, sir, other income are fully taxable. That means interest income is fully taxable. Simple. From where this electoral trust can get the donation? See, Indian citizen can donate. Resident or non-resident, not relevant, but Indian citizen can donate. Company registered in India, any resident firm, AOP, BY. See, donor's PAN is required and non-resident's passport is required. But not a citizen of India cannot donate. Foreign entity, electoral trust, government company, any foreign source cannot donate any money. Remember, electoral trust has to get its books of accounts audited by a chartered accountant in Form 10BC, and that has to be furnished with ROI as well. Whenever donation is to be received by electoral trust, it should be by account, paycheck, demand of electronic clearing system only. And trust may spend only 5% of its receipts in managing its affairs, and that to 5 lakh in first year and 3 lakh in subsequent year. Let me take an example to illustrate. Trust received 600 lakh rupees, and it is electoral trust received 6 lakh rupees, and it is first year of operation. How much it should donate? Sir, it should donate at least minimum 95%. That means 570 it shall donate. This is minimum. How much money electoral trust can keep for its operations. How much money the electoral trust can keep for its operations? So it can keep 5% or 5 lakh, whichever is lower. That means 30 lakh or 5 lakh, whichever is lower. This is the first year of operation. If this would have been the second year of operation, then we would have taken 5% or 3 lakh, whichever is lower. This is the amount of expenditure that this electoral trust can keep for its operations. That is how we are going to solve it. 13b. I hope this topic is clear. Wow, sir, done with the chapter. Done with the chapter. Now you tell me which political party is in your state, and I will try to guess your state. If you say BJP, I might not be able to guess up, but if you say any other party, I might be able to guess. How you all are doing? All good. I was just looking at how much time I did take in English batch to reach this position. In English batch, I mean in English marathon, if I tell you na fairly speaking, not lying at all, not lying at all, we are already half an hour late. This happens, I don't know why in English. In English, we don't even talk a lot. That then too, I take more time to complete English. Chapter number 11. Only two chapters are left, basically TDS and assessment. And in assessment also, some portion is to be covered, not the entire. But yes, energy has to be there. Okay? Energy, full on energy has to be there. No uh, questions attached. Full energy unconditionally. Tax deducted at source. See, person making the payment is called deductor, and he is also the payer. Person receiving the payment is called the deductee, and he is also called the payee. Remember, TDS is deducted at the time of earlier of payment or credit, whichever is earlier. Whenever you pay to the person, it is whenever you pay to somebody, TDS is to be deducted, or when you credit. For example, interest expense debit to Satish. For example, I passed this entry. So I have credited the party now. I have credited the party, therefore TDS has to be deducted at this juncture as well. So payment or credit, whichever is earlier. But there are 8 instances where you have to deduct the TDS only at the time of payment. What are those 8 instances? Salary payment, EPF payment, dividend payment, winning payment, LIP payment, compensation payment, cash payment, insurance payment, perquisite payment. These are the 8 instances where you have to deduct the TDS at the time of payment only. Okay. Now, TDS rates are normally fixed. TDS rates are normally fixed, but for salary and this non-resident, we have to check. Okay. Important consideration, whenever you pay any sum to somebody and you have to deduct TDS, but you did not deduct TDS, what will happen? So 30%, 100% will be disallowed to us, but it is the responsibility of the deductee to consider this income and pay taxes. This is the first thing, we already know that. Second thing, so if we deduct a TDS but not paid to government, what will happen? So again, 30%, 100% would be disallowed. But whether deductee would get credit for this? Right answer is yes, deductee would get credit for this. Deductee would absolutely get credit for this. If we deduct TDS but not paid to government now, deductee would get credit for this. TDS is never applicable on GST component, whereas TCS is applicable on GST component. TCS is applicable. Okay? Done, sir. Done, sir. TDS on salary. Whenever employer gives any salary to the employee, he shall take up the salary component. plus other incomes as well, and calculate the taxes. Under what regime taxes will be calculated? Under 115 BAC by default. But if assessee says old, then old shall be taken. Taxes calculation shall be taken place. Taxes calculation. In this taxes, employer shall consider the other TDS deducted, and this will be TDS deductible. TDS deductible for this employee. So while considering the total income, whatever the taxes that turn out to be, employer shall consider that TDS has to be deducted accordingly. Whether employer is going to consider the deductions, exemptions, or any kind of losses. See, deductions will only be considered if proof has been submitted. Exemptions will only be taken when proof has been submitted. At last, so any losses, see, house property loss would be taken, otherwise no other losses will be taken. Okay. For example, if employer is paying arrears of salary, I mean employer and employee salary is disputed from months, years. Employer is paying arrears of salary, disputed salary. In that case, what happens? See, after considering the relief under section 89, then only TDS is to be deducted. If employer bears non-monetary perquisites taxes, in that case, TDS on that is not applicable. Sometimes, very important, sometimes employee might have worked for two organizations. What do I mean? If employee has worked at TCS also, at Reliance also, and I am working and I am working at Reliance as of now. Lawmaker says if I work at Reliance, then it's the duty of Reliance to consider my TCS income as well. Consider such income, calculate taxes, and deduct a TDS accordingly. At last, not last, but if any partnership firm pays any interest to partnership firm pays any salary to partner, 192 is not attracted. And at last, sir, any tip paid to waiter is not salary. Customer coming to hotel, tipping extra amount, this does not amount to salary. Section 192 for you all. Section 192. See, I have selected 100 questions. But in between also, these are small topics. My heart doesn't let me move. My heart doesn't let me skip these topics. Therefore, I had marked 100 topics to cover. But willingly, unwillingly, I have covered entire income tax for you all. Okay. So, accumulated balance of PF. See, every year your employer contribute to your PF, Provident Fund. Okay. Whenever you withdraw money from that PF, it is either taxable, it is either exempt. It might happen anyway. Okay. If it is exempt, no TDS implication will apply. If it is taxable, and if it is 50,000 or more, in that case, TDS would be deducted at the rate of 10%. Then we have interest on securities. For example, if a company pays interest to me on bonds, companies pays interest to me on debentures, in that case, they have to deduct a TDS at the rate of 10%. Any person paying interest on bonds will deduct a TDS at the rate of 10% of resident. Remember, if interest paid individually or aggregate is up to 10,000 rupees, no TDS is applicable. Up to 10,000, I paid to anybody, no TDS applicable. This is amendment. If it is interest is paid to insurance companies like LIC, GIC, no TDS is applicable. If interest is paid on government securities, government itself is paying. Do you think that government will deduct TDS? No, sir. If DMAT securities interest is paid, no TDS. At last, sir, if interest is paid on Power Finance Corporation Limited or Indian Railway Finance Corporation Limited 54 EC bonds, then no TDS is applicable. See, what did I say? Any person paying interest on bonds, securities, will deduct TDS at the rate of 10% under 193. Important here is if interest paid up to 10,000 rupees, no TDS. DMAT securities, government securities, Power Finance Corporation Limited, Indian Railway Finance Corporation Limited, GIC, LIC, no TDS is to be deducted. Section 193 for you all. Section 194. Wow, sir. Now pointers are going very fast. Point number 54 or section number 194. Whenever anybody pays dividend, what happens in this case? So TDS is deducted at the time of payment. If a domestic company, domestic company only has an obligation to deduct TDS, foreign company doesn't have. So domestic company paying to a resident person now shall deduct a TDS at the rate of 10% on every dividend paid by it, be it deemed a dividend, be it interim dividend, be it final dividend. Every dividend that this company pays will attract a TDS. But if it is paid if it is paid to an individual other than cash up to 10,000, then TDS is not applicable. But if it is paid more than 10,000 rupees, then TDS is deducted for individual as well. Acha, if you pay to LIC, GIC, then TDS is not applicable. Interest other than securities, 194A. What does this say? See, if interest is paid on securities like bonds and debentures, it is covered above. But what about it is not on securities? Interest is not on securities. For example, FD. For example, interest is paid on delayed payment. Interest is paid on loan taken. Anywhere now, interest can be there. So in this case, now TDS is to be deducted by hijacker people. These people would come multiple places. What are these hijacker people? Let me tell you. What did I say? Hijacker people. Hijacker people. What does this hijacker people means? See, under 194 HIJACRS, in these 7 sections. In these 7 sections, now who is the deductor? See, everybody is a deductor. Every company, AOP, BOI, artificial juridical person for a company, any LLP, everybody has to deduct TDS. But individual HUF shall only deduct a TDS if their turnover in preceding financial year exceeds 1 crore. Hijacker means everybody will deduct TDS in these sections. But individual HUF will only deduct TDS if their turnover in last year exceeds 1 crore or their professional receipts exceeds 50 lakh rupees. Okay? TDS will be deducted of a resident person at the rate of 10%. Now, here section is not important. Rather, what is important is where TDS will not be deducted. Where TDS will not be deducted. See, if interest is paid on a savings account, then TDS is not deducted. If interest is paid on income tax refund, TDS is not deducted. If interest is paid by a partnership firm to partner, TDS is not deducted. If bank pays you any interest on FDRD, post office pays any interest to you on FDRD, anybody pays, okay, government, cooperative bank, NBFC, anybody pays you interest on FDRD up to 50,000 rupees, they will not deduct TDS. And if you are a senior citizen, then up to 1 lakh rupees. If non-resident, if senior citizen, if payment is made to senior citizen, then up to 1 lakh rupees of interest TDS is not required to be deducted. What does Kumar says? Confusing when TDS is required to be deducted other than 195. Point. Kumar, can you tell me what are the tax TDS rates available with us? Can you tell me? Just taking 1 minute off just to relax my mind as well. Can you tell me what TDS rates we have? Sir, we have 0.1%. At some cases, we have 1% as well, TDS rate. In some cases, we have 2%. 5% we don't have. We have 10%. In some cases, we have 20% as well. In some cases, we have 30% as well. This is the maximum TDS rate. Yes, wherever 20% and 30% is there now, we do not have any difference between resident and non-resident. We have to deduct of non-resident, non-resident only. Both the cases we have to deduct. Perfect. For 20% and 30%, we have resident and non-resident both. Wherever we have 1%, 2%, it is never non-resident. Never ever you will see that non-resident TDS is deducted by 1%, 2%. In case of 10% also, we have 2 or 3 sections where we have some sections where we have 10%. See, lower tax rate benefit is never given to non-resident. If you understand non-resident taxation now, you will realize that whatever the tax rate is in the hands of the non-resident now is the TDS rate applicable to him. And no income of non-resident is taxed at a lower price. If he is earning income from business trust, 5% income tax rate, 5% TDS rate. So you don't have to get confused. If it is 30% rate, then it will be applicable to resident, non-resident also. If it is salary, applicable to resident, non-resident as well. If it is lottery, online gaming, virtual digital asset, it will be applicable same it is. Okay? Virtual digital asset 1% will not be applicable. 1% is very less for a non-resident. But otherwise, I'm telling now, this 30% rate wherever is applicable or 20% in 194, wherever applicable, it shall be considered for non-resident only. Rest all is for resident. You will see that all is for non-resident. Now, if interest is paid by one person to another person, what does that mean? See, if I take loan from Kumar and I pay interest to Kumar, in that case, I have to deduct the TDS if I pay interest more than 10,000 rupees. If interest is paid on zero coupon bond, then TDS is not required. If interest is paid to bank, cooperative bank, financial institutions, insurance companies, no TDS is required. See, TDS in 195, TDS is taken at rate in force. Oh. We shall come on to that. Remind me this later on. I will tell you this. I will describe this thing to you. Okay. What does this say? Interest. If we pay any interest to, if we pay interest to bank, we don't deduct TDS. If we pay interest to cooperative bank, no TDS. If we pay interest to financial institutions or insurance companies, no TDS. But if we pay interest to NBFC, we have to deduct a TDS. We have to, or we might have to deduct a TDS. Sir, ठीक है. Got it. Gotcha. Sir, if a cooperative society pays interest to a member, no TDS. But sir, if cooperative society has turnover greater than 50 crore rupees, then if interest is paid more than 50,000 rupees now, then TDS is to be deducted. And for senior citizen, if the interest is paid more than 1 lakh rupees, then TDS is to be deducted. Ideally, for a cooperative, TDS is not deducted. TDS is not deducted by cooperative society to its members. But if interest is paid more than 50,000 or 1 lakh and cooperative society has turnover more than 50 crore in last year, okay, in that case, TDS will be deducted. If a cooperative bank pays any interest to society, no TDS. If a motor accident claim tribunal awards any compensation and on that compensation interest is also given, so up to 50,000 TDS is not given. See, sometimes you have account at bank. Okay, sometimes you have account at bank. Bank create a provision account of yours. Bank create a provision account, and what happens in this provision account? Let me tell you. They regularly credit interest to your provision account so that they are aware as to how much is your interest expense. On day-to-day basis, your provision account is being credited with interest. Day to day, you have been given with the provision account, and your interest is credited on provision account. Your actual credit is not taking place, but on provision basis, daily interest is being credited. Lawmaker says if your provisional account is being credited with interest on daily basis, now in that case, what will happen? This is not taxed. This is simply not subject to TDS because this is not actual credit into account. It is just a provisional credit. This is not subject to TDS. Sometimes you get interest on CGAS as well. What happens in that case, sir? If in case you get interest on CGAS, TDS is deducted in the hands of the person who deposits. But if that person deceased, the person dies, then his legal hire would be subject to TDS. See, whenever you check the interest, it is always bank-wise. It is not branch-wise. What does that mean? Try understanding this. Okay? If I have FD at HDFC Bank, SDFC Bank pays me 40,000 rupees, SBI pays me 40,000 rupees, and ICICI pays me 40,000 rupees. All are within the threshold limit. That means all are up to 50,000 rupees. In that case, TDS is not applicable. TDS is not applicable if all are paying me 50,000 rupees. TDS is not applicable. Fine, fair enough. Yes, sir, fair enough. But sir, if its HDFC has 3 branches, SDFC in Coimbatore, SDFC in Chennai, SDFC in Hyderabad, all of them are paying me 40,000 rupees, then in that case, you have to club all the interest of the branches because you have to check bank wise, not the branch wise. Okay? Sometimes what happens is when property ownership is disputed, what happens? Property goes to court and court deposits this property in the name of the registrar of the court with the bank. Okay? Now bank pays interest, bank receives interest. I mean, see, whatever the money court receives, now court deposits that money in the bank FD. Okay? Now bank pays this interest to registrar of the court, and whenever the case is settled, now court remits this money to the owner. Court just as acts as a custodian of the custodian of the funds. Court is not the owner of the fund. Court is just the custodian of the fund. Whenever court receives the interest, in that case, this interest is later on remitted to the owners. This interest is remitted to the owners. In this case, bank is not required to deduct a TDS of court. Why? Because here court is not even actual receiver. Court is just the custodian of the funds. Therefore, it is not the TDS of the court. TDS will not be deducted in the hands of the court. 194B talks about winnings and 194BB talks about horse races. If you win any kind of winnings, betting, lottery, gambling, or any kind of horse racing, and your per transaction winning is more than 10,000 rupees, then that company is required to deduct a 30% TDS. Fair enough. TDS is deducted at the time of payment. Sir, for example, I went to a casino and won a Audi car. Okay, Audi car. Audi. Now, in that case, how they can deduct a 30% TDS? Are they going to take away the tires? Are they going to take away the seats? Are they going to take away the engine? Lawmaker says no, 30% TDS will be deducted on the money component. Sir, but what about the gift is in kind? In that case, they will take money from me, or they will request me to pay the advance tax, or they will bear this off their own pocket. But anyhow, they will release asset only if they receive the money and that money is deposited to the government. Gotcha, sir, gotcha. Sir, TDS will be deducted only on gross basis. For example, I had 10,000 rupees. I invested and earned 50,000 rupees and lost 20,000 rupees. So ultimately, whatever I have, lawmaker says that this gross winnings will be subject to TDS. Gross winnings would be subject to TDS. That's it. Online gaming, you can skip out. There is only one question in online gaming. I have done that in Super 150 questions. You can refer that point. Otherwise, you don't have to do. Whatever withdrawals are there, now withdrawals minus opening balance minus deposits is the amount of TDS. Or at the time of closing balance plus withdrawals minus opening balance minus deposits minus the amount on which TDS has been deducted. This is the formula that you have to use for TDS deduction in online gaming. Otherwise, you don't have to consider anything. 194C. TDS on contract. Let's take some break here. Let's take a small break. Let's take a small break. It is 6:08. We will have break till 6:20. Let's take a small break. We shall continue after the break. Welcome back from break. Are you back from break? Yes, sir, we are back. Chal. Of course, it requires a lot of effort from your end as well to sit for this long and process things. But yes, every minute given at this juncture of exam is worth it. Moving on to question chap section 196, 194C. Now, who is required to deduct TDS under 194C? Every hijacker. That means every assessee is required to deduct, but individual HUF will only deduct if the turnover is up to 1 crore in preceding financial year. Resident person TDS is deducted. Ideal case scenario 1% TDS for individual HUF and 2% for others rate is applicable. When TDS is not applicable, carefully listen, when TDS is not applicable, if a single contract is up to 30,000 rupees plus aggregate contract is up to 1 lakh rupees, in that case TDS is not deducted. If single exceeds 30,000, TDS deducted. If aggregate exceeds 1 lakh rupees, TDS is deducted. If contractual payment is made for personal purposes, then TDS is not deducted. For personal purpose, TDS is not deducted at all by individual HUF. Now, work includes any advertisement, any broadcasting, any telecasting, any catering. For example, you make payment for advertisement, for broadcasting, for telecasting, for catering, then TDS is deducted. For transportation of goods, for example, from Indore to Chennai, I want to transport the goods. TDS is applicable. For transportation of passengers, for example, I am getting married. Okay, for example, I am getting married and I want all the students to be a part of this wedding and I am getting married at Goa. Only condition is that you have to come to Indore. We will go via road trip and have go and enjoy my wedding at Goa. Okay. The best part, okay, but you are very native to Goa, you are very close to Goa, so you will not enjoy that a lot. But let's assume everybody comes to Indore and we all go to Goa via road trip. Provision says if you pay any sum for transportation of passengers, now that shall be considered as 194C wala TDS. In this case, any payment made to railways, wow, sir, wow, wow. Any payment made to railways shall not attract TDS under 194C. Now, you will not believe this, but I have been working really hard. If I check out the time, it is 8 hour 22 minutes since I have been speaking. Of course, if we take out the break, then still 7 hours plus I have been continuously speaking. But there is some issue, some small issue. Students don't want to share. Students are so selfish these days now that they don't want to share these classes to all. They want to keep the secret to themselves. They want to secret you. They want to. I mean, the elegance of this class should be secreted. Students don't want to share this because students are afraid that if we share this class to others, others would pass. Therefore, students are not sharing my classes. I am assuming that maybe that's the reason. So what I did now, of course, I always request everybody to subscribe to the channel, to like to the video, to hype the video, to comment down on expense. I request everything. Every time I request, and even I request you to as well. I request to you as well that subscribe to channel, like the video, comment and hype the video. I request you as well. But somehow now I was not getting the reach. So what I did, I went to Chodu. I went to Chodu and I said, Chodu, hey Chodu. I went to Chodu. I said, hey Chodu, hey Chodu, hey Chodu. Are you going to stitch blazers for me? I thought, whoever will enroll for my class now, I will give him free blazers. Whoever will enroll for my class now, I will give him free blazers. I had bought piece of material, gave this material to Chotu. Chotu stitched the blazers and built 100 blazers for say 70,000, 700 rupees per blazer. 70,000 rupees was the bill raised by Chotu. Point here is whether TDS would be attracted here in this case or not. Right answer is yes, TDS would be attracted. If I have supplied goods to Chotu and Chotu processes on those goods, Chotu processes on those goods and returns to me, it is nothing but a job work. And job work is covered under 194C. Care. I am sure that I don't have to repeat every time that you have to like the video and subscribe to channel. You must have done this by now. You must have done this by now. If you have not done this, I mean, if I was allowed to slap, if I was allowed to slap somebody, I would slap myself. Sir, please stop overacting. Okay. See, understand, huh? If you supply goods to the Chotu or any job worker and he works on that, then it is always job work and TDS under 194C is applicable. But, sir, if you don't supply, there is somebody else. There is somebody else who supplies the goods. For example, there is my mother, father, brother, sister, LA, LD, or my spouse supplies the goods to Chotu. If my mother, father, brother, sister, LA, LD supplies goods to Chotu, in that case, what would happen? Sir, in that case, what would happen? In that case, again, it will be job work. If I supply goods or my relative supply goods, now it is considered as job work only. But sir, if Chotu purchases goods of his own and sell the goods to me, does the processing work and sell those goods to me, lawmaker says that it is not job work. TDS under 194C is not applicable. If I give goods, Chotu processes, my relative goods gives the goods that Chotu processes, then it is job work. But if Chotu purchases of his own, then it is not gift, it is not job work. Okay? If you pay for transportation of goods to a transporter who is covered under 44A, in the morning we studied na 44A. Every topic has been studied in the morning only. If you make payment to a transporter who is covered under 44A, in that case TDS will not be deducted if he gives a declaration. Okay? If job worker gives you a bill where he has separately mentioned the material component, if he has mentioned material component, now you don't have to deduct TDS on material component, only on the labor services component you have to deduct. And if material is not specifically mentioned, in that case, what happens? So TDS is deducted on entire invoice value. Sir, for example, as of now, I run a TV channel. For example, I run a TV channel named Star Plus. And I see Pogo shows Chota Bheem. Chota Bheem is very popular at Pogo. I thought, why not Star Plus is showing Chota Bheem? Why not Star Plus is showing Chota Bheem? So I went into directors of Chota Bheem and bought Chota Bheem as a whole. From today onwards, Star Plus will show Chota Bheem. Lawmaker says whenever you acquire an already existing TV show, in that case it is not 194C. But sir, what if I went to directors of Chota Bheem and requested them to create the Chota Arjun? To create Chota Arjun. In that case, what will happen? In that case, TDS under 194C would apply. So if I request TV show creation based on my specification, it is 194C wala contract. Sometimes you pay to event manager for multiple services, for catering as well, for grounds as well, for marriage garden as well, for multiple services you pay. In that case, what happens? In that case, it is a bunch of services under 194C is applicable. Sometimes you pay for cold storage facility, where you get cold storage as well, where you get storage as well. Cold storage facility you get storage as well. In this case, you get a bunch of activities. Now, in this bunch of activities, what will happen? It will be 194C and not 194I. Sometimes airlines pay certain sum to airport authority. Airlines pay certain sum to airport authority. In that case, what happens? Sir, they are getting in return some upkeep charges. They are getting some security, surveillance, maintenance. Many things are returned. In that case, the TDS is deducted under 194C only. Airlines paying some money to airport for bunch of services like traffic service, ground safety. This would attract TDS under 194C and not under 194I. This transportation of gas you can skip out. What Kishore says, sir, renting of banquet hall for conference or event along with the food Does it constitute under TDS under acha. See it depends upon, see, if a contract hall is very big and it is very insignificant now, the other activity food is very insignificant now, then we can call it rent only. But if prices are almost equal now, in that case we might consider it as bunch of activities and we might call it a contract. Okay, it depends upon price as well. Okay. 194D insurance commission. Do you remember when you were a child, an auntie used to come to your mom, your mother, and she used to say, Didi, 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 take insurance for your child. She used to, stick the insurance to your family. She used to forcefully sell the insurance. Lawmaker says she doesn't do of her own. She gets commission. Whatever insurance commission is paid to anybody, now if that insurance commission exceeds 20,000 rupees per annum, in that case, person paying that insurance commission to resident person shall deduct a TDS at the rate of 2%. If that commission is paid to a domestic company, then 10% TDS rate is applicable. There is a small catch, very small catch. What happens? For example, this is Rahul. I went to HDFC to get myself insured. I paid 250 crore rupees for 1 year of insurance, but I want a cover of 10,000 crore. Oh wow. SDFC, it's SDFC in itself is very scared. So SDFC co-insured itself with Aditya Birla. That means if anything happens to me, 50% money would be paid by Aditya Birla, 50% would be paid by HDFC. And premium will also be divided. Can I say after a year, if I pay this premium to HDFC, HDFC shares 50% to Aditya Birla Sun Life. In that case, can I simply say that it is a commission given? Right answer is no, it is not commission given. Why it is not commission given? Because ultimately risk is also with Aditya Birla. Na? What is commission? Commission is nothing but if I clearly state what is commission, commission is earning without any risk. Earning without any risk. If you earn something without taking any risk, it is commission. You don't have any loss. There is no possibility of loss. That then it is commission. Here in this case, loss is split by both of them. Therefore, profit is also split. So there is principal relationship. Focus on words. Principal relationship is there now. Since there is principal relationship, it is not commission. It is never commission. Therefore, share of insurance commission by two insurance companies can never amount to commission. 194 DA. What this section says, see, whenever there happens a maturity of life insurance policy and that maturity is taxable. When maturity is taxable, sir, if annual premium is more than 10% or annual premium is more than 5 lakh rupees, then maturity is taxable. Then whatever the sum received minus premium paid is, on that 2% TDS would be deducted if maturing amount is more than 1 lakh rupees. If maturing amount is more than 1 lakh rupees. 194E, what this says, if any non-resident sports person is being paid some sum, then 20% paid some sum with some, sir, any sports payment, any advertisement payment, any article payment. If this payment is made to non-resident sports person, then 20% TDS plus applicable surcharge is to be deducted. But exclude umpire, referee, and commentator, these are not covered here. If any sports association is being paid, then 20% TDS plus applicable surcharge. If any entertainer is being paid now, lawmaker says that for whatever services they are providing, entertainment services they are providing now, TDS will be deducted at the rate of 20%. Remember, these sports person should be non-resident and non-citizens. 194G, what this says, if company or anybody distributes lottery commission and that lottery commission exceeds more than 20,000 rupees per annum, in that case 2% TDS is to be deducted for that agent. 194H, normal commission. See, lottery commission is covered under 194G. Insurance commission is covered under 194D. Whatever the other commissions are there are covered under 194H. Here, who deducts the TDS? Lawmaker says again, hijacker people deduct the TDS. That means every assessee deduct TDS under this section, but individual HF will only deduct TDS if their turnover exceeds 1 crore in preceding financial year. They pay commission to resident person. Aggregate commission in a year exceeds 20,000 rupees and TDS rate applicable is 2%. Now here are certain examples which are important for our understanding. First of all, whenever any company comes up with a public issue, So it pays certain fees to underwriters. Lawmaker says if underwriters are paid any money, it is not commission. Why? Because underwriters take a risk as well. If there is loss, they have to bear the losses as well. So underwriters is a principal relationship. It is not commission paid to underwriters. Even though we call it commission, but it is not commission. I don't know how old you are, but I am very old. I mean, I have seen that time where beside my house there was a PCO. I used to put a coin of a rupee coin, and I used to get a 1 minute talk time to talk to anybody. 1 rupee coin I used to put in machine telephone PCO, and I used to get 1 minute of talk time. 10 minutes, 10 rupees I used to pay. I don't know how I mean which era you belong to, but I belong to that era. Now what happens is whenever I used to pay 60 of 1 rupee, out of that, 60% was retained by the owner, 40% transferred to BSNL office because this telephone was of BSNL. The network provided was of the BSNL. Space premise was the owner. Telephone was provided by BSNL. So there is actually a partnership happening. It is a partnership happening now. In this case, it is a split of revenue. It is not a commission being paid. So it is not considered as commission. Then important, sir. Sometimes there are some travel agents and there are some airlines company. For example, Indigo is an airlines company. Indigo has a flight going from Indore to Mauritius, which is worth rupees 25,000 rupees. Now these flight tickets are sold by Make My Trip as well. These flight tickets are sold by Travel Yatri as well. Even Goa Ibibo sell these tickets at 25,000 rupees. Whenever Goa Ibibo sells these tickets, now he earns 5%. It earns 5% percentage from 5% commission on the sales. This commission is flat deductible under 194H. No questions attached. But sometimes what happens is कि Goa Bibo sells these tickets at a higher price. For example, 25,000 is the ticket price. Goa Bibo might sell it as at 32 rupees, 32,000 rupees. Lawmaker says this is nothing but extra payment made, extra price sold by the Goa Bibo. This is called supplementary commission, and this shall also be attracting TDS. Why, sir? Why this is attracting TDS? The reason is very simple. Government says if Goa Bibo is able to sell at a higher price, it is earning profit. But what if Goa Bibo is not able to sell? No profit is distributed. No losses of Goa Bibo. So Goa Bibo is an agent here. There is a principal agent relationship happening now. In that case, whatever payment you make to an agent, that is commission only. Bottom line is you have to check the principal agent relationship. Always principal agent relationship is to be checked. If person receiving the money also receives the losses as well, not just profit but also has a participation in losses as well, in that case what happens? In that case it is loss of both, and therefore it is not commission. But if only person receives only for profit, no losses, then it is commission. Here Goa Ibibo had only profits, no losses, so it is commission. Sometimes what happens is a company used to give the startup kits to the franchisees. For example, I own a franchisee of any company. They sell their startup kits at 1,000 rupees, and these startup kits have been given to me at 800 rupees so that I can sell. Now, this discount is given to me. If I'm able to sell that startup kits, I will earn the profit. If I'm not able to sell the startup kits, it is a loss to me. So, I am there to bear the profits. I am there to bear the losses. Therefore, it is a principal relation now. We both are sharing the profits, we both are sharing the losses. So ultimately I am not the agent now. Therefore any discount given to me for prepaid connections or likewise things, it is not commission. It was said by Bharti Cellular case law in case of Supreme Court. It was said by Supreme Court in case of Bharti Cellular case law. We also had an example which was Stamp Vendor Association. What the example was, see, the lawyers buy the stamp paper at a discounted price. For example, if a stamp paper is of 1,000 rupees, lawyer used to 10 rupees का 7.91 रुपी, ठीक है, 7 रुपी 91 पैसा, 7 रुपी 91 पैसा we used to get, ठीक है, 7. But this is about the scratch card. This was the scratch card. There was a PCO concept, ठीक है. PCO concept was outside where you used to put a 1 rupee coin and you used to get 60 minutes, 60 seconds talk time. This was a PCO. You are talking about mobile phone SIM card, ठीक है. Now, What is the stamp vendor association? What was this example? See, lawyers get the stamp paper from court at a discounted price. Whenever lawyer gets these stamp paper at discounted price, now this discount is not a commission, because ultimately if lawyers are not able to sell these stamp paper, it is their loss. Therefore, any discount given to them is not commission. This is 194H. Acha, there is another point. Sometimes na banks pay ATM network providers some fees. See, like SBI doesn't run all of its ATM. All of the ATMs are run by the cash management agencies. Okay. So if SBI pays any money to these cash management agencies as a percentage of cash handled, it is not commission. Because if these companies do any losses, it will be loss to them only. So ultimately, it is not commission. Whatever payment is being done, it is fees only. 194I, what this 194I says, if you pay rent on plant and machinery, equipment, building, furniture, and land, on 5 asset or on anything you pay the rent, TDS is deducted under 194I. Who is going to deduct TDS? Lawmaker says if you are a hijacker, that means if you are any SSC, but if you are an individual HF whose turnover in preceding financial year exceeds 1 crore rupees, then only you are hijacker. You have to deduct TDS. If you pay any rent to a resident person, you shall deduct a TDS on land, building, furniture 10%, plant and machinery, office equipments 2%. TDS is only deducted if rent payment per month exceeds 50,000 rupees. Per month rent payment exceeds 50,000 rupees. Sir, individually it might happen that 10,000 for land, 20,000 for machinery, 15,000 for furniture, 50,000. It is not relevant. We have to club all the rent paid to the single person. If it exceeds 50,000 rupees, we have to deduct TDS on the entire amount. See, if you have ever been to hostel, now, there is a concept of advance rent prevailing in the hostels. There is a concept of advance rent. What is advance rent? See, 2-month fees you have to give extra. 2-month advance rent you have to give. For example, 10,000 is the rent of the hostel now, so you have to give 2-month rent extra. What happens of this 2-month rent? 3-month rent sometimes given. So 3 months advance rent you have to give. Sometimes this happens. Now, what happens to this now? See, whenever we give advance rent now, we have to at least tell 3 months prior when we are leaving, so that our last 3 months rent is not paid, rather it is just adjusted from already paid money. This is the concept of advance rent. Whenever you want to leave now, we have to intimate at least 3 months prior, so that they can find new tenant, and whatever advance rent we pay now, it is never refunded, it is just adjusted. Lawmaker says if there is any advance rent which is non-refundable in nature, so TDS will be deducted on that advance rent as well under 194I. If there is non-refundable deposit, that shall also attract a TDS under this section. Non-refundable advances, non-refundable. So this type of advances are not refundable. These are just adjusted. So this shall also attract a TDS under this section. If you take motor vehicle on rent basis for transportation, then TDS shall be applicable under 194I also, because motor vehicle is a plant and machinery. If you pay arrears of rent, if you pay advance rent, na TDS is applicable under 194I only. Arrears, advance, both the rents are applicable. On both the rents, TDS is applicable. Remember, if 2 people collectively buy a property, then 50,000 limit is to be taken individual basis. For example, there is a hall. Me and my wife takes them. I also pay 30,000 and my wife also pays 30,000 rupees of rent. Overall rent is 50,000 rupees. Overall rent is more than 50,000 rupees. Provision says TDS under 194I is not applicable, because this 50,000 limit is applicable for different owners. For each owner, you have to check 50,000 limit separately. Done. Done. Come on to 194 IA, IB, IC. These 3 sections. Listen, very carefully listen. Whenever you buy any immovable property, sir, which immovable property? Any immovable property other than a rural agriculture land. A rural agriculture land is just excluded. Otherwise, every property is covered here. If any buyer who makes payment to a resident seller, see, of course, TDS, whose TDS is deducted should be resident. A resident TDS deducted. If any buyer makes payment to a seller, then he shall deduct TDS at the rate of 1% of consideration or SDV, whichever is higher. Consideration or SDV, whichever is higher, 1% we shall deduct TDS. 1% of consideration SDV, whichever is higher. Sir, if both consideration and SDV are lesser than 50 lakh rupees, both consideration and SDV are lesser than 50 lakh rupees, then no TDS is applicable. No TDS, literally no TDS is applicable if both consideration and SDV are more than 50 lakh rupees, no TDS is applicable. Remember, whenever we take consideration, we shall take the original cost plus whatever the parking charges are there, electricity charges are there, maintenance fees, incidental charges, whatever charges, incidental charges that have been asked to pay now, that shall also form part of consideration. So SDV plus consideration, and consideration that too including every ancillary things. Every ancillary things are to be considered for the purpose of consideration. Sir, fair enough. Fair enough. Sometimes what happens is now two buyers collectively buy a single property. Two buyers collectively buy a single property. Lawmaker says for the purpose of 194 IA, you have to club all the buyers for checking out the limit. Now here comes the hypocrisy. Let me tell you. See, this is Rahul and this is Rahul's wife. If I pay rent to somebody 30,000 rupees and my wife pays rent to somebody 30,000 rupees, our total rent is 60,000 rupees to the single person. But TDS under 194I is not applicable because simple reason being key 50,000 is per person limit. But if we both of them buy the same house at 30 lakh rupees and my wife also pays 30 lakh rupees, house bought is 60 lakh rupees, then 194 IA is applicable. See, this is the discrepancy. This might be tested in exam. I don't know. I have a very strong feeling that this can be tested. But see, this is a discrepancy. Under 194 I, 50,000 limit is for per owner basis. But under IA, 50 lakh limit is to be clubbed of all the owners. Maybe ICI, anybody from ICI watches this video and correct this in Bear Act, or maybe, oh sorry, ICI can give a recommendation for Bear Act. Maybe they ask an exam by watching this video. Who knows? Paper is already sent out, but the examiner might not watch this video. Second. Now, how TDS is deducted? See, whenever you deduct a TDS under 194 INA, you have to furnish Form 26 QB. To submit Form 26 QB within 1 month from the end of the month of TDS deduction. 194 IB, what this 194 IB says? See, 194 IB says you have been rejected. From where you have been rejected? You have been rejected from 194 I. That means your turnover was lesser than 1 crore. In that case, if you have been rejected there now, you have to deduct TDS on immovable property under IB. That means any individual HF whose turnover is lesser than 1 crore now will deduct TDS here. What they say, see, they have to deduct TDS of a resident seller and TDS at the rate of 2% here. Under 194 I now we had a 10%, but here we have 2% TDS. When TDS is deducted, so TDS is deducted if annual monthly rent is more than 50,000. Same provision, monthly rent is more than 50,000, then only TDS is deducted. Sir, when TDS is deducted, that is important. TDS is deducted annually at once in the last month's rent. Whenever you are paying the last month rent, then only you have to deduct the TDS. That is the first thing. Second thing that you have to do is, sir, if tenancy is vacated before, not a tenant is not staying till last date, tenancy is vacated before. In that case, what happens? Sir, you have to deduct a TDS in the last month of tenancy. Sometimes what happens is we want to deduct it, we want to deduct a TDS at a higher price. I mean, we want to deduct TDS, but other party is not furnishing the PAN. Is it possible that the other party might not furnish PAN? It is possible. In that case, we might have to deduct TDS at a higher rate. That is 20% we might have to deduct TDS. Basic fundamental test. 20% might be the TDS rate. Fair enough. Issue further is we might have to deduct TDS 20%, but 20% TDS might not be sufficient. What does that mean? See, if our annual monthly rent is 60,000, 12-month rent is 720. 20% TDS turns out to be 1,44,000. We only have to deduct the TDS in the last month's rent. That means in March. Now, March month rent is just 60,000 rupees. Just tell me, how can we deduct a TDS of 144 from 60,000 of rent? Maximum we can take 60,000 only now. Either we have to take money from them, which is not going to happen. So are you understanding? We have to deduct a TDS 20%. This is one provision. Second provision is we have to deduct TDS in last month rent only. So how do we settle these two things? Lawmaker says if last month rent is not sufficient to deduct a 20% TDS, in that case, maximum TDS that you are going to deduct is last month rent only. Maximum 60,000 is only to be deducted. If you want to deduct a TDS, deposit TDS, then Form 26 QC is to be furnished. 194 IC, what this 194 IC says, see, if I have a property and I give this property to a developer under joint development agreement, and under joint development agreement, this property is getting constructed and I get property in return. In that case, what happens? The TDS under 194 IC would be deducted on the money component paid by this developer. See, developer would give me money, developer would give me assets as well, property as well. Lawmaker says the TDS would be only deducted on this money component, not on any other component. At the rate of 10% TDS would be deducted. 194J. You pay 5 kinds of fees. Sir, what 5 kinds of fees? First of all, professional fees, technical fees, royalty, FTS, non-competition fees. Professional fees, technical fees, royalty, FTS, non-competition fees. If you pay 5 kinds of fees, and you are a hijacker, that means you are any assessee except for individual HF whose turnover is more than 1 crore. You are paying any sum to a resident. Then normally you would deduct 10% TDS, but for technical services, 2%. Royalty for cinematographic films, 2%. And royalty payment to call centers, 2%. This is the amount of TDS you have to deduct. Remember, for every payment now you have to check the limit of 50,000 rupees. That means if professional fees is paid up to 50,000, no TDS. Technical fees paid up to 50,000, no TDS. Royalty paid up to 50,000, no TDS. Non-competition fees up to 50,000, no TDS. Director remuneration, even a rupee paid, then TDS is to be deducted. Remember, this 50,000 limit is per person basis. What does this per person basis imply? Sir, per person basis imply, sir, sorry, per payment basis it imply. For example, if I pay 30,000 rupees to Kishore as professional fees and 30,000 rupees to Kishore only as technical fees, do I have to deduct TDS? Total payment is 60,000. Do I have to deduct TDS? Right answer is no. No. If the other person, this 50,000 limit is na per payment basis, na per, I mean in per category of the payment basis. If professional fees is paid up to 50,000, no TDS. If technical fees separately is paid up to 50,000 rupees, then no TDS. Also, whenever any individual HUF pays royalty or non-competition fees, TDS is not required to be deducted. TDS is not required to be deducted. Individual HUF paying for business purpose, for personal purpose, TDS is not deducted. At last, if any of the payment is made, professional fees, technical fees, any of the payment is made for any purpose, I mean maybe personal purpose, anybody pays personal purpose. Professional fees paid for personal purpose, TDS is not deducted here as well. Whenever there are sports person, sports columnist, umpire, commentator, referee, physiotherapist, event manager, coach, team physician, they all shall fall under 194J only. They all shall fall under 194J only. Any services provided by the professional referred under 44AA shall also fall under this section only. TDS shall be falling under this section. Third party administrator payment making payment to the hospital on behalf of insurance company shall fall under 194J. What does this mean? Listen. For example, there is person who gets ill and admits at hospital. This person is admitted to hospital. Now what happens is if he is admitted to the hospital now, then actually what happens, if he makes the payment, it is his personal payment, personal purpose, then no TDS. But if he has a cashless insurance and insurance company in request a third party administrator to come and investigate the case and furnish the payment, if this third party administrator makes any payment to the hospital, now they shall deduct a TDS under 194J. Because this third party administrator are not doing any are not doing any personal services, these are business services, so 194J would be applicable here. if you take trading terminal from NSE, if you buy trading terminal for a year, for 6 months, if you pay trading terminal charges, these are not technical in nature, these are not professional in nature. Anybody can go and request for trading terminal. In that case, TDS under 194J is not applicable. If you receive any income from UTI or mutual fund up to 10,000 rupees, now no TDS. If you receive more than 20,000 rupees, then resident person's TDS is deducted at the rate of 10%. If you have any compulsory, if you have any immovable property and that is compulsorily acquired, any person making you the payment, you are a resident person, then 10% TDS is applicable. Lawmaker says that if a payment is up to 5 lakh rupees in a previous year, then TDS is not deducted. If it is more than 5 lakh, then only TDS is deducted. Remember, if there is urban agricultural land or if there is rural agricultural land which is compulsorily acquired, then no TDS. Urban or rural land compulsorily acquired, then no TDS is applicable. Done, sir. 194M. This is important. 194M, what it talks about, listen. If you are any SSC, if you are any SSC who has been, who has been removed from three sections, section 194C, CHJ. If you are any SSC who has been removed from 194C, H and J, C for contract, H for brokerage, J for professional services. If you have been removed from these three sections, if you have been removed from these three sections, sir, why will you be removed under 194C if your turnover is lesser than 1 crore? H also lesser than 1 crore, J also lesser than 1 crore. Under C, you might be removed because you have been paying for personal purpose. Under J also, you might be removed because you are paying for personal purpose. But H, even if you pay for personal purpose, na H, you cannot be removed. Okay? Commission paid for personal purpose would attract under 194H only. I will refer that point. If you have been removed from this section, you are an individual HUF and you are paying any contract payment, commission payment, brokerage payment, professional fees payment to a resident person, then you shall deduct a 2% TDS. 2% TDS will be deducted in this case. But sir, TDS will be only deducted if amount exceeds 50 lakh rupees in a year. If you are paying any sum to somebody more than 50 lakh rupees in a year, then only TDS would be deducted. Under C and J, personal purposes were exempted, they shall be covered here. TDS will be deducted under 194M in Form 26 QD within 30 days from the date end of the month of the TDS deduction. Brokerage paid for personal purpose shall be covered under 194H only. For example, what is the example? For example, this is Rahul. I bought a house. My turnover is greater than 1 crore rupees. I bought a house for my personal purpose. Do I have to, and I paid a brokerage of 60 lakh rupees. I bought my house for personal purpose and brokerage of 60 lakh rupees I have paid. How much TDS will it attract? So TDS will be attracted under 194H, not M, not M, not M, only H. Okay, even brokerage paid for personal purpose that will attract TDS under 194H. Just let me have a glass of water again. How is the Josh? I don't know which students are sitting. Maybe students who were sitting in morning maybe have taken break. Some other students have started joining. I don't know. But whoever is sitting live, how is the Josh? Kishore, 194A, TDS to be deducted on interest paid to NBFCs for loans. Is payment to be made on monthly or if paid annually, will interest come on TDS if paid as it's on a gross amount on EMI? See, 194A, first of all, TDS will be deducted only if your turnover exceeds 1 crore in preceding financial year, then only TDS is to be deducted. Normally, you won't deduct TDS. Okay. This is the first aspect. Second aspect, if your turnover exceeds 1 crore rupees now, then you might have to deduct TDS based on sort of interest component only, not on principal component. They will share you the interest certificate, and based on that, you have to deduct TDS on that. Cash withdrawal from bank, cooperative bank, and post office. See, interest certificate is given. See, we do not deduct TDS on principal component. Never ever we can do that. But yes, interest component, we do deduct TDS of NBFCs. But for that matter, we require interest certificate. If entire payment, see, if we are making payment on EMI basis now, we are already provided interest certificate. I mean, sir, taking additional breaks in between will cover and will covering up later with 1.5x to match like acha, seems fair. Got it. ठीक है. 194N. Now, whenever you withdraw money from bank, in this case 194N is applicable. Bank, cooperative bank, post office. How much TDS is applicable? Lawmaker says, see, ideally up to 1 crore you can withdraw without any limit, but if you withdraw more than 1 crore rupees, then 2% TDS is applicable. And this is the first section that I am referring, that only amount exceeding 1 crore will be deducted, will be subject to TDS. Only amount exceeding 1 crore will be subject to TDS, not more than that. Fair enough. Sir, what if assessee stands in 2025 and he has not filed return for three consecutive last years? Last three consecutive years, he has not filed return of income. There is an assessee who has not filed return of income for last 3 years. In that case, up to 20 lakh TDS will not be deducted. 20 lakh to 1 crore TDS will be deducted at 2%, and more than 1 crore, 5% TDS rate would apply. 5% TDS rate would apply. If you are a cooperative society, then wherever the 1% limit is there, enough 3 crore limit will apply. For example, for a cooperative, up to 3 crore no TDS, on more than 3 crore, 2% TDS would apply. And a cooperative who has not filed return of income in last 3 years, then up to 20 lakh no TDS, up to 3 crore 2%, and more than 3 crore 5%. This is how structure would go for cooperative society. If any of the money is withdrawn by bank, sorry, by cash, by government, okay? By government withdraws any money, now then no TDS is applicable. If bank withdraws, post office withdraws, and bank's correspondence withdrawn, then no TDS is applicable. Any cash replenishment agencies, white label ATM operators, then no TDS is applicable. Any registered commission agent, any commission trader operating in agriculture market produce committee, no TDS applicable. Authorized dealer, full-fledged money changer, or any of the person notified by RBI. For example, UN agencies, international consulates, these are not subject to TDS under 194. These are not subject to TDS under 194N. Come on to mighty 194O, maybe the biggest section of the chapter. 9 hours, 2 minutes of continuous live classes. Maybe 1 hour of break. Oof. Payment by e-commerce operator as e-commerce participant. What this happens? For example, this is Rahul. We have any Janvi. Okay. This is Rahul. This is Mintra. And this is Janvi. I am a fashion designer, you know. I had designed a dress, and this was a tank top. Tank top. I listed this tank top at Mintra. Janvi saw this. Janvi went crazy. Literally crazy. As soon as she saw the dress, oh my god, I want this dress. She immediately paid 10,000 rupees to Mintra, and Mintra remitted this 10,000 rupees to me. Lawmaker says that Mintra is required to deduct TDS at the rate of 0.1% on this remittance to the seller. This is the essence of 194O. Now, what the issues are? What the issues are? See, Janvi will also be charged the GST as well, 1800 as well. For example, assuming in on clothes GST is 5%, if I'm not mistaken. For example, 18% is charged. She is rich. Okay. 11,800. She pays 11,800. Now, whether Mintra would deduct a TDS on 11,800 or 10,000, right answer is Mintra would always deduct TDS on non-GST component. I mean, GST on GST, TDS on GST is not applicable. Third thing. For example, this time now, I made a tube top. A tube top. Again, Janvi watching it went crazy, crazy, crazy. She immediately took out her Google Pay and immediately paid 10,000 rupees to Mintra. Mintra, while making payment to me, now deducted 2,500 rupees as commission and paid 7,500 rupees to me. Oh, oh, oh. Sir, what is this? What is this happening? Out of this 10,000 rupees, 2,500 deducted. Sir, on what amount Mintra is going to deduct the TDS? Right answer is Mintra is going to deduct TDS on before commission amount. Before commission amount TDS is deducted. Because my sales are 45, sales are 10,000 only. Oh dear God. And my commission expense is 2,500. Sometimes what happens is, this times I made a ponchu. I don't know how you know that thing or not, but girls would know. There is a cloth called ponchu. Ponchu, pochu, whatever you call. There is a word. There is a cloth called pochu. I mean, I am sure boys don't know about this thing, but it is a very, I mean, unpopular cloth, but a very popular. It was once very popular. Ponchu, pochu. I mean, whatever you pronounce. So as soon as I released this poncho, Janvi went again crazy to pay to buy that poncho. Janvi placed the order via Mintra, paid directly 10,000 rupees to me, and I sold this goods to Janvi immediately. Lawmaker says it is the duty of Mintra here as well to deduct the TDS. It's the duty of Mintra only to deduct the TDS. Nobody else is going to come. Mintra only has to deduct TDS. Oh my God, sir. Oh my God. Now here comes. Now Janvi has become a habit. I mean, Janvi has a habit of. I mean, she is suffering from a disease. I mean, she is suffering from a disease called not interested. Everything that she sees. Books not interested. Classes not interested. Junk food somewhere not interested. Health. TV shows not interested. Everything not interested. Sleep interest. I mean, she is suffering from a disease of not interested. Okay? This is very common these days. Okay? Most people have this disease of not interested. Now, Janvi went to Practo, okay, to search for a doctor, and there was Dr. Rahul Baba. I mean, Baba come doctor. I gave her the consultancy via Practo, and Janvi paid 10,000 rupees to Practo for this consultancy, and I received a 10,000 rupees. Lawmaker says that in this, two sections are applicable. 194J is also applicable, and 194O is also applicable. Which section shall prevail? Lawmaker says if both the sections are applicable. Sir, you made me a depressed person. I don't made you a depressed person. This is a common issue. Everybody right now faces this issue. Not interested. Okay? Whatever you see now, you feel you are not interested. That is the issue with everybody now. So this is what the issue is. Okay? Now here she came to Rahul Baba. She paid 10,000 rupees. Now TDS is applicable in both the sections, 194J as well, O as well. Focus here. Under which section will prevail? Sir, here gives a very important judgment that whenever 194O is applicable, any other section is not applicable. If 194O is applicable, any other sections are not applicable except for three. There are three exceptions to this. There are three exceptions to this. What are those three exceptions? Let me tell you those three exceptions. Three exceptions that are not applicable. First of all, sir, for example, this is Rahul and this is Janvi. I mean, Janvi buys anything that I sell. Janvi will buy anything that I sell. So this time I am selling the Bitcoin. And this is coin DCX. I sold Bitcoin via coin CDCX. Coin DCX were, sorry, Bitcoin were given to Janvi. Janvi paid 2 lakh rupees and this 2 lakh were remitted to me. Lawmaker says in this case 194S is applicable, therefore 194O will not apply. So ideally O has an overriding effect but not above S. S has to be followed. Second thing, for example, this is Rahul and this is Janvi. Here we have at Zerodha and National Stock Exchange. I sold Reliance. Reliance were given to Janvi. Janvi paid 2 lakh rupees. I received 2 lakh rupees. Lawmaker says again TDS under 194O is not applicable when you transact via securities and exchange, stock exchange. Third thing. This is Rahul. I want promotion. So I went to Aryan Advertising. Aryan Advertising. Okay. Now I went to Aryan Advertising and Aryan Advertising went to multiple other websites like Google, like YouTube, like Facebook. These are also e-commerce platforms. RN Advertising is the mediator. I said I want every Instagram channel to show my ads in every 10 minutes. In every 10 minutes, Instagram channel should show my ad. So RN Advertisement paid 20 lakh rupees to Instagram India for ads, for showing ads for me. Now this I pay 20 lakh rupees. Out of this, whatever is paid, for example, 15 lakh is being paid. In this case, now even though it is an e-commerce operator, in this case 194 O shall not apply, 194 C shall apply because it is advertisement related e-commerce services. 194 C shall apply. So ideal case scenario, 194 O is applicable everywhere, but there are three exceptions: 194 S, 190 sale of securities via stock exchange, and advertisement related e-commerce services. Next point. Now what happens? Listen very carefully. Listen. See, sometimes, for example, this is Janvi. Janvi wants to buy health insurance. So for that matter, she went to Policy Bazaar. She went to Policy Bazaar. Now in this case, now she has an option to go for Aditya Birla Sun Life. She has an option to go for HDFC Ergo. She has an option to Niva Bupa. She has an option for IFCO Tokyo. She has multiple options. She selected HDFC Ergo. Whenever she paid, for example, 40,000 rupees, she paid for health insurance, and the HDFC Ergo was paid almost 40,000 rupees after deducting 0.1% EDS. Right answer is yes, 194O will be applicable. Whenever Policy Bazaar would be paying this 40,000 rupees to HDFC Ergo, 194O would be applicable. For sure, it will be applicable. It is e-commerce transaction only. Perfect, sir. Perfect. But don't you think in first year, Janvi would go to Policy Bazaar? That's clear. But in subsequent years, why would Janvi go to Policy Bazaar? If she already knows that she can directly buy goods, she can directly buy the policy from this HDFC Ergo. Next year, she would directly go to HDFC. Next year, she would directly go to HDFC. So why there is a concept say next year now what will happen? She would directly go to HDFC. In next year now there is no concept of TDS under 194O. So in first year when there is a facilitator who is facilitating the transaction, he might deduct TDS under the first year. But in subsequent years there is no obligation to deduct a TDS for the subsequent sales. Yes, if if a HDFC pays commission to him, then 194D shall apply. But otherwise 194O will not apply from subsequent years. Listen, if there is an individual or HUF who sold goods up to 5 lakh rupees via e-commerce portal, then 194O is not applicable. If they furnish Aadhaar and PAN, if they furnish Aadhaar and PAN, important. Next, what happens? For example, this is Rahul and this is Janvi. This time I have updated a lehenga. Lehenga. And here it is Myntra. This lehenga is priced at 15,000 rupees and I placed it. Now Myntra wanted to increase the sales. So Myntra itself gave 10% discount. So Janvi paid 13,500 rupees of her own and 15,000 were remitted to me because this discount was given by her own. This discount was given by Myntra of its own pocket. In this case, TDS would be deducted on entire 15,000 rupees. See, if e-commerce operator is giving discount of its own, that is none of our business. It is his duty. But what if I am giving 30% discount, 10,500. Then remittance would be made to me of 10,500 only, and TDS would be deducted on 10,500 only. Fair enough. Very, very, very fair enough. Now, sometimes what happens is this is Rahul and this is Janvi. This is Mintra. This time I have designed a plazo, not plazo, jumpsuit. Oh, jumpsuit. Sir, you are very much aware about these clothes. Of course. Why wouldn't I be? I have sisters, I have mother. They take me to shopping and force me to carry bags. I mean, jumpsuit. I displayed jumpsuit and Janvi became fan of it and immediately paid via Google Pay. Now, Google Pay uses the payment gateway as PayU. PayPal. Chalo, let's assume PayPal. Google Pay uses the payment gateway of PayPal. So payment was given to PayPal. PayPal paid to Mitra. Mitra paid to Rahul. In this case, here since payment gateway is involved, whether payment gateway would deduct TDS, right answer is absolutely no. Payment gateway would not deduct TDS at all. Would not deduct TDS at all. Not at all. Simply not at all. Okay? This gives us to a conclusion that if there are multiple e-commerce operator, then in that case, now ideally seller side e-commerce operator would deduct TDS in 99.99% cases. Seller side TDS, seller side e-commerce operator is going to deduct the TDS. But sometimes what happens is seller himself is an e-commerce operator. It is possible that seller might himself be an e-commerce operator. In that case, the buyer side e-commerce operator might deduct. But otherwise, by default, seller side e-commerce operator is going to deduct the TDS. At last, we have an e-auctioneer portal. For example, if I want to sell my bike, I just want to know the price of that bike. I don't want to sell it, but I just want to know the actual price of it. So I list my bike at the e-auctioneer portal. This is meant for price discovery only. It is not necessary that whatever the discovered price is, it is the final price. Transaction is taking place outside portal, payment is taking place outside portal, and TDS of e-auctioneer portal has been deducted in whatever sense it is. In that case, now this transaction is not e-commerce transaction. This is not e-commerce transaction. E-auctioneer portal doesn't have to do anything in this regard. This is all about mighty 194. Oh, dear God. 194p. If you are a senior citizen who is of 65 years of age, so 65 is 75 years of age, who has interest income, pension income in the same bank account, then your TDS would be deducted. How much TDS would be deducted, sir? Your TDS at the rate of slab rate. Whatever your taxable income is, it will be calculated. It will be calculated based on whatever regime you select. It will be calculated, and whatever the tax arrived is will be deducted. TDS deducted will be considered, tax arrived will be considered, and after that, whatever your final tax payable is will be deposited to government. This is 194p. Therefore, you are not required to file return in this case. 194p TDS. If TDS is deducted, then return is not required to be filed by the other person. Fair enough. Very, very, very fair enough. Sir, whenever senior citizen wants to be governed under this section, he has to ensure that Form 12 BBA is furnished to the bank to get this done. Okay? To get this done, Form 12 BBA is to be submitted. Then only bank would do. Otherwise, bank won't do it of their own. 194Q, what it says, if you are a buyer, okay, if you are a buyer whose turnover in preceding financial year has been more than 10 crore rupees, whose turnover in preceding financial year has been more than 10 crore rupees, and you buy goods more than 50 lakh rupees. That means 60 lakh, 70 lakh, 80 lakh, 90 lakh, whatever you buy. So whatever the buying you are making over 50 lakh rupees, you have to deduct TDS at the rate of 0.1%. Whatever buying you are doing, the 0.1% you have to deduct TDS. Sir, from every different seller you have to consider. Every seller wise you have to check the limit of 50 lakh, or every year you have to check this limit of 50 lakh rupees. Unless limit is breached, you don't have to deduct TDS. And once this limit is breached, you have to deduct TDS only on this component only. Important point here, important point, very, very important point. 194O has always underriding effect. Any section, if applicable, now you will apply. If it is not applicable, if nothing is applicable, then only 194O is applicable. Any other section applicable, 194O not applicable. Sometimes what happens is we purchased goods, we deducted TDS. Sometimes we return the goods. Then what happens? So extra TDS deducted, then this shall be adjusted from further purchases. Done, sir. 194. Oh, very important point. See, Sometimes what happens, we buy goods which is exempt for the seller. For example, we buy potatoes from an agriculturist. So agriculturist potatoes we are buying, it is exempt for the seller now. In that case, what will happen? We will not deduct TDS under 1940. This has never been case in any other section. In any other section, it is not there. But if we are buying goods which is exempt for the other person, now we shall not deduct TDS on this section. We shall not deduct TDS on this portion. Okay, sir. Okay, sir. Got it. 194 R perquisites. What happens if you are a hijacker? What is an hijacker? Every assessee would deduct TDS under the section, but individual and HUF will only deduct if their turnover in preceding financial year exceeds 10 crore rupees. If I am speaking too fast, mention this thing, so I will slow down my pace. If any of the hijacker pays any perquisite to a resident person in the business nature, in the business correspondence, in that case, TDS would be deducted at the rate of 10%. Listen, if perquisite is paid up to 20,000 rupees per annum, no TDS. But if it is paid more than 20,000 rupees, TDS would be deducted entire amount. Sir, what is meant by perquisite? Free samples, free tickets, sponsoring a tickets, sponsoring a trip, incentives to distribute a retailer. These are the perquisites. Okay? Sometimes what happens is perquisite is given in wholly kind basis. For example, Hindustan Unilever gave me perquisite. Hindustan Unilever gave me perquisite. Why? They have given me a trip to Switzerland, 5 lakh rupees trip, 7 lakh rupees trip. Switzerland trip they have given to me. Now, in that case, how they are going to deduct TDS? They have not given me any money. In that case, they will take money from me in the form of TDS, or either I have to deposit advance tax, or they have to bear this off their own pocket. This they have to do. Done, sir. Some things are not considered as perquisite. First of all, any sales discount like 40% off, it is not perquisite. Any cash discount is not perquisite. Any rebate to customer, like for example, billing is of 10,400. You have just paid 10,400 is the rebate. It is not perquisite. Buy 5, get 4 free. It is not perquisite because price is inflated. Any issue of bonus shares or right shares, it is not perquisite. Any waiver of loan by the bank, a cooperative bank, it is not a perquisite. Any product given to social media influencer, for example, I created a mobile phone. I made a mobile phone. 1000 MP camera, 2000 storage GB, 300 GB RAM, weight just uh, weight just 200 grams, 4 times foldable. I mean, if you open up, it would become a laptop screen. If you fold, it would be just a small, sleek mobile phone. And price just at 25,000 rupees. I created a mobile phone. Okay? I want this mobile phone to popularize. Just like my classes, I want this mobile to popularize. So I went to Dhruv Rathi and asked him to popularize this mobile phone. I went to Dhruv Rathi. He liked the phone so much that he kept this phone with himself. Lawmaker says that if you give any asset to an influencer now and he keeps with himself, it is called perquisite. But what if Dhruv Rathi returns that mobile phone to me? Then it is not a perquisite. That is what here mentioned. If you give a product to social media influencer and then he returns, then it is not a perquisite. For example, if you give any perquisite to a government school, then it is not perquisite. This local agent you can cut down. Now, perquisite can be in the form of asset as well. For example, Hindustan Unilever gives me a piece of land. It will be also perquisite. They give me a car. It is also perquisite. They give me a gold chain. It is also perquisite. They give me any strip. That is also a perquisite. Free samples to the doctor, for example. In Indore, there is a doctor. There is a doctor named Dr. Kashish Ahuja. Oops, I could not. How could I say her name? Oops, sorry. Dr. Kashish Ahuja. She is very popular. I mean, she treats people with her smile. If you go and just look at her face, and most of her problems would be healed. Most of your problems would be healed. So beautiful, so elegant, just looking like a wow. Very, very qualified doctor. One day, a man in pant shirt, blazer, went to Dr. Kashish, asked him, please, madam, can I meet you? Says, what happened? Dr. Kashish says, what happened? He says, ma'am, we want a favor. You write so good medicines. Your smile is so good. Why don't you help us out? We have created a medicine. Please prescribe this medicine to your patients. Dr. Kashish says, why? Why? What benefit I will get? This The man in blazer says, "Arey madam, if you prescribe this medicine now, 70% of the sale proceeds would go to you. We will take care of with 30% only. 70% of the sale proceed would go to you." Oh my God, Kashish madam said, "Oh my God, I will write this prescription. I will write this prescription." She wrote nearly 2 crore worth of medicines in a year. She wrote 2 crore worth of medicines in a year, and 1,40,000 rupees were paid to her. Does this amount to commission? Does that amount to perquisite? Right answer is it is not considered as perquisites. It is not considered as perquisites. It is commission. Any money paid to anybody, na, it is commission. Perquisites are non-monetary benefits. Always understand, if money is paid to anybody, it is commission. If any non-monetary perquisite is given, then only it is commission. No, it is perquisite. Okay? Sir, what if somebody, a medical practitioner, pays any salary, pays any commission to Dr. Kashish? Now, what happens in that case? You have to check whether she is the employee at the hospital. If she is an employee at the hospital, now in that case, TDS of her would not be deducted. So hospital's TDS would be deducted under 194R, and it's the duty of the hospital to treat it as perquisite in her hands, and hospital will later on deduct the TDS in 194R, 194, 192, because she is the employee. So she will, her TDS would be deducted under 194, sorry, 192. But if she is a sitting professional, then directly 194 RTDs can be attracted. Reimbursement of the out of the pocket expenses you can cut down. See, if there is a business conference happening, for example, Hindustan Unilever gave me a trip to business conference. I mean, they gave me a business conference trip to, say, Dubai. I was very excited to go to Dubai. Hindustan Unilever gave me a trip. In that case, what happens? Sir, whenever a business conference trip is given to me, it is never a perquisite. Sir, why? Because it is for new product discussion, obtaining orders, teaching sales techniques, addressing queries. These are not perquisites. These are not considered as perquisites. But sir, what if I demand more? I says that family members should accompany me. Along with me, family members should also come with me. If I demand that thing as well, will that be counted as perquisite? Right answer is yes. Apart from me, if anybody goes from my family to that trip, it will be considered as perquisite. Sir, what if I myself go but for more than required period? In that case, again, it will be considered as perquisite. For whatever days business conference goes now, 1 day plus, 1 day plus. That means 2 days extra you are allowed. For example, from 15th Jan to 20th Jan, business conference is there. I might go there on 14th. I might leave that on 21st. Beyond that, whatever I stay now, that is considered as perquisite only. At last, sir, whatever the leisure spending that is being done by the company now, that shall also be considered as business conference only. So that shall be considered as perquisite only. TDS will be applicable in my hands. TDS will be applicable in my hands. Sir, how do we value? How do we determine the value of the perquisite? See, value of the perquisite is determined whether they have bought the perquisite. If they have bought the perquisite, then purchase price shall be taken. If they have manufactured the perquisite, in that case, price charged from others shall be taken, or in any other case, FMV of the benefit shall be taken as perquisite. Transfer of virtual digital asset. Virtual digital asset. What does this mean? See, first of all, whenever you transfer any virtual digital asset, buyer has to deduct the TDS. Now, who deducts TDS under this section? This is yet to be tested fairly. This is not yet tested, but this is to be tested fairly. Remember. See, any hijacker person would deduct TDS here. Any person other than individual HUF, every person will deduct TDS under 194S. Individual HUF whose turnover is more than 1 crore shall also deduct TDS, but all the people, all the hijacker people would deduct TDS only if purchase consideration is more than 10,000. If you purchase cryptocurrencies more than 10,000, then only you have to deduct the TDS. Fair enough. But these small individual HUF also have to deduct the TDS if their consideration exceeds 50,000 rupees. So hijacker would deduct if consideration is more than 10,000 buying consideration. These small individual HF who turnover is less than 50,000, and they shall also deduct TDS if their consideration is more than 50,000 rupees per annum, per person, of course. Okay, sir. Okay, sir. Okay. How they will deduct TDS? Form 26 QE. 30 days within the end of the month. This is the case. Any other section applicable, 194S shall override. Now, what happens, sir? For example, this is Rahul and this is Janvi. If we both have a transaction, who will deduct the TDS? Sir, buyer will deduct the TDS, Janvi will deduct the TDS. But sir, if there is an exchange between us, for example, Wazir X, then money would be given by Janvi to Wazir X and Wazir X would deduct the TDS. Perfect case, no issues. What if Wazir X is there and we are exchanging the asset? For example, I am Rahul and this is Janvi. I have Bitcoin and Janvi has Kishore coins. Let's change that. Janvi has Bitcoin and I have Ethereum. I gave this Ethereum to Wazirex. Wazirex sold 1% and 99% has been remitted to Janvi. Bitcoin was given to Wazirex. 1% was sold and 99% was remitted to me. Out of this 1% was sold, 1% TDS has been deposited by Seedhe Wazirex. It's clear. Very simple it is. But sir, what if Wazirex is not able to sell that? So at night, midnight, 12 p.m. Now whatever price Wazirex gets, it will execute the order at whatever price it is able to sell. It will sell it. Sir, whether you get 87A under VDA income, on old regime we get, under new tax regime we don't get. Last section for TDS, 194T. This says that if any partnership firm pays any remuneration to partners, this is for the first time. Who had asked? So, who had asked this point? I guess Kumar had asked. Ideally, whenever you pay any remuneration interest to partner, TDS is applicable under 194T. If remuneration interest is paid to partner more than 20,000 rupees, then TDS is applicable. Sir, it is nowhere mentioned that this section is applicable to resident only. So I assume, this is my presumption. Okay, nobody in industry has said that, but this is my presumption based on bare reading, that in this section is applicable to non-resident partners as well. Non-resident partners, non-resident interest remuneration payment as well. Okay, payment shall be deducted, TDS shall be deducted on the time of payment or book entry. Section 194 series, these are not relevant. 195 is important. Okay, 195 is important now. Whenever any person makes payment to a non-resident, TDS is deducted at rate in force or DD double rate, whichever is lower. Rate in force is nothing but the rate at which income is taxable. Rate at which income is taxable. It is possible that income is taxable at 5% plus surcharge plus education cess. We will deduct TDS at plus surcharge plus education cess 5%. If income is taxed at 20% plus surcharge plus education cess, we will deduct TDS at that rate. Sir, if income is taxed at slab rate, sir, for a company 35% would apply. For AOP BY or for any individual outside India, normally slab rate is not the slab rate that we calculate, it is 30%. It is 30% because we don't know that he has exhausted his slab or not. So we assume that entire income is taxed at 30%. Therefore, we deduct TDS 30% plus applicable surcharge education cess. So non-resident, we deduct a TDS based on the rate at which he is taxed. Fair enough, sir, fair enough. These four sections not relevant. Sometimes what happens is, if there is a non-resident whose TDS rate as per Income Tax Act is, say, 20%, plus 37% surcharge plus 4% education cess, assume this is the case. Assume this is the case. If you add it up, it will turn out to be 20% plus 37% plus 4%. So 31.4% is applicable tax rate. 20% plus 37% plus 4. No, 28.496% is applicable. As per Income Tax Act, rate is just 20%. But as per DTAA, if you say now, it's just 25%. Which shall prevail? Lawmaker says that income tax, whenever you charge, now it is inclusive of surcharge. Education says DTAA is just gross, nothing else. Here 25% is beneficial. You shall deduct TDS at 25% only. Now, under 195, TDS will only be deducted if it is taxable in India. And at last, sometimes you pay an overseas commission. For example, there is a non-resident person who helps you in buying goods, outside, or who helps in soliciting the clients. In that case, you pay him overseas commission. Lawmaker says overseas commission is not taxed in India because it is not received in India, not earned in India. Okay, fine. Whenever you make payment to government, RBI, statutory corporation, mutual fund, or any credit guarantee trust fund, no TDS under any section is applicable. If you want to deduct a TDS, sorry, if you want your TDS to be deducted at a lower rate, then you can go to assessing officer and get a lower deduction certificate. Assessing officer might issue lower deduction certificate to you. Sometimes what happens is if your income is below basic exemption limit, then for some sections your TDS should not be deducted now. So you might furnish 15G to the deductor. He will not deduct your TDS. But if you are a senior citizen, your income is above basic exemption limit. Your income is above basic exemption limit, but it is non-taxable now. So in that case, you can furnish 15H and your TDS will not be deducted. See, whenever you want to import certain goods, so you have to furnish bank guarantee to the other person. Whenever you import certain goods, you have to submit bank guarantee, because otherwise the other party would not send the goods. He would be worried. He would be worried that if you don't make the payment, so he will be at loss. So he requires bank guarantee. You have to submit bank guarantee. Whenever you submit bank guarantee, bank charges bank guarantee commission. It is not doing seva. It is not doing volunteering. So whenever you pay bank guarantee commission to bank, no TDS is applicable on that. Okay. Perfect. If you make any payment to IFSC located unit for interest, commission, anything which is their business income, in that case TDS is not applicable. Fair enough. Whatever TDS deducted, it is your income only. TDS credit shall be given to you. You have to deposit TDS up to 7th of next month, and for March month you have to deposit up to 30th April. If you delay in deduction, then 1% interest would be charged from due date of deduction till actual date of deduction. And if you delay in payment, now your interest will be charged at the rate of 1.5% from actual date of deduction to the actual date of deduction to actual date of payment. For quarter ending, June ending quarter, 31st July is the due date of return filing. 30th September ending quarter, 31st October, December ending quarter, 31st Jan, and March ending quarter, 2 months. So 1 month, 1 month, 1 month, and 2 months. This is the period. If you delay in TDS return, 200 rupees late fees is charged, but TDS late fees cannot exceed the TDS amount. TDS late fees cannot exceed TDS amount. Remember, once you file the TDS statement, this statement cannot be corrected after 6 years from the end of the year you furnished that. If you have filed the return, if it contains some errors, you will get a rectification within 1 year from the end of the year in which you filed that. At last, sir, if you are required to deduct TDS and you did not deduct, or you deducted but not paid, in case of resident, you might be declared assessee in default within how much? Within 6 years from the end of the year of deduction. But if you are required to deduct TDS of a non-resident, you did not deduct, or you deducted but not paid, in your entire lifetime, government can declare any time, at any point of time, they might declare you assessee in default, any point of time. Sometimes, like, you make the payment, your phone pay just turns around, it just a circle is just rotating, payment is not successful. You think that payment is successful, but it is not received to the recipient. It happens sometimes. This is also prevalent for TDS as well. Sometimes you paid the TDS amount, but it never reached to the department, and later on you got a refund. Now, because of which interest would pile up a lot. See, if you could not deposit because of technical glitches, TDS could not be deposited because of technical glitches, then whatever the interest that has been charged, that will be remitted. But we have to request for the waiver by CCIT, DGIT. We have to make a waiver application within 1 year from the end of the year in which order for interest has been charged. And if we have paid the interest as well, then refund of interest shall be also given to us. If we want to deduct a TDS, if we want to deduct TDS of a person and he has not furnished the PAN, then we shall deduct the TDS at a higher rate. What is the higher rate? Rate of respective section, or 20%, whichever is higher. Sir, if he has furnished us an inoperative PAN, then to TDS at higher rate would apply. But under 194O and 194Q, maximum rate applicable is 5%, whichever is higher. This is the higher TDS rate, and that completes your TDS topic. Now I am seeing the question points. Janvi, option to deduct TDS on DTAA is only under 195 or any other section, every other section. If See, income tax versus deductible. It's not about 195 versus deductible. It is income tax versus deductible. Any income might be taxed at a lower rate in deductible. We have to honor that. Okay, sure. TDS on improper PAN, higher rate of TDS is applicable to few sections. Inoperative PAN at that time, no. Kishore, whenever you make the payment now, you have to check whether TDS is active or not. See, whenever you file return, TDS return, na, TDS portal itself checks that whether PAN is operative or not. If PAN is not operative now, you will have to deduct TDS at a higher rate. Whenever you file the TDS return, na, TDS portal itself shows that PAN is inoperative, so you have to deduct TDS at a higher rate. It will create a demand in itself. Okay. So it's not just about non-furnishing of PAN, but if PAN is inoperative, now we have to deduct TDS at a higher rate only. Tax collected at source, concept number 72. Still 28 concepts are pending. Wow. Whenever, acha, speed was fine. I know you are fed up now. You don't want to hear me. That's enough. I know. But still, we are left with one entire chapter after this TCS. Okay, entire chapter. We will not cover advanced tax, don't worry. But still, we are left with entire chapter. Okay. Hello. Whenever you sell goods. Whenever you sell goods, remember. See, we need to consider. Legally, we need to consider. Lawmakers cannot say that after return filing you get to know that PAN is inoperative. No, you cannot know. Okay. You should time to time check whether PAN is operative or not. By e-filing portal, it's available that whether PAN is operative or not. So you should. It's your duty. As per as per legal text, you don't have to wait for department to tell you that it is an inoperative PAN. You should take it. You should check it off your own. See, these are practical issues. Right now in marathon, I cannot answer practical issues. I have told you theoretically what is to be written in exam. Now, whenever you sell goods, okay, you have to collect a TCS. You have to collect a TCS. What is the when you have to collect the TCS? Whenever you receive the payment or you debit the wire. Whenever you receive the payment or you debit the buyer, that means you enter the sales, whichever is earlier. 1F is only applicable at the time of payment only. Now, section number 206 is C1. What this C1 C speaks out? Whenever you sell 5 things, this section is really important, has undergone amendment as well, and TCS has already been not asked from multiple attempts, so TCS is possible. Now, whenever you sell alcohol, 1%, scrap, 1%, coal, 1%, timber, 2%, tendu leaves, 5%. Again, alcohol 1%, scrap 1%, coal 1%, tendu leaves 2%, sorry, timber 2%, tendu leaves 5%. 5 things, okay? Alcohol 1%, scrap 1%, coal 1%, tendu leaves 5%, timber 2%. This is how you have to learn it. You have to learn these 5 rates. Alcohol 1%, scrap 1%, tendu leaves 5%, timber 2%, and coal 1%. If you sell these 5 items and you are a hijacker means every SSC will collect a TCS, but individual HUF will only collect if their turnover is more than 1 crore. This is the rate from whom you are not going to collect the TCS, sir. You are not going to collect the TCS from the person who is buying these things for personal consumption. If somebody is buying alcohol for personal consumption, you are not going to collect TCS. If somebody who is a PSU is buying these assets, you are not going to collect TCS. If central government, state government is buying, then to TCS is not applicable. Remember, in addition to that, if you are selling these things to somebody, you are selling the scrap, timber, coal to somebody who uses these things for manufacturing or power generation, and he gives a declaration to that regard now, in that case, TCS again will not apply. So what did I say? TCS is not collected in cases where it is used for personal consumption, where it is bought by PSU, it is bought by central government, it is bought by state government, or it is bought by somebody who would use this for manufacturing purpose. We shall not collect a TCS. Sir, if we will not collect a TCS, then 194Q TDS might apply. Always check that thing as well. 1C. What this says, whenever you have a big toll plaza quarry mines which is given on lease, Whenever you give these things on lease, okay, you have to check your last year's turnover. If your last year turnover is more than 1 crore rupees, then you have to collect TCS at the rate of 2% to anybody you lease it out, and TCS will be collected at the rate of 2%, except for PSU. 1F, what this says, if you are a hijacker seller, again, anybody will collect TCS under the section, but individual HF will not collect if the turnover is more than, if the turnover is less than 1 crore. Okay. Here, transaction is you are selling motor vehicle for more than 10 lakh rupees. Motor vehicle for more than 10 lakh rupees, and motor vehicle be ex showroom price. Not the taxes included. Ex showroom price is more than 10 lakh rupees first thing. Second thing, you are selling this motor vehicle for personal users, not for any car dealer or car manufacturer. Car is being sold for not to a car dealer, not to a car manufacturer, but for a personal user who might use this for their business, who might use there for personal consumption. Then only you would collect a TCS. How much TCS? 1% TCS collected, but not from PSU, not from central government, state government. Remember, it is possible that 206C 1F is applicable, but sometimes 1F is not applicable. Now, in that case, you might have to check 194Q as well. 194Q might apply if 1F is not applicable. Okay? 10 lakh or more, more than 10 lakh rupees of electric motor vehicle sold, TCS collect 1%. 10 lakh is more than 10 lakh is the ex showroom price, not the on road price, ex showroom price. Now, important here is, apart from the motor vehicle, now you have to check if you are selling any luxury items like wristwatch, like sunglasses, like coin, stamp, collectible items, like horse racing, horse racings, shoes, art piece, antiques, paintings, purses, handbags, sportswear, sports equipments, yachts, rowing boat, and helicopter. If you are selling these items, now, then also we have to collect TCS. Remember, these are per product sales. Not that we have to sell 100 handbags and then after that we have to collect. No, per handbag sales, if it is 10 lakh, if it is LV bag, Louis Vuitton, if it is Gucci bag, if it is Gucci sells bags, if it is Chanel maybe, if it is Christian Dior, if bags value more than 10 lakh rupees, then you have to collect a TCS. Individual bag, if sold more than 10 lakh rupees, then you have to collect a TCS. 1G. If you remit money outside India under liberalized remittance scheme, if you are remitting money outside India, remember, up to 10 lakh rupees you can remit for any purpose without any issue. To 10 lakh you can remit without any issue, without any purpose. Sir, no TCS would be applicable. But after 10 lakh, when you will start remitting now, you have to check for what purpose you are remitting. If you are remitting for educational purpose, then 5% TCS would apply. If you are remitting for other purpose, then 20% TCS would apply. If you are remitting money from the loan taken for educational purpose, educational loan referred under 80, if you are remitting now, then no TCS is applicable. So educational loan has to be taken from bank or financial institution, not from anybody. Sir, what is meant by educational purpose? See, for tuition fees you are paying, for hostel fees you are paying. For example, educational loan repayment you are paying, for coaching fees you are paying, for staying purpose you are paying, for educational purpose, hostel fees you are paying, whatever thing you are paying which is related to education is educational purpose only. Who will collect the TCS? The TCS will be collected by authorized dealer. Perfect, sir. Sir, for example, first time I went to ICICI for remittance purpose. Second time I went to HDFC for remittances purpose. So 10 lakh limit will be given twice to me. Okay? Twice limit will be taken. Sometimes if I go and buy overseas tours and package program, for example, Kishore got married and his wife wanted to go to Pakistan. Okay, she wants to have a trip to Pakistan. So Kishore went to Sat Fere Travels to buy a trip to Pakistan. And trip cost rupees 18 lakh rupees. In that case, lawmaker says first 10 lakh rupees, the 5% TCS would be applicable, and after 10 lakh rupees, whatever the trip cost is 20 lakh rupees applicable. 20 lakh rupees applicable. This is per trip basis. Okay? TCS will be collected by overseas tours and package program seller. Now, if TCS is collected any other section, then TCS under the section will not be applicable. For example, if you buy trips via Go IBBO, then it is possible that this TCS would not apply. If non-resident does these remittances, for example, my NRI aunt came to India and she bought this overseas tours and package program for 30 lakh rupees. The provision says their TDS will not be deducted. Then TCS is always calculated on invoice value. Make sure whenever the person to whom we have to collect the TCS has not furnished the PAN, in that case TCS will be collected at a higher rate. What is the higher rate? Twice the rate of respective section or 5%, whichever is higher, subject to maximum of 20%. This is the rate applicable. For TDS, we had rate of respective section or 20%, whichever is higher. This was the rate for TDS, but for TCS, we have twice the rate of respective section or 5%, whichever is higher, subject to maximum of 20%. Okay. TCS has to be deposited on 7th of next month. If you late collect TCS, then from due date of collection till actual date of collection, 1% per month is the interest rate applicable. If you late pay that from due date of collection till actual date of payment, from actual date of collection till actual date of payment, you will be charged 1.5% interest per month and part of the month. For June ending quarter, you have to file return up to 15 July. September ending quarter, 15th October. December ending quarter, 15 Jan. Or for March ending quarter, 45 days you are given with. If you delay, again 200 rupees late fees will be charged per, and this can never exceed the TCS amount. If you furnish the return, that return can be revised within 6 months or 6 years after the end of the financial year of filing. After that, it cannot be revised. Advance tax, I personally think advance tax is not much relevant. Make sure, sir, what happens? You have to pay first installment of advance tax on 15th June, 15% of the advance tax liability. Second installment of 15 September, that is 45% of the advance tax liability. Third installment 15 December, and fourth installment 15th March. These are the 4 installments. What happens? 234C interest is charged when you shortfall in quarter 1. Whatever 15% is required, if you shortfall, then 3% will be charged. Quarter 2, 45%, whatever shortfall you do, 3%. Quarter 3, 75%, whatever you shortfall, 3%. Quarter 4, whatever shortfall you do, 1% will be charged. So quarterly shortfall will be covered by 234C. In quarter 1, instead of 15%, if you pay 12%, then no interest would be charged. In quarter 2, instead of 36%, instead of 45%, you pay 36%. Again, no interest would be charged. 234B, this talks about annual payment of advance tax. On 31st March, what was the advance tax required to be paid versus whatever you have paid? This difference is the shortfall. On this 1% per month will be charged up to the date you file the ROI or you pay the taxes. If you have not filed the return, then it will be continued till the assessment. 234A is nothing but the delay in return filing. So whatever the unpaid self-assessment tax is there, 1% per month from the next day of the due date. That means if 31st July is the due date, from 1st August till the date of actual filing the return, we shall be charged. Not more than that is relevant. 234, concept number 76, refund. What this refund says, see, whenever we pay excess taxes in the form of TDS, advance tax or self-assessment tax, then we get refund. On that refund, we get interest as well. How much interest is given to us, sir? We are being given interest 0.5% per month and part of the month. That's it. Refund interest will be calculated for a period, and what that period is, that is important. Carefully listen. If we get refund out of TDS, TCS, advance tax, and we have filed return on time, that is well before due date, in that case, now we will be given refund from 1st April of the assessment year till the date of grant of refund. But if our return is not on time now, then interest will be given to us from due date of ROI, from actual date of ROI till the date of granting of refund. So our interest period will shortfall. Interest period will reduce if we delay the return. Self-assessment tax, you will get refund. You will get interest from the self-assessment tax from the date of payment of taxes or ROI, whichever is later, to the date of granting of refund, 0.5% per month and part of the month. Now, department will withhold your refund if department thinks that there is outstanding tax liability, so it will be setting off the tax liability and then giving you the refund. If AO thinks that grant of refund would affect the interest of the revenue, so they would stop your refund. At last, sir, if your refund amount, for example, your declared taxes are 1 crore and your TDS deducted was 1.08 crore. So your refund amount is nothing but 8 lakh. Lawmaker says whenever your refund amount is there, you have to check out the assessed taxes, whatever assessed taxes are there. See, right now I'm considering declared, but in exam you have to consider assessed taxes. If you have assessed taxes, of that 10% you have to take assessed taxes. For example, assessed taxes 10% is 10 lakh rupees. If your refund amount is lesser than 10% of the assessed taxes, again, refund amount is lesser than 10% of the assessed taxes, in that case, sir, no interest on refund would be given to you. I don't know when this can be asked in MCQs, but I am waiting for the day when this point will be asked in MCQs. That completes our That completes our income, sorry, TDS thesis advanced tax. Oof, honestly, I am hell tired, but I cannot let this go. If I want to make it comprehensive, I have to sit for at least 1 hour to complete this chapter as well. Will you cooperate with me to complete this chapter as well? Will you cooperate with me? Sir, income tax authorities return filing and assessment procedure. Why did I keep this chapter at last? Because I know you also keep this chapter at last only. 20 minutes break, sir. It will take an hour for me to complete this chapter. Chalo, theek hai, let's take break. Not for 20 minutes, but it is 7:57. I am taking break till 7. 8:15. Yeah, what it is. 8:15 only. Take break. After that, we shall start with assessment. Maybe we will be in a position to complete this entire chapter. But this video should not go more than 12 hours because otherwise the stream will stop automatically. So we have to take sure that we end up before 12 hours of being completion. वेलकम बैक फ्रॉम ब्रेक। क्या सभी वापस आ गए क्या ब्रेक से? आर यू ऑल बैक फ्रॉम ब्रेक? आई टेंड टू फॉरगेट दैट इट्स एन इंग्लिश क्लास। चलो, आर यू ऑल बैक फ्रॉम ब्रेक? यस सर, वी आर बैक from break. Before going to break, we completed our tedious chapter. Now we have income tax authorities, return filing and assessment procedure. Let's do it. First concept, that is income tax authorities. Who are IT authorities? See, under CBDT now we have two wings. First of all is assessment wing, the other one is investigation wing. Under assessment wing, PCCIT, CCIT, PCIT and CIT. PCC, CC, PC and C. Joint Commissioner, ACDC, ITO and tax recovery officers. Investigation wing we have PDGIT, DGIT, PDIT, DIT, JD, AD and last. And these are simple IT authorities. These six are called assessing officer, joint commissioner, assistant commissioner, ITO, joint director, assistant director. These five or six authorities are simply called ITO. What are the powers of joint? What are the powers of IT authority? Listen up. Very carefully listen. This is an important area. Whenever IT authorities are given, okay, I want to refer Bula series for this. I really want to refer Bula series for this. I have shared this Bula series note with you all. Kindly refer this sheet as well. Okay. I have shared this Bula series in my Telegram channel. I want to refer these IT authorities via this page. Please kindly support me. Okay, please kindly support me. I have shared this in my Telegram channel. You can refer this. This IT authority chart now, I mean, I don't know how, but it is very helpful, even for understanding purpose and from teaching purpose as well. What powers do IT authority have? First of all, general powers. IT authority have four powers: discovery and inspection. Whatever asset is there, they might find out who is the owner of that. Enforcing attendance of a person and examining such person or not. This means if IT authority wants you to be present at this premise at this point of time, they can ask you and they can record your statement as well. They might impound your books of accounts for maximum 15 working days and they might issue a questionnaire for which you have to respond. So these are the four powers, four general powers of IT authority. Very important, section 131. Same powers you would see for advanced ruling as well. Yesterday we studied, day before yesterday we studied, advanced ruling also has the same powers. Then some special powers. What IT authority special powers has? See, IT authorities, why they want power? You need to understand why IT authorities want power. To get more and more information about us so that more and more income can be charged to taxes. DICE, I mean, whatever DICE, your DICE or whatever short form you make, discovery inspection, enforcing attendance of a person, impounding books of accounts, and issuing commissions. Yes, DICE it is. Yes, DICE it is, but okay. You might forget in exam what DICE full form is, so try learning everything. Okay. Now, why IT authority wants power? They want power because they want to know more information. For example, if there is Satish, I want to know information about Satish. What are the best way of knowing information? Either I contact Satish. Satish, hey Satish, tell me about you. How much you do? How much earn? How much do you earn? What your father do? Did you married or not? I mean, what profession you are looking at? I mean, I can directly talk to Satish. This is first way. Second thing is talk to Satish's friends. He might have any multiple friends, so we can ask him, Acha, oh, so he has a bad habit of this and this. Oh, so he goes home very late. Oh, I can talk to his friends. These are two information, these are two ways. Via communication method, there are only two ways. Na? Either I can ask Satish or either I can ask his friends. There are two ways only. But there is another way. I might go to Satish's house and ask his father, ask his father, ask his fair mother, ask his sister, ask his brother. I might go his house and I collect information. Similarly, to collect information, IT authority has basically two kinds of power. First of all is communication, information collection via communication. Here they have two powers. And then we have information collection via visiting the premises. Here they have five powers. Via communication. As I said, I can talk to Satish or I can talk to Satish's friend. Sir, whenever I want to talk to Satish's friend, similarly, IT authority has this power to collect information about me from a third party. Who is this third party? The third party may be a debtor, might be a creditor, might be a lender, might be a share broker, might be a banker, might be anybody, registrar, anybody. Anybody whose names appears in my books, okay, they can call. My neighbor, my relative, anybody they can call. Yeah, everybody can call. Right answer is you have to check whether assessment is pending or not. If assessment against me it is pending, if assessment against me is pending, then any IT authority above ITO can ask information against me. But if there is no assessment pending against me, no assessment is pending against me now, then investigation wing, every authority can ask. But assessment wing, these big people can ask. But these Tucha, JC, AC, and ITO cannot ask unless they have taken prior approval of these big people. So my information from third party, assessment is pending, anybody can ask. But no assessment is pending, then investigation wing can ask. But assessment wing, big people can ask. Tucha people cannot ask. Acha, third party is obligated to tell the information. If my information is being asked from my relatives, then they have to tell, otherwise 500 rupees per day penalty would be charged. IT authority can collect my information from me also. Likewise, I can talk to Satish and collect his information. But in this case, there are chances that he might lie. He might lie. Therefore, this information is only for cross-checking purpose, cross-verification of the data. And remember, this is only power with investigation wing. Not every wing has this power. Investigation wing only has this power. Two sections done, 133.6 and 133C done. Done and dusted. Come on to power to visit. These three powers are studied simultaneously. These two powers are studied differently. 133B, 133A and 133A2A. What are these three powers? Try understanding. 133B gives IT authority power to visit your premises, and this visit is just for checking purposes. There is no intention to take away anything. There is no intention to do any wrong thing, just to check whether the things are correct or not. You have said you are doing jewelry business, but you are not doing any opium business, just to checking business. 133A power to survey, to find out the discrepancies in books of accounts and reality. And 133A2A is nothing but power to do TDS survey, to check out whether you are deducting TDS correctly or not. Any approval required under 133B? Right answer is no approval required. Can books of accounts be impounded? Sir, no books of accounts can be impounded. When can they enter your business premises? They can only enter your business premises during business hours. Sir, this thing can be done only at business premises. This entry can be only done at business premises. That's it. That's it. Enough. 133 be done. They can just come to check the correctness, check the actualities of the business. That's it. No other purpose of this. They cannot take away your books of accounts. They don't require any approval. They can only enter during business hours. No other place they can enter. 133A talks about survey. Before survey, CCIT approval is required, and for TDS survey also CCIT approval is required. During survey, IT authority has 6 powers. What 6 powers? If they found my books of accounts, they can inspect them and they can even impound my books of accounts for maximum 15 working days plus extension allowed. If they found any cash, jewelry or other valuable articles in my premises, they might inspect them. They might place identification marks on them. They might make a list of the items that they have found, and they might record a statement of mine that whatever they have found is correct or not. They can never seize any asset in survey. Whereas in TDS survey, they might inspect. They cannot impound. They have just come here for TDS checking, so they cannot impound books of accounts. They can inspect any article. They can inspect any identification. They can place identification mark, but they cannot make a list of items, and they can record the statement of a person. Now, when IT authority can enter in your premises for survey purposes? If they enter your business premises, they can enter during business hours. But if they enter your other premises, they can only enter before sunrise and sunset. After sunrise, before sunset. After sunrise, before sunset, that is where they can enter. But sir, under TDS survey, if they enter business premises, for business premises only it is sunrise, sunset. Normally, sunrise sunset is for other places in TDS survey, but in TDS survey, business premises can only be surveyed only during the sunrise sunset period. Survey is possible at a charitable trust as well. Survey is possible if it is found that your books of accounts are kept at a third place, then that third place can be covered under survey as well. If ceremony survey is to be done, then survey can be done at ceremony as well, but only after the conclusion of the ceremony. Very simple it is. Survey, TDS survey cannot be done as ceremony. This is all about power to enter under 133B. power to survey under 133A, and power to tedious survey under 133A to A. That's it. Power to search. Power to search. Just 1.5 page and we'll be done with search as well. Just be patient. Search, we never write it, we never use the word raid in exam. Never use the word raid, always use the word search and seizure. Who can authorize search? See, ideally CCI, sorry, CIT or DIT or above authorities, but areas where joint commissioner and additional commissioner can authorize, also authorize when they are empowered by CBDT. Why search happens? See, if there is a notice for inquiry before assessment against us, or they have issued summon under 131, we have not responded, that in that case search can happen. If inquiry before assessment has been done, summon has been issued against us, and we might not respond, then survey can be done, search can be done. And if department knows that we have certain assets which we have not declared to the department, in that case search can be done. Sir, at any place, at any point of time, if search is done, I have no right to know why search has been done. Even if I went to CIT appeals and requested CIT to know that why search has been done, it is department will not tell. Even ITAT asks, na, department will not tell. Sir, only can High Court can ask and department has to respond. Otherwise, nobody else can ask why search has happened. Whenever search happens now, they can enter any premises, shop, house, any premises. They can break the locks if keys are not provided. They can access your digital records like mobile, like laptop. And if you do not provide the passwords, they might hack them. They might search any person as well. For example, you are wearing clothes, you are wearing turban, so you can also be under search. If they require the help of a local police officer, then they might take it with the prior approval of CCIT. They might seize your assets as well. They might seize your books, they might seize your cash, jewelry, but they cannot seize your stock in trade. Some things like building, they cannot seize. If you have building, then they cannot seize. So there would be deemed a seizure in that case. Sir, you cannot sell that. You can use that, but you cannot sell that. Now, what are the presumptions during the search? Whenever any asset is found, it is yours. It is assumed that it is yours. If a gold chain is found in my neck, and I say that no, it is of Akshay, department will not accept. Okay, department will not accept. If whatever is written, for example, there is an employee in my house and he wrote a paper. He took a paper and wrote that 5 lakh rupees has been paid to Satish. Then department will accept that whatever is written is true. And whatever is written will be assumed my handwriting only. At last, sir, whatever signature done is my signature only. My signature only. Remember, sometimes what happens is my multiple premises can be under search. For example, Indore, Jaipur, Delhi, Chennai, all the premises are under search. All of the places, books of accounts, cash, jewelry, other valuable articles are found. Somebody has to take the charge and he shall be lead officer. Then other officers shall pass all of the things within 60 days from the conclusion of the search. Now this brings us to a point. What is conclusion of the search? See, first of all, there will be authorization of the search. Then there will be initiation of search. Then there will be conclusion. What is conclusion? So a list is drawn, whatever the products that have been found, that is a list is drawn, that is panchnama. Officer has to sign, assessee has to sign, and that is called the conclusion of the search. After conclusion, assessee is required to file ROI and he has to furnish ROI within 60 days. And after that, assessment order is passed for block assessment. Done, sir. Now, request for release of the asset. This is, see, search is done. Search is done. Now we are talking about release of asset. When search took place, our assets were taken off or our assets were seized. So we want them to be released now. So for example, if our building was seized, then in that case now, this seizure can be done. If they took the building, they cannot take the building. If you have building, they cannot take the building. So they would do a deemed seizure where I can use it, but I cannot sell it. This deemed seizure will be valid for 60 days from conclusion of the search. For 60 days, this deemed seizure would be valid. If they want to seize it for longer period, they have to pass the provisional attachment. They have to do the provisional attachment. In this provisional attachment, I cannot sell this property. This provisional attachment shall also be valid for 60 days. So original 60 days plus 6 months extension. Maximum this long they can hold your immovable property. Otherwise, they cannot hold more than this. Also, extension if they want, they require CIT approval. After 6 months, this provisional attachment shall vacate. After that, it shall vacate. So if they cannot seize any asset for 60 days, they can do deemed seizure. And after 60 days, they can do 6 months provisional attachment. They cannot keep it any longer. What about if they took away your books of accounts? Then what happens? If they took away your books of accounts now, you can request books of accounts within 1 month from the end of the quarter of completion of the assessment. As I said, first of all, assessment would complete. Let quarter end, quarter end plus 1 month, quarter end plus 1 month, we can request books of accounts and they shall release accordingly whenever they want. Okay, they shall release. There is no time as to when they will release. We have to request within 1 month from the end of the quarter of the assessment completion. They can keep it for longer, but for that they require CIT approval. I took an example. Example is not to be checked right now. If they took away my cash, jewelry, other valuable articles, if they took away everything, okay, then I can even request that as well. Provision says if there are some unexplained assets, they shall be released only after the completion of the assessment. After paying off the liabilities only they are going to set off. But what about explained assets? The assets for which I have explanation available. In that case, sir, I have to request within 30 days from the end of the month of the season. For example, search concluded on 6th May. 30 days from the end of the month of the season ends on 30th June. So we can request up to 30th June. They shall release 120 days, within 120 days from the conclusion of the search. If conclusion of the search happened on 6th May, they shall release within 120 days. If they are not able to release from 100 up to 120 days now, so from 121st day till the date of completion of the assessment, they shall be paying us 0.5% per month and part of the month interest. For example, there is a person called Suyash who is under search and 10 crore of his assets were seized and he knew that they are going to be taxed. Suyash knows that they are going to tax it. So Suyash voluntarily says, AO, can you sell this asset so that my interest liability is set off? Sell this asset, pay off the liabilities so that my interest is saved. I am not liable for more and more interest. Suyash is asking that. Department cannot sell off any asset. Even if you have cash, now department is not going to set off this cash against the upcoming liabilities. Remember, unless your assessment order is passed, department cannot set off any tax liability. This was judgment in case of Hemant Kumar Sindhi. Sometimes under Rahul's premises now, GST department has done the search and income and documentation found that tax has not been paid. So GST department will tell income tax department. Income tax department will request our books of accounts and GST department will share the books of accounts. As soon as the books of accounts are delivered, it is called completion of requisition, and against that, again search assessment will start. This is about IT authorities. This is about entire IT authority. Entire IT authority summarized for you all. Watch this video multiple number of times, as many times as you want, and have a comfort over IT authority concept. This is entire topic. Listen to this multiple number of times, read this PDF, and you will be for sure very confident about the concepts. Believe me, for sure. IT authorities is a weaker link of this chapter, weaker link from examiner's point of view, because they cannot ask much things than this. Whatever they think, whatever things they ask, I have given that in chart, so you will be able to answer. Return of income, IT authorities and appeals are the easier portions of our assessment chapter. Assessment procedure is technical. IT authorities, ROI and appeals are easy. If you cover these three only, now you will have a greater chance of scoring marks. Plus amendments, what you do, whatever you do. 139.1. Who is required to file return of income? See, every company, AOP, BY, every person, every company, partnership firm, LLP is required to file ROI. Partnership firm, LLP or company are required to file ROI. Apart from that, any other assessee whose gross total income exceeds basic exemption limit, they are also required to file ROI. But gross total income now you have to consider before Sec 54 exemption, then only you are required to file a ROI. If you are a resident person, you have foreign assets, foreign banking interest, or if you have foreign partnership, in that case you have to file ROI. Wow, sir, wow. It means a lot to me. Okay. Apart from that, now if you deposit more than 1 crore in your current account, you have to file ROI. If you deposit more than 50 lakh rupees in your savings account, you have to file ROI. If you spend More than 2 lakh rupees in foreign expenditure, you have to file ROI. If you paid bill of more than 1 lakh rupees, then you have to file ROI. If your business receipt are more than 60 lakh rupees, then you have to file ROI. If your professional receipts are more than 10 lakh rupees, you have to file ROI. Or if your TDS deducted TCS collected is more than 25,000, or for a senior citizen, it is more than 50,000 rupees, then they have to file ROI. Due date for a transfer pricing assessment is 30th November. If a partnership firm is under transfer pricing audit, then their partner's due date shall also be this only. Any company, LLP, any other person who is under audit, income tax or any other section, any other act, then for them it is 31st October. If partnership firm is under audit, then partner's due date will be the same. For any other person like you and me, it is 31st July only. Loss return. See, whenever you have loss in return and you want to carry forward the losses, then you have to file return on time. If you don't file, then your business losses, capital gain losses, or horse races losses will not be allowed to carry forward. Mind my words, business losses, it can be any business, speculative business, specified business, horse races losses and capital losses will not be carried forward. That means, can house property losses be carried forward? Can unabsorbed depreciation be carried forward? Yes. Even with late return, you can carry forward house property losses. Even with late return, you can carry forward the unabsorbed depreciation. Fine. Also, carry forward is disallowed. Set off is allowed. We can set off. We can still set off. Set off is allowed to us. Remember, also current year losses are only disallowed and carry forward. Brought forward losses we can still carry forward. And even after late return, if our case is genuine, we can request condonation and we will be allowed losses. If our loss is up to 1 crore rupees, then we should go to CIT, PCIT. If our loss is more than 1 crore up to 3 crore, then we should go to CCIT. If our loss is more than 3 crore, then we should go to PCCIT. They will give the condonation. Within 5 years, we have to request, and within 6 months, they will approve our condonation or they reject whatever it is. Be late return. Remember, if you did not file return on time, you have an option to file the return up to 31st December of the assessment year or completion of the assessment by the AO, whichever is earlier. If you delay the return, then there are 6 consequences you have to bear. First of all, losses carry forward is not allowed. 234 interest charge, 234A interest charge. Late fees is applicable under 234F. Chapter 6A Part C deduction will not be given. 10AA will not be given. And at last, sir, refund interest will be given to you lesser. Earlier, refund interest was given from 1st April, but now refund interest would be given to you from the date of ROI. So your interest is also lost. Revise return. See, you can revise your return any number of times. Any number of times you can revise the return. But this revision should be made up to 31st December of the assessment year or completion of the assessment by the year, whichever is earlier. Revision can be done any number of times. Revise return substitutes the original return in all the senses. What does this mean? Whatever revised return you file now, that substitutes the original return. What does that mean? See, if in original return you were able to carry forward the losses, in revised return you will be allowed. In original return, if late fees was applicable, so in revised return also late fees will be applicable. If original return you were not allowed to carry forward losses, in revised return also you will not be allowed to carry forward. So whatever adjustments you could do in original return, same adjustments can be done in revised return. It's as good as date will remain same. Date of the return shall remain same only. For example, return filed on 1st July. Revised return shall substitute the original return of 1st July only. Okay? Even if you receive refund, even if you receive intimation, you can still file the revised return, no issue. Just merely furnishing the statement of income to AO does not mean file a revised return. You have to go to AO, submit the statement, and then you have to go to portal, you have to submit the revised return. Fresh claims can be made to AO only by filing the revised return. What does that mean? See, for example, if I forgot any deduction, we forgot any exemption, we forgot any kind of expenditure. In that case, what happens? Sir, we can only claim it via revised return only. Can we claim it under 142.1? Right answer is no. Can we claim it under 147? No. Can we claim it under 139.80, that is updated return? No. Can we claim it during assessments? No. Can we claim it during appeals? Yes, at the time of appeals it is allowed, but otherwise during assessment it is not allowed. Any fresh claims cannot be entertained. Trust, political party, these other person, defective return. See, if tax audit report has not been attached, taxes have not been paid, or you have filed return in wrong format, in that case, AO will treat your return as defective. You have to correct the defect within 15 days of intimation. If you fail to correct, then it is assumed that you have not filed the return. It is assumed that you have not filed the return. This PAN number, I personally think not relevant. Aadhaar number not relevant, not much relevant. Updated return. What this section says. See, your return can be filed in up to 31st December of the assessment year. This is previous year. This is assessment year. You can file your ROE up to 31st December of the assessment year. But even if you missed out that date, you have 4 years as well. After assessment year, year 1, year 2, year 3, and year 4, you have 4 years to file the updated return. Sir, in first year, if you file a 25% additional tax, you are required. Second year, if you file 50% additional tax required. Third year, if you file 60% additional tax required. Fourth year, if you file 70% additional taxes required. This is the additional tax you have to pay to file the updated return. If you have already filed return, you can update it. If you have not filed return, you can still file updated return. Fair enough? Okay, sir. Sir, what are the instances where you cannot file updated return? First of all is if you want to file a return of loss, you cannot file. Remember, updated return can be only filed for the benefit of the department and not you. Only for the benefit of the department and not you. Even if you forgot the TDS credit, now you will not be getting credit against the updated return. You will not get any refund. So any return of loss will not be allowed. Any return that results in refund or reducing the tax liability or increasing the refund will not be allowed. See, for example, search is initiated against me today, and tomorrow I started filing updated return in last year and declared every income. Is it possible that I filed updated return of last year and declared every income in last year so that I am saved from the taxes? Lawmaker says no. If search has been initiated or your accounts have been requisitioned or survey has been initiated or search has been conducted at some other premises and your books of accounts have been found in that premises, now in all the 4 cases you cannot file updated return for any of the previous years. What did I say? See, it is logical enough now. For example, on this date of previous year, search initiated against me. So what do? Instead of department finding out my income, I myself will declare 4 years, 3 years back, so that just by paying 25% taxes, I will be relieved. Just by paying the 25% taxes, I will be relieved to save myself, to avoid that cleverness by the assessees. Now, department says once search is initiated, you cannot file any updated return for any year. Sir, where updated return has already been furnished. If you have already furnished, you cannot revise it. If assessment is pending, if assessment has been initiated, then you cannot file UR. It is completed also, you cannot file UR. And it is logical. Now, scrutiny notice issued and you file return. No, it is not allowed. If assessment is initiated, you cannot file updated return. If department knows that you have some money which is under PMLA, you have some tainted money, or you have some Benami property, and that has been communicated to you, the department knows you have money, in that case you cannot file UR. If information about you has been received from foreign government that this assessee has this and this property, then you cannot file UR. If prosecution proceedings have been initiated, then you cannot file UR. Important point. Now, one thing, just try and process. We said that if assessment proceedings are initiated, we cannot file UR. Correct? Everybody agree with me? If assessment proceedings have been initiated, we cannot file UR. As simple as it can be. Assessment proceedings initiated, we cannot file UR. But sir, can I say 148A show cause notice? 148A show cause notice issued, does it amount to initiation of proceedings? That means if show cause notice is issued, can I file UR? Can I file UR? Right answer is yes, sir, we can file UR. Because 148A show cause notice does not amount to proceedings. If show cause notice is issued, unless 148A order is passed now, it does not amount to proceedings. Unless 148A order is passed, it does not amount that proceedings have been initiated against us. So if show cause notice is issued now, we can file updated return. Correct? If show cause notice is issued, we can file updated return. Year 1 we can file. Year 2 as well. If show cause notice has been issued now, we can file UR. Year 3 as well, we can file. But year 4, we cannot file. Department has prohibited that for first 3 years now you can file UR even if show cause notice has been issued. But in fourth year you are waiting for show cause notice to file UR. That means you have a lot of income in spare. We will not allow you to file updated return. This is amendment and it is important as well. No updated return shall be furnished by the SSC to whom show cause notice under 148 has been issued. In case of after 36 months from the end of the relevant assessment year, if show cause notice is issued after 36 months, now that means within if in fourth year you are issued show cause notice, that means your income escaped is more than 50 lakh rupees. You are issued show cause notice and now you are filing UR. That means we will not allow. In first 3 years you can file a UR even if show cause notice is issued, but in fourth year you are not allowed. I hope it is clear. But yes, in fourth year also, if a show cause notice is issued to us, if show cause notice is issued to us, we responded and proceedings drop. If proceedings are dropped against us now, even after show cause notice, then we can file UR. Remember, whenever we file UR and that results in changing the loss to income. For example, in 2023, we had a loss. We file updated return and declared it as income. Whenever we change our income, we declare from loss to income. In that case, for whatever years I have used that let's loss, I have set off that losses. Now for that years, I have to revise again. I have to file the updated return. For whatever year I have used that losses. Now I have to file UR for those respective years as well. Sir, how do we compute the taxes? See, if you are filing UR for the first time, that means you have not filed original return as well. Now, then tax as per updated return, interest, late fees, additional taxes, minus TDS credit, minus relief, minus MAT credit, or this will be taxable. It is very easy. If you have not filed return, then very easy tax calculation is there. But if you have filed return, then tax calculation is complicated. Understand? If you have already filed return, now you are increasing your income. What happens? First of all, you shall take the in new income as per updated return. New income as per updated return you shall take. You shall calculate fresh interest minus the interest paid in the old returns. This you will take. Then after that, what will happen? Sir, you shall add up the fees. You shall calculate the taxes. Additional taxes you shall be paying. Minus TDS credit, minus TCS credit, minus AMT credit, minus the tax paid in earlier return. This will give us the tax payment. Okay. Simple, it is not difficult at all. But sir, how you will calculate the additional taxes? See, whatever the new taxes that come your way, new taxes that come your way. So taxes plus surcharge plus education cess plus interest. On interest also 25% additional taxes charged. On interest also 50% additional taxes charged. Taxes plus surcharge plus education cess plus interest. On the total tax that turns out to be 60% is charged, and on total taxes whatever it turns out to be 70% is charged. This is on which we are going to pay the additional taxes as well. How to compute the interest? I have made a summary for that. This summary can help you to solve any question. You can take a screenshot of it if you want. Assessment procedure. First of all is inquiry before assessment. Inquiry before assessment is a gun given to department. See, department must have some powers to collect information and powers to do the assessment. This inquiry before assessment is also a power. If assessee has not furnished return of income, now department will force him to file the return of income. Any officer, maybe ITO or higher authority, may request the assessee to file the return. If return has already been filed, AO can request assessee to produce books of accounts. For relevant previous year under consideration, he can request books of accounts. Apart from that books of accounts, now 3 prior year books of accounts can also be requested by department. SSC has to furnish. Not more than that, but 3 prior years he can ask. Department might ask information about assets and liabilities as well. Assets and liabilities information might be asked. Remember, if department wants to ask any information beyond assets and liabilities, for example, if I am doing a business in my brother's premises, he is asking, department is asking registry of my brother's property. So he can also ask, but for that matter, joint commission approval is required. Remember, if return not filed, they'll ask us to return file. If return filed, they can ask us to produce books of accounts for relevant previous year plus 3 previous years. three preceding previous year. They can ask our assets and liabilities information, and beyond assets and beyond books of accounts, they can ask assets and liabilities. But for that, they require joint commissioner approval. Sir, if we do not respond this 142.1, there are two consequences possible. First consequence is best judgment assessment under 144. Second consequence is 132 search. Search can also take place if we do not respond this. Second, power special audit. IT department, see, assessing officer is just a thumb. I mean, what do we call Angutha chap? He doesn't know how to, he doesn't know anything. Okay? Assessing officer just assumes so it will be easier for you to process. Assessing officer doesn't know how to do anything. So if he feels that books of accounts are very complex, if there is multiplicity of transaction, there is volume of transaction, he can direct the SSC to get the books of accounts audited by a chartered accountant or inventory valuation done by a cost and management accountant. He can direct the SSC to get the audit done. Remember, always an opportunity of being heard is to be given to SSC. If opportunity of being heard is not given, it is invalid audit. Opportunity not given to SSC, it is invalid. See, SSC should be given an opportunity. So directions can be issued with prior approval of higher authority. Assessing officer cannot directly issue the audit. He cannot direct the audit. He has to give an opportunity to SSC. Plus, he has to take approval from higher authorities as well. The higher authorities are going to appoint the chartered accountant. Higher authority are going to appoint the chartered accountant, and remuneration will be paid by the central government. How much remuneration? Minimum 3,750 rupees, maximum 7,500 rupees will be the remuneration paid by the central government. If our accounts are already audited, again audit will be done. Sir, CA has to report submit within 180 days before using the material of the CA, chartered accountant or CMA. In that case, room again will be given. Reasonable opportunity will be given again. If SSC failed to get his books of accounts audited, he shall be subject to best judgment assessment and he shall be attracted penalty of 10,000 rupees. Reference to valuation officer. Sir, if assessing officer doesn't understand the FMV of the asset, now he can refer the case to valuation officer for asset, property or investment. VO shall report furnish the report within 6 months from the date of the reference made. Whenever this report is to be used, again reasonable opportunity to be given to the SSC. Section 133.1 assessment. Oh, let me have a glass of water and then we'll continue. Now I am tired. Now this 10 minutes and we'll be done. Focus. Summary assessment, processing of return or intimation. Okay. Whenever you file the return, your return is processed. Department processes this return. If it has arithmetical errors, what are the arithmetical errors? For example, you are opting for presumptive taxation. Instead of 8%, you have offered 800%. But yeah, it is wrong. Okay, it is wrong. They will correct it. They will charge 100% only and they will tax you. If you have claimed incorrect, if you have done any incorrect claim apparent from record, which means, for example, you have interest as 0, you don't have any interest, but you have claimed 80 TDA, then in that case, it is incorrect claim. If you have delayed return, if you have filed late return, then losses will be disallowed. If you have delayed the return, any loss, any chapter 6 deduction that should be disallowed will be disallowed. Any expenditure that is considered in tax audit report and you have forgot to consider that in ROI, then this shall be considered. Before making such adjustments, now they will give an opportunity for correction. They will give an opportunity of correction and we will be given 30 days time limit to correct it or to respond it. If we do not respond, department will process the return considering such changes and intimation will be sent to us within 9 months from the end of the financial year in which return is furnished. So 9 months from end of the financial year of ROI. You can write this word and this word is only relevant for your topic. Then we have scrutiny assessment. See, scrutiny assessment is done for the return filers. Scrutiny assessment is done for the return filers. Return filers simply imply you have filed return, then your case can be selected for scrutiny. Fair enough. Sir, whenever scrutiny assessment is to be done, you are to be issued a notice. Without notice, scrutiny assessment is invalid. It is absolutely invalid. No questions, no ifs and buts. It is absolutely invalid. If you have not been given any opportunity, it is invalid. Sir, When notice can be issued? Remember, notice has to be served within 3 months from the end of the financial year in which ROIs was filed. That means if ROI has been filed in up to 31st July 2026, then in that case, scrutiny notice should be issued up to 30th June 2027. Whenever you file ROI now, within 3 months from the end of that financial year, scrutiny notice will be issued to you. Within 3 months from the end of the financial year, scrutiny notice will be issued to you. For sure, it will be issued to you. If it is not issued, your assessment is invalid. You can learn a thumb rule that 30th June is the due date. After that, it will not be issued. Okay, 30th June is the due date. Sir, what if we filed a return? What if we filed a return and our return was defective and our return was corrected in next year? Then, sir, scrutiny due date is always taken from the original return. Original return date has to be checked for the finding of the scrutiny date. Done, sir. What happens, sir, in case of trust? See, in case of trust, for example, if assessing officer finds out any specified violation, he will refer the case to CIT. CIT will find out whether cancellation to be done or not. CIT will cancel the registration and give the order to AO, and assessing officer will pass the final order based on the order. Order shall be passed within 12 months. 12 months from end of assessment or year. From end of the relevant assessment year, this is the order date. Just this is the thing you need to remember. 3 months from end of financial year of ROI. These are the dates that you want to learn. Otherwise, everything you can skip out. Best judgment assessment. Now, what does best judgment assessment imply? You have not responded to 4 things. First thing, 142.1. You were issued inquiry before assessment. You did not respond. You did not file return under 139.1 or 4. You were issued special audit notice 142.2a. You did not cooperate in special audit, or you were issued scrutiny notice. You did not respond. In these 4 cases, department is going to give the best judgment assessment against you. Department is going to do best judgment assessment against you. Whenever department wants to do best judgment assessment against you, department shall ensure that they issue a show cause notice. But sir, show cause notice is not issued when best judgment assessment refers to 142.1. If you have not complied to 142.1, you will not be served any show cause notice. In otherwise 3 cases, show cause notice will be served. But in this 142.1, no show cause notice will be served at all. Why it will not be served? Because 142.1 in itself is a show cause notice. Once you submit show cause notice, they will do the proceedings and they will submit you they will pass the final order. Sir, whenever they want to do the best judgment assessment now, refund will never be given. There is no refund possibility in case of best judgment assessment. No refund possibility. Sir, order shall be passed within 12 months from end of relevant assessment year. Order shall be passed based on 12 months from the end of the relevant assessment year. Sir, when show cause notice can be issued? No date prescribed. No date prescribed till when show cause notice should be issued. Remember, whenever department wants to do income escaping best judgment assessment, this should not be done on ad hoc basis. This should not be done on arbitrary basis. No, it should not be done on ad hoc or arbitrary basis. Sometimes when you follow the method of accounting which is not consistent, 1 year you are following cash system of accounting, the other year you are following the accrual system of accounting. If it is inconsistent, and then your books of accounts are irrelevant, in that case AO will do the best judgment assessment. Sometimes you do not follow ICDS, then your books of accounts, your income computation is irrelevant. He will do the best judgment assessment in this case. If AO is not satisfied with the completeness of the books of accounts, if AO thinks that you have maintained books of accounts which are not complete, in that case also he shall do the best judgment assessment. This is called discretionary best judgment assessment. Power of joint commission you can cut down. Income escaping assessment I will cover in Bhula series. Rectification of a mistake. Listen, if you have filed a return of income, or if assessment not filed return of income, if assessing officer has passed an order and this order contains some mistake which are apparent from record. Mistake apparent from record means 2 plus 2 by mistake he has done 5. This is mistake apparent from record. So he either suo motu can correct it, or assessee can request for correction. Both these things are possible. See, he has passed the order. intimation order or any other TCS CDS intimation, he has passed an order which is mistake, which contains mistake, and which is a non-debatable mistake. Non-debatable means there is no questions why it is wrong. Okay? Either they can do suo moto or even assessee can request no form and fees prescribed. If they want to do suo moto, na, they can correct within 4 years. If assessee applies, then assessee can also apply in 4 years. Remember, department has to correct within 6 months if the assessee has applied. If department could not pass the order within 6 months, then rectification cannot be done. But sir, if it is for the benefit of the assessee, if it is for the benefit of the assessee, department will get additional time limit for 4 years to correct the order. So every rectified order is appealable order. Remember, see, for example, there were multiple mistakes in an order, and out of them, one mistake I went for rectification. I went to correct to get one mistake corrected. I went in that case. If I went for one mistake now, if I went for one mistake, that is still uncorrected, and my time period for 4 years have lapsed. Lawmaker says if that one mistake has been not corrected, now you can again file rectification for that one mistake. But for all those mistakes for which you didn't originally request for rectification and for them time limit has passed, you cannot file rectification. So if uncorrected mistake, sorry, if a rectification is sought for a mistake and that is still uncorrected, now uncorrected mistake shall be again 4 years given to you. But for other things, now 4 years from original order shall be counted. Very important point. This is tested in exam. Multiple mistakes. One is sought for correction and that remains uncorrected. Order is passed and it is still uncorrected. So 4 fresh years will be given for that mistake. 4 fresh years are not given for original mistakes. Section 156 demand notice. See, whenever any order is passed against you, then department will pass a demand order to collect the taxes from you. This demand order has to be issued to you, has to be served to you. Okay? But sometimes tedious intimation order, if intimation order is there now, then demand notice will not be served to you. Any assessment order is passed, then demand notice is also passed. But in case of intimation, no demand notice is passed. Whenever any demand notice is served to you, you have to pay that demand notice within 30 days. If you don't pay within 30 days, sir, from 31st day till the date of payment, you will be charged 1% interest per month and part of the month. Sometimes what happens is, we are not even aware that interest is outstanding on us and interest continues to accumulate. In that case, what happens is we have to go to IT authority for waiver of that interest. Which IT authority we have to go? Sir, if interest is up to 50 lakh rupees, we have to go to PCIT or CIT. If interest is more than 50 lakh up to 1.5 crore, then we would go to CCIT. If it is more than 1.5 crore, then we would go to PCCIT for the waiver. At last, we have protective assessment. If ownership of a property is under dispute, I don't know who shall be the property. Who shall be taxed? There are two sisters fighting for the ownership. Law says we will tax in the both hands. Later on, who shall become the owner? Now we shall continue to tax him, but other person, we will file a rectified order, and he or she shall be relieved. He or she shall be given a refund of Section 292B or 292BB. Important. So 292B, what it says, if you have been issued a notice, and it contains some clerical errors, just because clerical errors are there in the notice, now it is not invalid, it is valid notice. For example, we have Janhavi. Instead of Janhavi, Janvi is mentioned, or JHNVI mentioned, and Janvi says, no, I will not respond. See, it is a valid notice. You cannot argue on the clerical errors. But what if notice has been issued? Notice has not even issued. Scrutiny notice is not issued. So it is invalid. It is invalid. Second thing, sometimes what happens is there are two companies which are amalgamated. After amalgamation, if assessing officer issues to old non-existent amalgamating company, old company which is not even into existence, whether it would be valid? Right answer is it would not be valid. Because when amalgamation happens, now department is being informed. There is an inherent obligation for the companies to tell the income tax department about the amalgamation. In this case, even after knowing that even after knowing about amalgamation, department still issues notice to this amalgamating company. Now, in that case, it is invalid notice. This is not a clerical error. 292BB, what it says, if you have been issued a notice which is time barred, that means scrutiny notice issued up to 30th June, but you have been issued up to 5th July. If it is time barred, sir, it is by default invalid. But if you participate and order is passed, it shall become valid. If you participate and order is passed, it shall become valid. So, sir, we are not left with any option. So, if you participate now, you have an option to object. Before passing of the order, you can object. If you object, then it shall become invalid. But if you don't object and you let the order pass, it shall become finally valid order. That is 292 BB. Block assessment I will cover in Bula series again. One topic I remember that I forgot is 144C. 144C is important. See, whenever any order is passed for foreign company or non-resident, or any order passed where reference to transfer pricing officer is made, in that case, what happens is, what happens is, sir, a draft order is given to assessee. He has three options. He can accept. Wow, draft order is very good. He can accept. Then draft order shall become final order. Assessing officer will make draft order as final order. This is not appealable because assessee is accepted. I mean, appealable like high court or by high court you can go because you have accepted the order. Now, how can you do anything? If you don't do anything, that's a different matter. But if you accept something, how can you fight that? Okay. Second thing, you have an option not to do anything. Not to do anything. The order came, that is kept in your drawer, you did not respond. So again, assessing officer will make draft order as final order, but this order is appealable because you have not accepted, and this order is appealable to this order is appealable to CIT appeals. At last, sir, you have an option to object that order as well. Whenever you don't like any order, you can object that order as well. Okay? Assessee can object that order. Okay? Once objection is done now, the case will be transferred to dispute resolution panel, and dispute resolution panel will give guidelines to the assessee within 9 months as to how to do the assessment. Guidelines will be issued. Assessing officer has to accept these guidelines and he shall pass a fresh order within 1 month. Within 1 month from the end of the month of the guidelines. He has to pass the order. Can assessing officer object to the guidelines? Right answer is no. Assessing officer cannot object to the guidelines. Sir, if assessee is not satisfied with the DRP guidelines, he can appeal to IT-80. The best part of all, sir, if assessee has objected to DRP will issue guidelines on time, but assessing officer is not able to pass order within 1 month. This assessment shall become invalid. Assessment shall become invalid. And that completes your assessment as well. In this assessment, we covered entire syllabus, IT authority, return of income assessment also. Two things are left, that is block assessment and income escaping assessment. From examination point of view, this upcoming attempt, you can even skip out income escaping assessment. Even if you just go through the video, that is sufficient. But income escaping assessment, according to me, is not much relevant for your attempt. Block assessment and income escaping assessment, both the topics, you will see a video in Bula series with English subtitles or English audio. So you can refer that as well. With that, we complete our 9-10 major chapters. We completed with tax rates, we completed capital gain, we completed IFOS, we completed PGBP, we completed assessment of various entities, plus taxation, tedious taxation assessment. And I swear I have not left out even a point in PGBP, not even a point in assessment of various entities, not even a point in cap gain, and not even a point in trust taxation, not even a point in tedious as well. And all the points of assessment has also been completed. I name it a marathon, but it is a regular revision class. I might clip it as well and upload it separately. So it is a revision that I have given to you just to take full advantage of it. And please make this attempt your last attempt. Anything you want from me now, just message me out and I will deliver that to you. In English also, I have tried to deliver equal content the way I have done in English, in Hindi as well. Okay. So that's all from my side today. You all have been wonderful students to sit for this long, and it's because of you only I have been able to sit. It really means a lot to me. Just one request, as I have been saying this, do like the video, subscribe channel, share it with your friends. Do comment down your experience after the video ends so that people are able to make an opinion based on your comments, because live comments are taken off. Okay? Once the video is over, live comments are taken off. People can only see the recorded the comments after the video. So once the video is over, you can do mention your comments as well and share it with your friends. Anything on me, I'm here for a minute, otherwise our session is over. Akshay, thank you so much for this exhaustive revision session. It was truly as comprehensive as possible it could be. Absolutely worth every minute of our time. Grateful. It means a lot to me. Be sure, get Bula series in English. It will help to revise more. See, Bula series English, entire English would be difficult. It is 10, 15 minutes video now. So I enable the auto dubbing in that it is it can be heard in English as well. So you can refer that as well. It is difficult for me to cover that every topic in English. But yes, if you are saying now, I have two more thing, two to three things more planned. MCQ series I have to come up. MCQ one-liner summary I will be coming up. RTP, MTP, and shorter theories of RTP, MTP I will be coming up in English as well. So still yet content is yet to come for your attempt. You just pass. I will deliver. I will continue to deliver. Thanks all from my side today. You all have been wonderful, wonderful students. See you guys on some other video with same energy, excitement, enthusiasm. Bye bye. Take care. Love you all. Signing off. See you. Rahul Satija.